Take your wealth to the next level.
Rory McIlroy knows success takes preparation. At FM, so do we. Rory conquers the heat, the water, the wind. FM helps you conquer any storm. Rory's success demonstrates the power of resilience.
What a finish for McIlroy!
FM empowers you with it. Engineering resilience into your business. Helping protect and ensure your purpose.
It probably would have come out on streaming. You know, I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. You know, but that's where I'm at today.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Amin, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate.
More than what you need to know, it's what you need to think about.
Mag 7 hasn't been the monolith that it had been the last couple of years.
Tech companies have healthy balance sheets, but on the margin, they're getting worse rather than better.
More cash flows generated in Mag 7 than the rest of the S&P.
There is a lot going on into next year, which is why I think we're positive, but I think there may be some volatility.
There's a 30% chance that you get a full-on bubble next year.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Stocks pulling back after hitting another record high on Fed rate cutting expectations, with questions mounting about how far big tech can really go. Questions after Broadcom earnings, questions after even Oracle. Now we're going to be looking at all of the data coming out in the upcoming week, including the November jobs report, as well as, of course, retail sales and CPI. A real question here as we get some commentary from a number of the Fed members.
Yeah, a busy week for them. Opining, we heard from the Fed chairman. Now we're hearing from other members of the committee, regional bank presidents as well, about how they see the economy, the prospects for it going forward here. You mentioned that data, a lot of it delayed. Some of these deadlines are now indefinite. Just an open question, I think, of how effective it is in telling us about the state of the economy today. Obviously, always backward looking, but now increasingly so, and I think that kind of flummoxes them a little bit more.
Yeah, we're getting commentary this morning from Austin Goolsbee, who was one of the three dissenters. He dissented to not have any kind of rate cut. He said that he felt it more prudent to wait for more information, talking about how a lot of the business people and consumers that they have spoken to in his district talk about prices, the sort of cost concerns that we think about. I remain optimistic that interest rates can come down a significant amount over the next year. As I've reiterated for months, my unease is about too heavily front-loading rate cuts and just assuming that inflation will be transitory. How much is the T word still hovering over this for FOMC?
A lot of popular fascination about Austin Goolsbee as a dissenter in that last decision. Here we see him kind of reiterating what he said all along. He is an adherent to the data. He likes to talk about the data, wants to see more data. That's been something we've heard from him over the course of the last few months, just the eagerness to have more of it. So not surprised there, but certainly interesting, again, to think about the move that he made there, advocating for a pause here until we get, I think, the big data number from next week, of course, the jobs number from the Labor Department.
On the other side, we're getting Anna Paulson, the Philadelphia Fed president, coming out and explaining why she did opt to cut rates, saying that she is still more concerned about the labor market than inflation. Next week, we get a read on that information. Next week, we get, of course, the jobs report from November on Tuesday. We also get retail sales, and then on Wednesday, CPI. So both sides of this equation, albeit with some dated measure, the idea that this should have come out already before this meeting, and yet here we are because of the government shutdown. Watch this space, especially given some of what's been priced in terms of rate cuts for next year. Meanwhile, in markets, yesterday we did see all-time highs. Today, pulling back just a touch, although really, as the session grows older, you can't keep a good market down. This is very much for you, Steve Chiavarone, down just now 0.1% on the S&P. Yields just slightly higher, now crossing that 418 threshold on 10-year yields. Yield curve steepening, taking hold after the Fed cut rates, and you are seeing ongoing dollar weakness throughout the week, but today marginally strength at 117 on the euro-dollar cross. Coming up this hour, Daryl Cronk of Wells Fargo as stocks trade near all-time highs. Former White House CIO Teresa Payton as Disney is officially entering the AI era. Hello, Mickey Mouse. And former House Majority Leader Eric Counter on the Fed's path ahead for interest rates. We begin this hour with stocks looking to end the week on a high note, possibly. Daryl Cronk of Wells Fargo writing, we believe the next 12 months will favor U.S. equities. Trade, tariff, and longer-term inflation concerns could result in equity buying opportunities. Daryl joins us now. Daryl, thank you so much for being with us.
My pleasure, Lisa.
So before we get into 2026, what do you make of this week in terms of the Fed meeting, in terms of the rhetoric we're hearing this morning, and the sort of push-pull that we need more information before the Fed can more aggressively lean in any direction or give any kind of guidance?
Yeah, I think, well, so Austin's comment this morning about significant rate cuts into next year doesn't match with how the vote came in last week, obviously. We still think, I mean, if you look at their dot plots, right, they have one cut in for next year. It's probably too light, to be candid, right? You're going to get a new Fed chair in mid-May, right, who all signs indicate is going to be dovish, right? We think there's probably at least two cuts into next year. And you're seeing that in the bond market. The bond market doesn't believe the Fed's SEP dot plots. It's saying, if you look out on Fed funds futures, that by December of next year, there'll be 53 basis points reduction in Fed funds, which is two cuts, basically. I think you could build more of that in there, particularly if you see that consumer weaken, which you've talked about all morning, the labor market deterioration. I think the November jobs report next week is not going to be very pretty, right, from a headline number.
So this goes to Priya Misra's question, right? Are rate cuts a good thing if they're coming on the heels of weakness in the labor market? Are they a good thing for risk assets? How do you take that?
They have been a good thing for risk assets. We saw that reaction on Wednesday, obviously. It's interesting. I think what's changing in risk assets, if you get below the surface, is it's more of it's about cyclicals, but it's more about industrial cyclicals than it has been about consumer cyclicals. For the longest time, you know, in the last several years, consumer discretionary has done extraordinarily well, along with tech and comm services and all that stuff. Now you're really seeing industrials take off. You're seeing financials take off. You're seeing, of course, utilities continue to take off and participate. So 2026, I think, ends up being more about kind of like an industrial cyclical play than maybe a consumer cyclical play, as the consumer still struggles with a bad labor market, poor confidence levels, and you know they're going to get the boost from the big tax cuts coming in the first quarter of this year. Most people don't realize that. The tax cut number is going to be up 50% year over year. It was $300 billion last year. It looks like it's going to be north of $500 billion this year. So it's material. And history tells you the consumer will spend. They spend $1.17 of every dollar they get back in a refund historically, if you go back and look at the data.
We see that disconnect between the street and the SEP, as you mentioned. I think a lot of kind of concern or curiosity about what this Fed looks like come May when Fed Chair Jerome Powell steps aside, either to become a governor, remain a governor, or do something else entirely. He wouldn't say which. We did have this news overnight, the Fed confirming 11 of the 12 regional bank presidents. There's one retirement there. But certainly I think for those who are worried about Fed independence, a positive step forward here. How much are you thinking about that, the change in personnel at the Fed? How much is that kind of coloring your sense of where things are headed? It does seem like there's a lot of ambiguity and unknowns going into this new year when it comes to monetary policy.
Yeah, I think we think that the Fed independence, concern, risk might be a little bit overplayed, especially now that you've got the Fed regional presidents, right? So you've got the 7 governors voting. You've got the New York Fed president who always votes, and then 4 rotating regional Fed presidents, which make up the mix of how the Fed votes at every meeting that they have. So not much turnover of the 7, right? The New York Fed looks to us like it stays where it is, and you get the normal rotation of the 4, but it's going to be the same 4, right, to your point of 11 of the 12 staying home. I think had you had more of a mix-up in those regional presidents, I think you'd have restarted that whole narrative about Fed independence and influence of the administration over the Fed and that type of thing. I think everybody breathed a little bit of a sigh of relief yesterday afternoon when that news came down, minus, Regional President Bostic, who had already announced his retirement.
I'm sure you were working on your outlook for 2026 for months. It's gone through edits, et cetera, et cetera. Has anything changed as a result of what's happened this week when you look at what we've seen from Oracle and Broadcom, the kind of agita surrounding the prospects for AI, the concerns about debt? Does it change the color of or your sense of what the year ahead looks like?
No, not at all. I mean, you're going to have moments in time when you get these big transformations like AI, where things overheat and then they walk themselves back. And so to us, that looks like a short-term kind of noise. We actually launched our outlook this last week, and the title of it is called Trend Lines Over Headlines, right? And that was a theme throughout 2025, right? Think of all the noise. Go back in 25, you had DeepSeek early in the year, right? Then we moved to Liberation Day in April, right? Then as we went through the summer, the U.S. comes in and bombs 3 Iranian nuclear facilities. We walk into the fall. Like, it's the old adage, there's an axiom on Wall Street that says, if you give an investor $1 million and perfect foresight, they will find a way to go broke, right, over a year, right? Because when you looked at those news events, you would not sit here at this moment in time and say, the S&P 500 is a stone's throw away of putting the third 20% return in the books consistently or consecutively at year end here. I mean, we're up basically 17.5%. I tack a 1.5% dividend on. I'm right there, right? Which on the back of 24 and 23, that's a great return, right? Notwithstanding all that noise and headlines. The trend lines are what we want to pay attention to, and that's, monetary stimulus, fiscal stimulus, deregulation, what we think is a CapEx super cycle, and the M&A world picking back up again. All those things have real materiality to them and play through the day-to-day noisy headlines.
Which is the reason why there are so many double-digit expectations for 2026 as well, which is actually fairly rare, right? I mean, but we got from this morning, we got Goldman Sachs strategists seeing a 7,600 price target. That's on the lower end with just a 10% gain. It just kind of highlights, does it make you worried that it's so consensus now, that we're going to just keep on grinding higher because of this trend line?
So people forget, if you spin the clock back to exactly this time last year, the consensus was that the U.S. economy would enter a recession in 2025. And in fact, the first quarter GDP was negative. It was down 0.5, 0.6%, right? And then we took off in the second quarter economically, right? But people were very differently positioned this time last year than they are today. Just this week, we started to see S&P 8,000 targets out there, Lisa, to your point, right? So the optimism and euphoria we've flipped the script from last year to this year. Consensus is rarely right? Let's just call it what it is, right? History proves you over and over again that the crowded consensus often isn't the right trade as you think about what's going to happen on a forward-looking basis and not a backward-looking basis, which too many of our PhD economists and everybody else are looking in the rearview mirror all the time instead of out on through the windshield.
Daryl Cronk, I'm so happy to say that you're going to be sticking with us for the hour. While we were speaking, there was some news that just crossed a Reuters scoop talking about NVIDIA potentially raising its H200 chip output due to demand. This was the big question earlier this week when President Trump signed off on NVIDIA's ability to sell the H200 chips to China. Would there be the demand? And really, this would suggest that the answer, which is yes.
This was just a huge open question. I mean, we can't understate that enough, have to underline that there's been this roiling debate, what should be exported to China, what shouldn't be. And there was that kind of coyness or strange moment on the earnings call with the CFO of NVIDIA where they said they're basically treating China as a zero line item on that. They weren't counting on this kind of investment. So we were all wondering, the company itself, I think, very much wondering sort of what that demand would be like. And we've certainly gotten mixed messages from China over these last few weeks. And then the news that we reported earlier this morning, there's going to be this new kind of subsidy or state focus from China on its chip industry as well. So a lot swirling around that over the course of this Friday morning.
Yeah, China trying to put its thumb on the scale when it comes to its financing of domestic chips, while at the same time their companies
needing these chips from the U.S.
chips from the United States. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg brief from Vonnie Quinn. Vonnie.
Lisa, thank you. China also considering a package of chip sector incentives worth as much as $70 billion. Sources telling us here at Bloomberg the program would aim to reduce China's reliance on foreign chip makers such as NVIDIA. President Donald Trump signing an executive order to go after state-level regulation of artificial intelligence. Trump saying the industry shouldn't have to navigate a patchwork of AI rules. The order directs the Attorney General to set up an AI litigation task force to sue over state laws that are inconsistent with White House policy. Lululemon shares rallying in the pre-market on news that CEO is stepping down. The company's founder is weighing in, writing, quote, "The company needs revitalization and an infusion of new skills to get back to being a product-first company." He's calling for new independent board of directors to lead the search for a new CEO. And that is your Bloomberg Brief. Lisa.
Thank you so much, Vonnie. Up next, the morning calls, plus former White House CIO Teresa Payton as Disney enters a whole new world of AI. Who knew that we needed a GIF with Mickey Mouse talking to you personally about your laundry? That's next. This is Bloomberg Surveillance.
Some bad people tried to hack me with sad affirmations.
Sad, Craig?
No. We're protected.
AT&T Dynamic Defense help protect us because small businesses need us.
So he's not sad. Guess we don't need these.
I think we do.
Meet the all-new Fidelity Trader Plus with your preferred tools, customized charts, and streaming data, so you can start a trade idea on one device and execute it on another. Meet our most powerful trading platform yet, Fidelity Trader Plus.
Excellence takes drive, work, perseverance. Tiger Woods brings it to the course. Insperity brings it to your business. Want to be the best? Work with the best. Insperity, how HR matters. Learn more at insperity.com/tiger.
There's part of this deal we like and part that we don't. The part that we like is we'd rather see a commercial deal than litigation. And so we like the idea that they've inked something. We think Disney is going to get some cash for the use of its IP. The part I don't like is the billion-dollar investments. Disney tends to have a propensity to invest its capital at sort of the peak of the mania.
That was Jason Bazinet of Citigroup on this discussion of Disney and its partnership with OpenAI. A real question about how you get involved in artificial intelligence as a content creator. Right now, big tech underperforming, but really you are seeing futures come back as the session grows older. S&P futures now barely down, less than 0.1%. You are still seeing, though, that sell-off in the yield space. 10-year yields close to that 4.18%. So a real question here heading into next week about whether we do get supportive, robust data coming out of the U.S. economy. Time now for the morning calls. First up, Bank of America raising its price target on Lululemon to $220, viewing its leadership change as an opportunity for a fresh perspective. Those shares surging almost 10% in pre-market activity. Next up, JP Morgan upgrading Citi to overweight, expecting profitability to improve next year. And finally, TD Cowen raising its price target on Broadcom to $450, highlighting upside from its business with Anthropic. Those shares still lower, 6.2% ahead of the open after earnings yesterday were fine, but then they didn't necessarily give a guide that left people with a good flavor in their mouths. Sticking with AI, Disney licensing its characters to OpenAI and taking $1 billion stake in the startup. Former White House Chief Information Officer Teresa Payton writing, "This move makes clear the Gen AI era is here to stay, and when a company like Disney loosens its grip, it shows just how quickly AI is reshaping expectations." Teresa joins us now for more. Teresa, thank you so much for being with us. Let's start there. This idea of how do content creators grapple with the AI era? What have we learned from this transaction?
Yeah, this is very interesting, bold on Disney's part, also risky, because if this AI-generated content crosses the line, both creators and consumers are not going to blame the algorithm. They're going to blame Disney. But it really is an energizing time. It'll be very interesting to see where this goes. I hope and I see sort of early signs that content creators are protected in the initial stages of this deal. So it could be that actually content creators, if it gets executed the right way, may actually come out on top. But you know, kind of the proof will be in the details as this rolls out.
And Teresa, we can get into whether this is the right partnership for Disney, the idea of this particular engine and exactly how people are going to be using it. But does it highlight to you something else that's taking place throughout Hollywood, throughout the creative realm, which is trying to figure out who to partner with so that you don't have to just be aggressively going after everybody? You can actually be working with them to make yourself more relevant.
Yeah, I love that you brought this up, because if I were advising Mr. Iger and Disney on this particular thing, I noticed that it's 3 years. That's too long. We don't know who the winners and losers are going to be in 3 years. And so I would have liked to see, and maybe it's in the contract details and we just aren't privy to it, I would have liked to have seen it could be up to 3 years. Maybe it's a 1 year horizon and then renewable after 1 year up to 3 years. But this does show how fast AI is reshaping all of our expectations, and how urgently we need a couple of things. We need governance, we need AI ethics, we need safety standards and security standards, as well as protection of intellectual property. The creators are going to be the first to feel this the most, but businesses everywhere, consumers everywhere, you're going to see over time, we're going to have to think about what are the emerging standards as well as it relates to our intellectual property.
You opened the door with your, if I were advising Bob Iger, so I'm going to go there. And I'm very curious, when you look at the debut of Sora, it was like a mess of slop. The company got into a ton of trouble. There were the Martin Luther King Jr. videos and the like. This was really kind of something that blew up quickly, was kind of a cultural flash in the pan, and then kind of crashed cataclysmically at the end. Look, we're used to seeing Mickey Mouse play the role of Bob Cratchit with Scrooge McDuck, but when this moves into something else, you're going to need guardrails in place. And I'm just curious about your sense of the thoughtfulness that went into this deal, and both of these companies shared capacity to deal with this, to regulate this space, and sort of how that colors the deal as you look at it.
Yeah, I mean, Disney has been a leader in sort of thinking about how to do things differently, everything from animation to movies to theme parks to resort stays. So Disney definitely does put a lot of thought and time into how they think about this. I'm assuming the Imagineers are going to be all over this. But you bring up something really important, which is sort of this shared responsibility the two companies now have to the governance and guardrails. And I don't know that any company right now really understands the combination they're going to need to have for moderation of these different things that are posted on these online platforms. So it's going to have to be somewhat of a human-led, human precision around the content that's generated and making sure it doesn't violate the terms and conditions. We're not going to be able to leave the job up to AI to govern AI, because I think in the end, AI will decide, meh, it's probably okay. So I think you're right. There's a shared responsibility here. We need to underscore that, and hopefully they're going to have people all over this as far as those governance and guardrails, looking at content and being very assertive around taking down content that could damage the brand, be bad for public safety, and some of the other things that are sort of unintended negative consequences.
I'm going to sound like a huge skeptic here, but put this question under the what are we doing broader question. And that is, you have at the enterprise level companies wondering about how AI is going to change the way they work, pouring a lot of money into this, maybe not knowing exactly what it's going to be like when it's put into effect. Here we have Disney doing this, and I'm just kind of curious how you react to the question of, like, is this it? I mean, is this kind of the radical change that AI is going to bring about, that, like, Lisa's going to be able to make a delightful 10-second video with Mickey Mouse or Donald Duck? What does it say just about our sense of where this technology is going versus sort of what we kind of recognize as we're able to do right now?
It's a great question. And, you know, this is an example of, you know, sort of that keep your friends close and your frenemies closer. I'm not sure how Disney is looking at all of the different AI content platforms, but we know they had a beef with Google that you know, is under discussion, and now they placed a bet on OpenAI. So I think what we're seeing here is some early bets being placed. I don't know necessarily that this will be an ongoing, sustaining relationship. We'll just have to to see. But it is smart on Disney's part to lead the way, to say, well, we're going to place a bet on this. We're going to learn from this. We're going to pilot this type of partnership and relationship. I think, again, 3 years is too long. That's just my humble opinion here. But I think it's smart for them to place a bet. Hopefully, again, the Imagineers and the governance and guardrails that Disney can bring to bear and the discipline that Disney can bring to bear is going to result in something smart. I do think this will start a new wave of announcements like this. So I do expect to see other entertainment groups as well as other companies announcing big partnerships like this.
Former White House Chief Information Officer Teresa Payton, thank you so much for being with us. Daryl Cronk still with us here from Wells Fargo. From your perspective, is this a good deal?
I think it's actually a better deal than initially people thought, right? It's the classic boardroom / management strategy of partner and police at the same time. Partner with OpenAI, figure out where you're going to put, to Teresa's good points, the guardrail, and then police, what they considered to be kind of intellectual property theft or illicit use that didn't have guardrails and was not codified in some way, right? So this allows them to say, look, we have a partnership with OpenAI. It's short form video. We have this cast of 200 characters, right? So it puts those tight guardrails on what that universe looks like, and then that way they can defend it in the corporate universe where people are using it in long form video or in other places, TV, where there's no rules to the road type of thing.
We were talking about, is this a good thing or a bad thing for Hollywood actors, for scriptwriters? Yeah. And there is this issue of what is the precedent here after the strike that we saw last year in terms of AI-generated content? Do we have a clear sense of that, or does this just raise more questions than answers?
I think it's the latter. It's more questions than answers. I think the actors and actresses will really question where's that line of demarcation between, can you use my voiceover? Can you replicate it through AI? Do I have any, contractual rights there? Am I getting paid for that and monetized in any way? So I think all that still has to be figured out, but you've got to take the first step of the partnership, and Disney had to establish the partnership. I completely agree with Teresa that this is going to unleash a fury of kind of other partnerships and considerations. Obviously, we see that already with what's happening with, the Netflix, Warner Brothers, Skydance, saga, right? So the media world is really becoming kind of ground zero for a lot of those battles about what the future looks like and who's going to control it.
Yeah, which is to your point, are we going to be here or is it going to be Donald Duck sitting here? And the question of what the labor market will look like and how it gets affected.
You'll see.
Tune in Monday. You never know. Coming up next, we'll talk about the labor market. Becky Frankowitz of Manpower Group on the impact of AI with respect to jobs. From New York, this is Bloomberg Surveillance.
The all-new Fidelity Trader Plus with your preferred tools, customized charts, and streaming data, so you can start a trade idea on one device and execute it on another. Meet our most powerful trading platform yet, Fidelity Trader Plus.
You can't control the course or the competition, but you can control what you do next. Tiger Woods built his career on the ability to reset, adapt, and make the next shot count. Insperity is built to help businesses do the same. You deserve an HR partner that's there to help you thrive, no matter what comes your way. Insperity, because how you HR matters.
This is a book, but it's also a teacher for students and lifelong learners. In 2024, nonfiction book sales reached almost 362 million copies. In a connected world, books help us stay connected to each other, too. Bookstores and publishers are thriving as retailers reimagine stores as curated experiences for digital-weary customers, using connectivity to track inventory, manage supply chains, and increase sales. In the past year, the American Booksellers Association increased by 200 members, while book club event listings grew by 24%. And a book is also a launchpad. Film and TV studios and social media platforms are amplifying new voices, creating entertainment from the books that make us laugh, cry, and think, with tools that depend on reliable and secure connectivity from AT&T Business. Because reading is a journey of discovery, and a book is a compass that helps us find the way forward.
Premium benefits anywhere you go. Unlimited, zero trading fees. 6% back in crypto. And other exclusive benefits with Level Up. Take your wealth to the next level.
In 3 days, Silicon Valley Bank had failed. Here was an opportunity for us to buy when others are selling. I turned to my research team and said, let's do our homework. When you think of smart and repeatable strategies for us here at Vanguard, it really starts with our research-driven security selection. There's always mispriced opportunities if you've done your homework.
I should listen to Steve Chiavarone more often. Yesterday, futures were lower, and he said by the end of today, it's going to be higher. Well, right now, we're seeing futures that were substantially lower, and as the session grows older, less so. S&P futures down by 0.1%. You are seeing a little bit of reprisal for the dollar, although just. We've seen dollar weakening, 117 on the euro-dollar cross, and yields now crossing that 4.18% level on the 10-year, as you do see that yield curve steepening. Turning to the Federal Reserve, as we hear from multiple speakers today. Bloomberg's Michael McKee joins us now. We did hear some comments from Austin Goolsbee. Just curious about the reason behind some of these dissents.
Well, that's what we're getting, the explanations. It's become a tradition lately for Fed officials to explain as soon as the blackout lifts why they dissented, and the blackout has lifted. So we got a few minutes ago Austin Goolsbee's comments from the Chicago Fed saying basically people are telling him inflation worries them more than jobs. Goolsbee said almost all business people and consumers that we have spoken to in the district lately identify prices as the main concern. I remain optimistic that interest rates can come down a significant amount over the next year. As I have reiterated for months, my unease is about too heavily front-loading rate cuts and just assuming that inflation will be transitory. Now, just now we are getting breaking explanation from Jeffrey Schmidt from the Kansas City Fed, who also voted to hold rates steady. I continue to hear concerns about inflation. My conversations suggest we are at risk of moving away from a situation where, to quote former Chairman Alan Greenspan, inflation is so low and stable over time that it does not materially enter into the decisions of households and firms. So those are the dissenters, and we will be hearing from other Fed officials. We heard from Anna Paulson, who was not a voter this time. She's the new Philly Fed president, but she is going to be a voter next year. She says that labor market is more of a concern to her. But somebody else who has focused more on inflation, Beth Hammack of Cleveland, is also speaking in a little while, and we expect her to sound much more like Goolsbee and Schmidt. Makes it harder for anybody coming into the Fed to try to convince people to cut interest rates a lot, to have all these dissents. And we had another effort last night, or another move last night, that also would make it harder for the president to get his way. The Fed has now reconfirmed all 11 of the 12 Fed regional presidents. This happens every 5 years. Bostic from Atlanta has announced his retirement. That's why only 11 of the 12. Renewals would kind of foreclose a path to Fed control for Trump, because unless the Supreme Court says he can fire people at will, then he's not going to have a chance to replace Fed bank presidents either.
Michael McKee, thank you so much for breaking that all down. Darryl Cronk of Wells Fargo is still with us. And Darryl, I'm curious your perspective. Which do you think is the bigger concern, inflation or the labor market?
I actually think the labor market is a bigger concern. I mean, so stay with me on the timeline here. If you go back a couple years, in 23, non-farm payrolls average for the entire calendar year, 220,000 a month, right? 24, 186,000. Year-to-date 25, at least of the data we have, 151,000. I think 26 non-farm payrolls probably average somewhere between 30 and 50,000 new jobs a month, right? Which is a material shift down, right? Yes, you're not seeing, you're getting this low hire or low fire environment that everybody talks about. But I think the growth of the labor market is really hitting a stall speed kind of point. Inflation to us looks like it's hanging out here kind of in the upper twos, right? It's not coming down to the Fed's target zone, and there's going to be kind of corresponding pressures. It's interesting because, I do think you're starting to see the early signs of AI having that disinflationary push, right? Which is important because when you start throwing all that stuff in the mix, right, about what's happened with price increases and immigration and tariffs and that all should be inflationary, you have to ask the question, why is inflation not moving higher than it is?
Well, that's exactly where we want to stick on, this question of, are we seeing disinflation because people aren't getting hired? And this is what Howard Marks of Oak Tree Capital Management was warning about with the impacts of AI. Take a listen.
I'm not talking about investing or economics. I'm talking about society. And it's very worrying to me. If we can find a way to replace their income, I worry about purposelessness. And, we get so much from our jobs other than a paycheck. And you can't replace that stuff. So I worry for society.
Becky Frankowitz of staffing firm Manpower Group writing, AI is reshaping work, but not erasing it. Blue-collar demand remains stronger than white-collar, though this appears to be caution amid the evolving AI landscape rather than a long-term trend. Becky joins us now, and Becky, I'm so grateful that we get to speak with you because there is this real anxiety. You heard it there from Howard Marks. Will AI cannibalize from the labor market and leave people out of work? What's the early evidence showing?
Yeah, good morning, Lisa. We're seeing a labor market that I would say is definitely cooling. So I would agree with the gentleman from Wells Fargo. It is cooling, not collapsing. There are still pockets of growth in industries and jobs. And this widespread impact of AI that we read in the headlines is not yet realized, but we are seeing early signs.
So what are the early signs? Is it just idea of blue collar taking over for white collar? Is it the idea that companies are more reluctant to hire? Is it that productivity comes on the heels of smaller workforces?
Yeah, it's all of that, Lisa, and more. So let me give you the data as we look at real-time data. I think you asked me 4 or 5 months ago the percent of job mentions that require AI. It was about 2% at the time. That held steady until the last 3 months. It's now 5% of mentions. And you might say, well, that's not that big. That big of move in 3 months in our economy is quite large in terms of in-demand AI jobs. The second impact I would note, again, an early sign, software developers have been the number 2 job in most demand in our country since 2023. This year, it drops number 3. When you think about that echelon of job demand, to see that drop also significant. And the final piece of evidence I would say is early indication is when we see the demand for college graduates start to decline. And so the number of jobs, the percent of jobs that do not require a college degree, entry-level jobs, has jumped 36% in the last year.
I hear the sobering comments from Howard Marks about what this means for society, and it does give me pause, especially when I think about the way that the Fed chair talked about AI and productivity during the course of the press conference following the meeting this week. He's willing to engage with it, but still I think acknowledges the fact that there is so much that we don't know about the effect this is going to have on the labor market. We've talked a lot about timing in the sense of when is the construction of data centers going to lead to advances in AI, and what's that going to mean for work? How about when it comes to productivity? When you think about where we are and having a more holistic understanding of the impact this is going to have on the labor market, where are we? How much are we fumbling here with no real sense of what it's going to mean in real terms?
Yeah, so first, David, let me say I loved Howard's responses. I believe in work. It's the whole purpose of Manpower Group. We believe in meaningful and sustainable work. Work produces good societies. It produces good families. So I'm so grateful to hear someone from the capital market start talking about that. In terms of productivity, again, we are seeing the anticipation of AI. So if you ask me to step back and say, what are employers actually doing? Are they seeing the business cases? Not yet. They are stalling hiring in anticipation of what AI can do. I spend a lot of my time with CEOs and CHROs, heads of HR of companies around the world. In fact, I was with about 12 of them in the last week. And what I hear from them is the promise of productivity, but not yet the realization. But there's active work in almost every major company that I speak to understand the process changes that can be implemented to drive productivity. We're just not realizing that yet. It's anticipatory stall, not real reality stall.
Hey, Becky, great comments this morning. I'm curious, when we look at the labor market, much is made about the softness, the deterioration of the labor market. Where we do seem to see strength, at least from our standpoint, is in tech hiring, healthcare hiring, and maybe a little bit of hospitality. Are there other areas where you're seeing, so if we think about the whole labor market maybe sliding this way, but there's pockets of strength, where should people be thinking about those pockets of strength?
Yeah, so nice summary, by the way. Wells Fargo's well informed. I would say first, we're seeing for sure in healthcare, but there's a bit of nuance now in healthcare. Registered nurses, not a new topic. The new growth we're seeing, physical therapists, radiologists, there's some new pockets of growth in healthcare. Retail has been quite a surprise. Of course, we expect seasonal hiring. We have gotten that. It continues. But we're seeing frontline workers, cashiers, stockers, those are in demand. And in tech, you mentioned tech. You heard me speak to the software developer decline, but there are new jobs in tech that are up triple digits, almost 300% increase on a low base. Data scientists, people who know how to use machine learning. So we're seeing these pockets of growth, but I'll give you a surprise one. In times of transition, management is crucial. We are seeing growth in executive leadership demand. So the demand for managers and leaders who can help us transition through this time we're facing in the labor market. So those would be a couple of the pockets of growth that we're seeing.
Just quickly, Becky, how much are you starting to see entry-level work start to pick up as well? Because that's been a big concern.
Yeah, so I'm very concerned about college grads because we are seeing decline in the need for a degree in terms of demand. Entry-level work, it depends on the industry, Lisa. We're definitely seeing in food service 8 of the top 10 hirers in our country today are food service or retail. So there are definitely on-ramps for those industries, and they are not requiring college degrees.
Becky Frankowitz of Manpower Group, thank you so much for being with us and for that gut check. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Vonnie Quinn. Vonnie.
Lisa, thank you. NVIDIA shares rising in the pre-market amid reports that the chip giant is ramping up production of its H200 AI chips. Reuters is reporting that consideration comes from strong demand from Chinese clients after the sale of the chips was signed off upon by officials in both the US and China. Orders for the chips from China have exceeded NVIDIA's current output level, requiring the company to increase capacity. Uber is saying it expects to offer robo-taxi services in more than 10 markets by the end of next year. CEO Dara Khosrowshahi is telling Bloomberg News possible new markets include Hong Kong and Japan. Earlier this year, Uber and Baidu announced plans to launch robo-taxis on the ride-sharing platform in several markets outside the US and mainland China. The Education Department has added a, quote, earnings indicator to the free application for federal student aid. That will indicate any school where the average earnings of its graduates fall behind average earnings of high school graduates. Around 23% of colleges in the federal database classify as low earnings. And that is your Bloomberg Brief. Lisa.
Vonnie, thank you so much. And thank you for everything this morning. Daryl Cronk of Wells Fargo, thank you so much for being with us this morning. Always wonderful to get your thoughts.
Thank you.
Have a wonderful weekend. Up next, setting you up for the day ahead, plus former House Majority Leader Eric Cantor on the Fed's path ahead for interest rates. This is Bloomberg Surveillance.
Wherever news and ideas meet, wherever earnings reports and saved orders intersect, the all-new Fidelity Trader Plus is there. giving you the freedom to trade how you want with your preferred tools, customized charts, and streaming data. So you can start a trade idea on one device and execute it on another. Meet our most powerful, consistent trading platform yet. Meet Fidelity Trader Plus.
You can't control the course or the competition, but you can control what you do next. Tiger Woods built his career on the ability to reset, adapt, and make the next shot count. Insperity is built to help businesses do the same. You deserve an HR partner that's there to help you thrive, no matter what comes your way. Insperity, because how you HR matters.
Premium benefits anywhere you go. Unlimited, zero trading fees. 6% back in crypto. And other exclusive benefits with Level Up. Take your wealth to the next level.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
There's still questions surrounding, the big tech, the AI story, but you're seeing the equal weight S&P 500 do better, Russell 2000. I think it's helpful that the Fed is buying some T-bills up to $40 billion a month. So you're seeing all that. There's a lot more questions around the AI data center, but as rates are coming down, I think we're going to get rate cuts faster than the market's pricing. That should be really good for small caps and the broad economy.
That was Peter Shear of Academy Securities. As small caps continue to outperform, it's what we're seeing this morning. You are seeing the broader indices lower ahead of the open, down just about 0.1% on the S&P. You are seeing that bond sell-off continue on the long end, even though that front end has been pegged 4.18%. And you do see silver surging to new all-time highs, less than an hour away from the cash open. Here are your morning movers with Yahaira Anand. Yahaira.
Hi, Lisa. Broadcom's results had all the makings of a strong quarter with an earnings beat and a dividend boost, yet shares are falling more than 5.5% in the pre-market after its $73 billion AI backlog for the next 18 months fell short of the most bullish expectations on the street. CEO Hock Tan tried to soothe investors, calling it the minimum, yet it was not enough. Meanwhile, with social media driving this mindset that you can't wear the same thing twice because of photos, people are flocking to rent the runway. Shares are surging 25% after the company handily beat earnings estimates and said that it is sticking to its guidance for double-digit subscriber growth this year. And we end on Lululemon. Shares are rising more than 10.5% now in the pre-market. The company saying its CEO Calvin McDonald will step down at the end of January after more than a year of underperformance. And we heard from Chip Wilson, the founder, in the last hour, who's one of the company's biggest shareholders. He slammed the board for letting value slip under McDonald's, and now he wants the CEO search to be led by fresh, independent directors. Lisa?
Thank you. Thank you so much, Yahira, and have a wonderful weekend. Meanwhile, stocks just hovering near those all-time highs heading into the opening bell as investors set their sights on growth possibilities in 2026. Former House Majority Leader Eric Cantor joins us now, currently of Moelis. And I want to start on the economy and all of these deals that we see going on. I mean, is this just an incredibly robust deals pipeline on the heels of a benign economy and wide open capital markets?
Yeah, Lisa, I think you're right. I mean, I know at Moelis, our bankers are really busy as we come into the very end of the year running through the tape. And so there's a lot of dialogue. We're in the business of advising on transactions. Transactions are a tool for companies to accelerate growth, to figure out how to better position, to gain efficiencies. And as you say, there are accommodative capital markets right now, too. And so we are seeing just a lot of dialogue, a lot of activity, and I think a general optimism as we come to the new year.
What's interesting is in markets right now, you're seeing a bit of skepticism, pushback. Broadcom, perfect example of that. We also saw that with Oracle. Debt investors are saying you need to pay up a little bit more. As vice chair of Moelis, are you seeing that pushback in any way, shape, or form, or are deals just coming out of the woodwork in ways that keep even your associates really busy?
Well, I think if you look at the strategic sort of universe, I mean, they are and have always had a list of where they're heading in terms of targets and the kind of deals they want to do. And certainly in the sponsor world, there are other sort of forces at work, the need to recycle capital, assets that may need to go into a continuation fund. I mean, there are all types of different tools available for clients, investors, sponsors, strategics. And as you say, I think overall, the framework and the environment is more constructive now. Certainly Washington, when people look to the regulatory impact, we have sort of come out from under this very, very negative regulatory outlook that we had in the prior administration.
Talk a bit more about that. So when you're talking to executives about that regulatory environment, how would you describe it? I mean, we see some of these agencies where there's not a full panoply of commissioners, for instance. We heard it from the Treasury Secretary. There's going to be some new corporate tax policies coming here into effect in the coming weeks. How much of it is still inchoate or clear for you at this point of where it's headed regulatorily?
I think with this president and this administration, I think there is just sort of an acceptance that you're never really going to know for certain anything because of the way that, the rapidity that things are about in Washington, the way that President Trump sort of approaches the power he's got and the position. Very unique. But I think on the whole, it's a much more constructive regulatory environment. And you just don't have this overhang that you had in the prior Biden administration where, there was really an anti-business sentiment. And if you just remember, it's like eons ago, but with the likes of Lena Khan and Jonathan Cantor, they were sitting in these spots in the head of the antitrust regulators, and they really definitionally said, if you are bigger, that is bad, and therefore we're not really inclined to allow you to do it. Whereas this administration, it's not like it was under the Bush administration, but it's certainly much more constructive and they like to do deals.
As you've watched that parade of executives going through the Oval Office, some of whom are giving up equity stakes to the U.S. government, what are you thinking as a lifelong Republican, this kind of new breed of Trump Republicanism that involves, again, it's not dirigism, but it's sort of like the state is having a heavier hand in the way that these companies are being run.
David, I still remain a limited government, free market, Republican and conservative. So it's obviously something very new to me to see that the government wants to take a stake in a business and or a toll if it's an export. That is something that is obviously, and I think for the majority of the members that are in the Congress now, it is something that's very new. But I do think it's much more in keeping with what President Trump is about and what his career's been about. It's all about deal making. And I think if you look at sort of the Intel situation and what happened there, it was more of a response to the disdain that the White House had for the CHIPS Act and just giving away monies and instead say, hey, we need to do something for the taxpayers. Now, where I have an issue is the governance rights. That is, it's not as if the federal government has not stepped in before. I mean, you and I were down there when the great financial crisis happened and a lot of bailouts. You look at the airline industry, you look at the GSEs. I mean, there's a lot of history, but the difference, before, there was always sort of a path and a known path to an exit. That's right. And now not so clear.
Well, this is sort of the concern, is that right now, if you're putting an emphasis on deal making, deregulation, and potentially jawboning the Fed to cut rates more aggressively at a time that the economy is still chugging along, at what point are you setting up the risk of that kind of scenario once again in 2027 or 2028?
Well, listen, I think this president has been very consistent in his message of growth, and he wants growth, and that is the way, and that is where sort of the more traditional sort of conservative Republican can come along with the agenda, because we've always been about real growth comes from the private sector. And if you look at where the administration has been taking stakes, it's really in these industries that are critical to the national security. It is about AI related. It is about the rare earths minerals. It is all about how do we go and continue to take the lead in these critical sectors vis-a-vis China and other bad actors.
How do you think this administration has done with respect to messaging around affordability? This is something that has been dogging the administration quite a bit. Now we're talking about dolls and Christmas presents, but there's this issue of people aren't feeling great, even though the economy is chugging around. What do you think? What do you think the Congress should be doing? How do you think the president should be messaging this?
Well, you know, it's interesting. After the off-year elections, one of which was in my state of Virginia, and the party didn't fare well, the president was fairly nimble, and 10 days later turning around and taking the steps he did in lifting the tariffs on 200 food items, and which directly impact people when they go into the grocery store to look to prepare for the holiday meals, including not just the things that we don't grow here, but like beef, right, and Brazilian beef. And there's a real inflationary pressure in the beef industry in this country, and I think the administration took the steps necessary to provide the relief. So I think you're going to see a lot more accommodation in terms of that as we head into the new year. And look, the president's also, this is something also very novel, David, back to your original point about the kinds of things this administration's doing. He's talking about a dividend from the tariffs. I mean, but that is something directly related to the issue, Lisa, that you bring up, and that is, how is a president supposed to bring down prices when we're in a free market?
Don't have a whole lot of time left, but I want to ask you about the prospect of the fiscal stimulus in the new year from the tax bill. I mean, the president talks about it so much, maybe he hasn't been focused enough sort of on the potential benefits of that for ordinary Americans. How do you see that playing out in the year ahead?
Look, what's going on with AI and with CapEx necessary to bring about this infrastructure, not just in the data center piece and all that, but on the power end of things. I mean, there is a tremendous tailwind we're going to experience from the ability to completely, write off the expense up front. So I do think, and I think most economists will say, there will be an uptick in terms of what that will do to increase people's willingness to go and put capital to work.
Vice Chair Eric Cantor of Moelis & Company, also the former House Majority Leader. Thank you so much for being with us this morning.
Happy holidays.
Have a wonderful weekend and happy holidays. Coming up on Monday, Cameron Dawson of New Edge Wealth, Sarah Hunt of Alpine Saxon Woods, Russ Kosterick of BlackRock, and Keith Lerner of Truist. A real focus on the data, David, next week.
Yes, looking ahead to those jobs data. I think highly anticipated. We'll see sort of how that changes our read of what happened at the Fed meeting this week.
Exactly. Is good news good news? Is bad news good news? How are we going to message a Fed rate cut that might come on the heels of some softness in the labor market? Right now, what you are seeing in markets is just a touch of softness after reaching all-time highs. Again, you can't keep a good market down. Look at that. We're almost to positive territory, and we are seeing yields climb on the long end, 4.18%. That does it for us. Have a wonderful weekend. This was Bloomberg Surveillance.
All-new Fidelity Trader Plus with your preferred tools, customized charts, and streaming data, so you can start a trade idea on one device and execute it on another. Meet our most powerful trading platform yet, Fidelity Trader Plus.
You can't control the course or the competition, but you can control what you do next. Tiger Woods built his career on the ability to reset, adapt, and make the next shot count. Insperity is built to help businesses do the same. You deserve an HR partner that's there to help you thrive, no matter what comes your way. Insperity, because how you HR matters.
Premium benefits anywhere you go. Unlimited zero trading fees. 6% back in crypto. And other exclusive benefits with Level Up. Take your wealth to the next level.
Dividends from time to time.
Yeah, companies do suspend the dividend, but it creates fear, uncertainty, doubt in our preferred shareholders, which will impact our convertible shareholders, which will impact our equity shareholders. So I think preserving the payment of the dividend, even if our board has the rights to suspend it, it's the right thing for the short term, for the next 1, 2, 3 years, and it's important. It's also important for the Bitcoin asset class, and we realize we play a role bigger than just strategy in the Bitcoin world.
So would you say investors should think you will never suspend that dividend?
Never say never, but yeah, our objective is to pay the dividend into perpetuity.
Don't miss Bloomberg Crypto, live Tuesdays. Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Caroline Conan in Paris, and this is Bloomberg.
We had an all-new record closing high yesterday. 30 minutes till the start of the cash trade today. I'm Matt Miller. Danny Berger is on assignment. Open interest starts right now. Coming up, a Santa Claus rally tries to take hold as global stocks eye records and the U.S. market sets its first all-time high in 6 weeks, as judged by the S&P. But caution in the tech sector remains as Broadcom falls short of lofty AI revenue expectations and a plan to water down UBS capital demands, or Swiss capital demands on UBS, sends those bank shares to a 17-year high. We're going to focus in on what's going on there. Stocks to watch today include Broadcom. As I said, it is down after its sales outlook for the AI market failed to meet heavy expectations. We have the shares right now down about 5.5%. It has a backlog of AI orders totaling only, I guess, $73 billion over the next 6 quarters. Lululemon is actually higher in the pre-market as it sees solid holiday demand and announced CEO Calvin McDonald will step down in January. That's probably more important to shareholders and why we see the stock up 10%, because they see a reset now as possible. Let's start off, though, with Broadcom and the AI trade. Bloomberg Tech Co.'s Ed Ludlow joins us from San Francisco. And Ed, it's interesting. On the one hand, you know, the market is concerned about CapEx that's just exploding. On the other hand, they want to see the backlog and revenues at Broadcom higher.
The market always wants more, and it's more a piece of tangible, forward-looking data. So Broadcom offers custom chips. In the context of what's happening in AI and data centers, they are the IP and engineering partner on Google's TPU, for example. This figure, $73 billion AI-specific backlog, is over the next 6 quarters. And the narrative from the company to its investors was, this is a minimum number. But what the street was quite clearly looking for was the next step of that, which is we're very used to backlogs in the chip industry. Tell us in the next next calendar year how much revenue you're actually going to get through, how much revenue you're actually going to book through that backlog. And it just wasn't enough. The stock down almost 6% in pre, but I think, we make the obvious point, Matt, that this is a stock that's up almost 75% year to date going into it. And that's an important factor.
Ed, we also have news that China is going to put about $70 billion worth of stimulus into its own chip development. Is that a big number? Because it does, not yet meet the CapEx of some of our individual megascalers for the year.
Yeah, that's certainly probably the right way to look at it. 70 billion as a basic minimum example is far beyond what the CHIPS Act provided for in terms of government backed funds for the chip sector in this country. China already has some vehicles and investment funds that are specifically semiconductor related. And what I would say is, based on our reporting, $70 billion seems to be like an upper bound. Where they settle, it could be less than that, it could be near to it or more than that. The assumption is that it's Huawei and Cambricon that will benefit from these funds. But really, there's a lot we don't know. We don't know specifically which companies China hopes to support most, and sort of what the mechanism is here. Is this literally to support R&D, or, as has been the case in America, a great infrastructure build-out or capacity build-out? Those are two different things, right?
Ed, I look forward to your program today because there's a lot, as usual, for you to talk about. Bloomberg Tech co-host Ed Ludlow talking to us about Broadcom and what we see in terms of Chinese stimulus. Lululemon shares climbing after that company boosted its full-year EPS guidance on strong holiday demand, but maybe more importantly, Calvin McDonald, the CEO, will step down in January. Romaine Bostick, co-host of The Close, whom I would bet has never worn yoga pants, joins us now.
You would actually be wrong, believe it or not.
Oh, no.
Yeah, I went through a phase, let's just say.
All right, let's experimenting in college, I guess.
Sure.
Let's talk about why the reset is so important to investors. I mean, this stock is up 10% on the CEO exit.
Yeah, this is actually going to be one of the best days for the stock in months, probably going back to April. But just to put it into perspective, Chip McDonald took over in 2018, and he actually did a pretty phenomenal job in the early days. He took this from a company with less than $3 billion in annual sales to one with almost triple that today. The stock price soared like 50%. The problem is this company kind of peaked back in 2023. The stock is down 63% since then. Sales growth has basically been stagnant to down. In fact, they had double-digit comp sales growth pretty much through most of his tenure, but the last 7 quarters have all been in the single digits, Matt, and more importantly, not just in the single digits, but no real signs of improvement, despite some of the numbers that we got last night.
We actually were talking with Stephen Yalof of Tanger, and Danny was like, I guess Lululemon's not so hot because they have these really high-end competitors, not Nike and Under Armour, but like expensive stuff, right?
Yeah.
And Yalof said, no, they're actually doing great.
Well, I think analysts would disagree, and several analysts have already basically put a lot of pressure.
At his outlet stores, let's be clear, at the outlet stores, yeah.
But this has been part of the problem. You remember Lululemon was always, at least in the early days, considered a very high-end, premium type of brand, and there's been a lot of criticism that McDonald's maybe took it down a little bit too pedestrian. They created partnerships with Disney, putting Mickey Mouse logos on pants, putting NFL logos on some of the products as well, and a lot of people thought this was taking a little bit of the cachet out, and particularly at a time where you had sort of the Fiore and Alu and all these brands come in that sort of have now the same cachet that Lululemon once had maybe 10 years ago. And of course, Chip Wilson, the founder, who still is the largest individual shareholder, he has been just vicious. If you ever want to have some fun, go through his LinkedIn account. He's basically spent the last couple years just trolling management.
Dude, by the way, unrelated, I wonder what you think about using NFL logos, because for years, Breitling has been doing this, and it always seems to me that maybe it cheapens the brand a little bit, but obviously the NFL has such big cachet in America.
But that's the concern. But does it broaden out your reach? Sure, but at the same time, it also brings in a different customer that maybe doesn't want to necessarily pay, $100+. The other issue too is they've had a lot of issues with regards to just fashion. McDonald just recently finally hired a new creative director, but he's not going to really have time to bring that person in. But also remember, they had a couple missteps. Remember last year they had those breeze-through leggings that were apparently a little too breezy. And so a lot of women just decided they didn't want to wear them. They had the other one with the little V-shaped seam that was unfortunately very misplaced. So there were some huge missteps that they took on the fashion side that whoever the new CEO is, they're going to have to find a way to address. And we should point out, they do not have a new CEO.
All right, Romain, great wrap up. Look forward to your program today. Romain Bostic anchors the close, and he presided over an all-new record high yesterday on the S&P 500, more than 6,900, I believe, at the close, 6,901. Let's turn to the broader market because U.S. stocks, this morning they're drifting lower, but we are at such lofty heights. European equities are also hovering near all-time records. Strategists are betting on further gains before the year ends. Karen Georges of EcoFi Investments writes, quote, everyone is convincing themselves that there will be a Christmas rally, so it looks like there will be one, and to be honest, there's no negative catalyst visible until the end of the year. Joining us now is JP Barnard, Bloomberg Senior Market Strategist out of Frankfurt. So, JP, it does look like even though, as you know, Romain was on yesterday, they hit a record high again on the S&P, and of course the President of the United States has been touting the Dow Jones Industrial Average. We could continue to climb into the holiday.
Yeah, absolutely. I mean, and I'm totally with that statement that there is no negative catalyst or no obvious negative catalyst on the horizon right now. Right now, we have moved through the Fed issue and kind of a little bit of the macro data. I mean, there's still more to come, but it looks all right. And what you're seeing with like stocks is that they take this to the heart. And I mean, the AI trade is still on pause for now for good reasons. But we're seeing a cyclical rotation, and stocks are really like embracing the idea of like there is no danger on the horizon right now. The economy is doing fine. The job market is doing fine. The Fed gave us kind of what we wanted, and from there, like I mean, like seasonality is on your side, and so I guess from next week on, it could well be that we get that center rally as we have seen so often before.
JP, I don't know how much you're focused on the concentration risk. You know, in Europe, it's not the same thing that we have here in the U.S., but has there been a broadening out? It seems that big investors that we talk to have differing opinions on this.
Well, I guess it depends on how you want to look at and what's your starting point. Of course, I mean, like we still have a big concentration, and that's probably not going to go away unless, like, I don't know, Apple and all the Magnificent Seven will be cut in half, and that's not going to happen. I like to predict, but what we are seeing is that the market is like not so keen anymore to jump on everything that has AI on it, and that of course like automatically removes a little bit of the concentration. I mean, that trade is still big, and it's going to be big in 2026 for sure, but. The thing is like that the market is now a little bit more focused, asks more nuanced questions, is focusing on like, okay, where does this trade actually make sense? Who is going to be the best bet on it? Who is going to make the best money? Who is fastest to implement all the AI ideas that are floating around? And I guess like we are not going to see that pure let's buy NVIDIA all the way up just because of we like it, but people are going to be a bit more nuanced going forward, and I guess that's automatically going to have a market that is more broad and that's not so one-sided as we have seen, quite frankly, over the last 3 years, actually.
JP, you know, American investors eyeing European outperformance with a little bit of envy. I mean, the DAX, where you're sitting, is up 23%. Here in the U.S., the S&P is only up 17%. But if you're a dollar investor, you're up 38% in Germany. You're up 46% on the IBEX in euros, 66% in dollars. Is that kind of outperformance set to repeat itself in 2026?
Probably, I guess so, because like the question is like when the Fed is really like moving with interest rates in one direction and the whole world is moving in the other direction, kind of, or at least hold steady, then this needs some wealth to explore itself into the market, and that usually is then the foreign currency market and the dollar. So I guess like most people are, or the consensus is that the dollar is probably going to have a hard time to really perform, and that means like it's going to be a better place for all the assets outside of the U.S. Will that lead to like an outperformance that we have seen this year? I'm not so sure about it because, like, I mean, Europe also, that's why I was shaking my head a little bit. It also has kind of a concentration problem a little bit. And we have seen like trades like defense doing really, really well. So Europe has to prove that it really has its place to be. But I guess like overall for investors, diversification is something that they want to have going forward the next 12 months. And that should usually help like all the markets outside of the US.
Yeah, I mean, the banks are a standout example. In Spain, you're up 66% in 1 year, but it's mostly the banks that are driving that. We're going to talk about that on the other side of this block. JP, thank you so much for joining us this morning out of Deutschland. Quick check on what's going on in futures here in New York. We're looking at really on the S&P, but we hit over 6,900 yesterday at the close. NASDAQ futures down about 0.4% as that AI trade comes into question again. Looking at some of the other movers on our radar this morning, Costco profits topped expectations as price-sensitive shoppers search for value. That place has been packed in Yonkers, I can say for sure. Restoration Hardware reported higher growth than rivals as the industry contends with tariffs and a sluggish housing market, but rich people still buy expensive furniture. And pot stocks jump on news that President Trump is expected to direct his administration to reclassify Mary J as a less dangerous drug. Tilray also announced a new product line. Coming up, UBS jumping this morning as Swiss lawmakers pitch a watered-down version of proposed capital requirements. We'll talk about one of the most important bank employers in the world. This is Bloomberg Open Interest.
Meet the all-new Fidelity Trader Plus with your preferred tools, customized charts, and streaming data, so you can start a trade idea on one device and execute it on another. Meet our most powerful trading platform yet, Fidelity Trader Plus.
Tiger Woods built his career on forward thinking, staying ahead of the curve and away from the expected. Insperity believes that in business, it's no different. They're dedicated to driving your business forward, providing the HR support you need to innovate and win. You don't become one of the greats by doing things the same as everyone else. You take a swing, knowing you've got the right partner by your side. Insperity, because how you HR matters.
Premium benefits anywhere you go. Unlimited, zero trading fees. 6% back in crypto. And other exclusive benefits with Level Up. Take your wealth to the next level.
Signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Let's get out of high interest and look at what's making headlines around the world. President Trump is moving to shift marijuana into a less dangerous drug category, reclassifying it from the strict Schedule 1 category to a Schedule 3. The move signals a major shift in federal drug policy. Reclassification would make it easier to buy and sell cannabis and could ease tax burdens and some obstacles for companies and investors in the sector, but they still wouldn't be able to bank. You can see, well, you saw there, they were all up. Here they are again. For students filling out financial aid forms, also probably concerned about the legality of marijuana, some colleges might now come with a warning. The Education Department is adding a new earnings indicator to the FAFSA. When students file, some colleges will now show a red flag if their graduates earn less than other high school grads, with the cost of attending college reaching $100,000 a year in some places. More people are questioning the value of that higher education. And UBS shares are hitting a 17-year high after a group of influential Swiss lawmakers proposed watering down the capital requirements for the bank. The proposal would allow UBS to use junior debt, so-called AT1 bonds, instead of equity to meet the capital requirements. And to talk about this, I want to bring in our chief Wall Street correspondent, Sridhar Natarajan, joining me over here at the desk. Sri, this is an important story on so many levels, especially for our viewers and clients. But first of all, it means UBS probably won't move to New York, right?
So the lesson from that is perhaps playing hardball works. And we should remind our listeners and viewers as to why we're even talking about UBS in New York. Not that it has ever been floated as a serious proposal, but in the last few weeks and months, there has been a lot of murmurs and rumors and talks about UBS, senior ranking UBS executives talking to US officials, potentially relocating their headquarters out of Switzerland, which would be a big hit for Switzerland because UBS is the last remaining globally significant bank in the country, a country that is built on its banking system. What we have today is a group of influential Swiss lawmakers trying to find a compromise. And you know, the details, there are some details here, but the details at this stage truly are not relevant because these will still be debated a year and a half down the line. We're talking about debates in 2027. But the idea is to make sure that they get to the negotiating table because up until now, the Swiss government was taking a very hardline stance, which would have meant that UBS would have had to set aside $26 billion in additional capital to meet their demands for a safer banking system. And UBS had been saying that would simply not be acceptable because it would make them uncompetitive.
By the way, UBS shares apparently rise to a 17-year high, and they have returned, well, they've tripled in the past 5 years, but they're not doing as well as Goldman Sachs over that period, not doing as well as Deutsche Bank over that period, not doing as well as HSBC, and I haven't even looked at the Spanish banks, which are killing it. What's going on with this insane bank rally, like all across the globe?
Well, you know what's happened this year is we've finally seen a big return in deal-making activity. You've seen that even as this has happened and people are worried about where the economy is headed, could there be a turn in the economy? When you look at the actual underlying numbers right now, the biggest banks are not that concerned. They're talking about a resilient economy. Their consumer banking operations are doing fine. And when you talk about the investment banking side of things, when you have so many deals in the pipelines, major deals, there is a flow-through effect into other parts of that investment banking business. It's not just fees from advising on the biggest deal. It's raising debts, it's issuing equity. And there is also obvious trading activity that you will get from all of this business that the investment bankers are bringing in. So right now, it is a good time to be a major bank that is globally significant.
Especially in Spain. I just looked up Santander. In the same period, over 5 years, they've returned, with reinvested dividends, 353%. Is there a bubble in bank stocks? Are we worried about the wrong bubble here?
Wow, we're now trying to find bubbles everywhere. Look, when you think about what has happened in some of the more exuberant parts of the market, it is very hard to look at the banking sector and talk about bubbles. And let's bring back the conversation to why we're even talking about the banks today. It's the strict capital demands. And there is this sense that in the last 15 years, regulators have acted in a way that has made the banking system safer. And that's why in the last year or two, more of the conversation is about what is happening in the non-banking system. And are there enough eyes on it? And are there enough guardrails placed out there? So not saying that nothing could possibly go wrong with banks, but on the surface, there's no obvious sign that banks are in some sort of bubble territory.
I just put a smattering of the big ones here, and you can see JP Morgan is the worst performer among all of these big banks. If you can decipher the tickers, those are UBS, JP Morgan, Goldman Sachs, Deutsche Bank, HSBC, and Santander. Sri, great talking to you. It's a really important story for investors right now, and especially also for employees of UBS. Sridhar Natarajan covers global Wall Street for us. Check on futures ahead of the bell after a bang-up session yesterday. We're looking at a lackluster session coming into the start of this Friday, at least for S&P futures, really not moving there. You do see NASDAQ futures falling. When we come back, we'll talk with, or about, I should say, the expected Santa Claus rally, maybe that we're already seeing with Ulrika Hoffman-Burchardi of UBS Global Wealth Management. This is Bloomberg Open Interest.
Wherever news and ideas meet, wherever earnings reports and saved orders intersect, the all-new Fidelity Trader Plus is there, giving you the freedom to trade how you want with your preferred tools, customized charts, and streaming data. So you can start a trade idea on one device and execute it on another. Meet our most powerful, consistent trading platform yet. Meet Fidelity Trader Plus.
You can't control the course or the competition, but you can control what you do next. Tiger Woods built his career on the ability to reset, adapt, and make the next shot count. Insperity is built to help businesses do the same. You deserve an HR partner that's there to help you thrive, no matter what comes your way. Insperity, because how you HR matters.
Premium benefits anywhere you go. Unlimited, zero trading fees. 6% back in crypto. And other exclusive benefits with Level Up. Take your wealth to the next level.
Goldman Sachs is the latest to boost its S&P 500 forecast. Strategists there see the benchmark hitting 7,600 in 2026, a nearly 10% upside from Thursday's record close. Those analysts cited AI adoption across industries, fewer tariff headwinds, and productivity gains. Let's bring in Ulrika Hoffman-Burchardi, CIO for the Americas and Global Head of Equities at UBS Global Wealth Management, which is obviously a very large wealth management. AUM must be tremendous. Business must be crushing it, especially with this new record, not just here, but around the world. Mm-hmm. Do you see us continuing higher from here?
Yeah, we actually think that this week is a little bit of an early read onto the two dynamics we think are going to shape 2026. One is supportive policy, and then an AI story that is now pivoting from CapEx to cash flow. And I think both of these dynamics support a broadening equity market, but also a higher equity market into next year.
Is the AI bubble concern not one that you share?
I think whether it's an AI bubble or whether valuations in those stocks are high, for me, is largely definitional. The question really is about fundamentals. Valuations are never a cause for a stock market correction. It's just they show you the amplitude of a potential correction if fundamentals disappoint. If we go back even to the 99, the heydays of the internet, we saw NASDAQ valuations peak in December 98. And yet the NASDAQ increased by another 100% after. So again, you need fundamentals to change. In 2000, there was the loosened profit warning. It was the Fed hiking rates. And it was also dot-com companies running out of cash. And I think none of these conditions are here right now.
All right, I'm going to save the banks question because I have viewers writing in saying, hey, can this rally in European bank stocks last? U.S. bank stocks have done very well as well, and it's, I think, a big part of maybe future growth. I'll ask you. Ulrika Hoffman-Borchardi is staying with us. Check on futures ahead of the opening bell. On the S&P, not a lot going on, but on the NASDAQ, because of Broadcom earnings, because of China stimulus, we're looking at a drop in futures of about 0.5% on this Friday morning. This is Bloomberg Open Interest.
What happened? Some bad people tried to hack me with sad affirmations.
Sad, Craig?
No. We're protected.
AT&T Dynamic Defense helped protect us because small businesses need us.
So he's not sad. Guess we don't need these.
I think we do.
Wherever news and ideas meet, wherever earnings reports and saved orders intersect, the all-new Fidelity Trader Plus is there, giving you the freedom to trade how you want with your preferred tools, customized charts, and streaming data. So you can start a trade idea on one device and execute it on another. Meet our most powerful, consistent trading platform yet. Meet Fidelity Trader Plus.
Premium benefits anywhere you go. Unlimited, zero trading fees. 6% back in crypto. And other exclusive benefits with Level Up. Take your wealth to the next level.
What seems to be the problem, soldier?
The belly, sir, is full of Greeks. Innovation changes everything.
Send it back!
One ETF, 100 innovators rethinking the world. Before investing carefully, read and consider fund investment objectives, risks, charges, expenses, and more in prospectus at Invesco.com.
Build a couple more, maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Bringing you up-to-the-minute geoeconomic news whenever and wherever it happens. I'm Bonnie Quinn in Sao Paulo, Brazil, and this is Bloomberg.
We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what's going on. Really, NASDAQ futures are where you want to pay most attention because we're seeing the biggest move there, down 0.6%. S&P futures are down a little bit, but you know, we had all new record highs on the big benchmark indexes. The S&P 500 closed over 6,900 yesterday, and so a loss of 0.2%, maybe not a huge deal. Chipotle, which has had a very tough time ringing the opening bell at the New York Stock Exchange, CMG, the ticker there, and it's really a huge part of the whole K-shaped economy narrative and whether or not you still want, I think they call them slush bowls, or someone in the control room, slop bowls, whether you're still into that or now you want a handheld sandwich again. We have Wealthfront ringing the opening bell at the NASDAQ marketplace, which is is very cool because the CEO is going to come and join us in a little bit. And this is at least one of the companies that has really changed the money market industry, an irreversible shift for younger generations that are using it basically as a checking account these days, and just looking at more than $8 trillion now in money market funds. In terms of stocks to watch, Broadcom is one of the big weights on the NASDAQ. It'll be a big weight on the S&P as well, as this company has gotten ever bigger and done ever better. But now investors say not good enough when it comes out with its outlook for AI. The backlog was 73 billion. That's over 6 quarters. They said that's at the minimum, but investors want to see more. Lululemon is higher as it sees solid holiday demand. We heard that from Stephen Yaloff at Tanger, although that's an outlet store, and maybe that's part of the problem. The CEO, Calvin McDonald, is going to step down in January. Investors may be worried he's brought it a little bit too mainstream, and they want to see a reset. So the shares are up 12, almost 13% in the early trade. And we're back with Ulrika Hoffman-Burchardi of UBS Global Wealth Management. Ulrika, I wanted to talk to you about bank stocks. It's been a focus of ours the last couple days because they've outperformed by so much in Europe. They've done very well here in the U.S. as well. And how much of that is part of, the broadening out trade? It's not just these 7 hyperscalers or top 10 stocks that you want to buy, but you're getting into other things like finance.
Yeah, when we look at the macro, maybe just to step back, then we see this dual engine of both monetary and fiscal policy that's now coming together. We saw the Fed, of course, lowering rates by 25 basis points again. Not only that, but also adding liquidity by buying T-bills. And then we have the fiscal stimulus that in particular is going to apply for the first part of next year with the tax refunds, helping the consumer, but also the delayed spending from the government shutdown. So all cyclically very positive conditions for financials. And then you have on top of that more room for deregulation. You have also increased capital markets activity that we think is going to happen next year. So we like financials as a sector together with technology, but then also increasingly healthcare as a diversifier to both of these.
So you really do see a broadening out. It's not just these, top 10 biggest companies that are growing earnings at a double-digit clip. What do you expect from earnings for the whole market in 26?
For the whole market in 26, so first of all, our price target is 7,700, 305 earnings, and probably a broader distribution of earnings within the other sectors. Again, in particular, we think the AI trade may be broadening out within technology, but also across other sectors. We have seen this week 2 more data points where just CapEx or just backlog in orders for AI infrastructure are no longer sufficient to drive stock prices higher. So we think actually the value may now increasingly accrue in the application layer of AI. So those companies that are using AI to actually drive margins and increase cash flows. And we think financials and also healthcare both actually have the potential to use AI with their very unique and proprietary data sets.
In financials and healthcare, we hear a lot of optimism there. In software, there's so much pessimism. That AI is, Howard Marks was out with a note a couple days ago saying that AI is going to replace software engineer or coders' jobs. I actually heard an interesting anecdote from Reid Hoffman yesterday. He was speaking at the Economic Club of New York. He said, he thought radiologists were all going to lose their jobs because AI was so good at detecting cancers in screens. But it turns out that screenings just shot up like exponentially. So now we have an undersupply of radiologists. How do you think it's going to fall in terms of job killer versus production driver?
I mean, what we do see right now in the labor market, right, at least anecdotally, that the parts of the labor market that are weak are also the parts where actually AI captures most value. So software engineering, right, technology is relatively weak when it comes to the labor market. Then we also see areas of marketing, customer service being weak. So we don't have a full empirical study yet, but I think anecdotally there seems to be some correlation. And actually that for us makes us more skeptical on the labor market going forward, maybe similar also to Fed Chair Powell's comment that we think the labor market may remain sluggish and the Fed actually may cut, we think, at least 1 more time in the first quarter, whereas the economy could potentially even accelerate in this environment. So a pretty unique setup if you think about it, and something that is, of course, very benign for the equity markets.
Is inflation a concern for you? We're going to talk to my editor-in-chief emeritus, Matt Winkler, at the end of this program. He has an op-ed out saying, look, the average consumer in America is paying an extra $1,000 at least because of tariff effects. Is that a concern for you, especially with a Fed that's cutting rates?
We don't think so. We actually think there are three disinflationary forces next year. First of all, we're going to anniversary the tariffs right in April. Then we also see the labor market still being weak, so wage inflation coming down. And then shelter inflation, of course, always has a lag, so that's still coming down. And even if the economy starts to accelerate again, shelter inflation could still stay low because of its lag. And then we see still wage inflation coming down because of potential AI replacement. So for us, that makes us actually on the inflation side relatively optimistic that inflation is staying contained. And also that gives, of course, the Fed more room to cut.
What do you think about the U.S. versus other markets? I was talking with J.P. Barnard, our reporter in Frankfurt earlier, about the incredible outperformance that we've seen, even if you take out the currency effects in Europe versus the U.S. Our investors are, the high net worth individuals that put their money with you, really still interested in broadening out and diversifying further?
No, I think this is a theme that we are continuing to watch. We do think because the U.S. economy, the largest economy in the world, is still very strong in economic growth, poised to accelerate next year, that will also be a good backdrop for global economic growth. And of course, we also see stimulus coming out of Europe. So we are broadly positive, not just in the U.S., but also in Europe and parts of Asia.
What are the big risks, Ulrike? I hate to ask you, this is my last question, getting ready for Christmas, what are the things that keep you up at night?
So with valuation being as high as they are, I think there has to be more scrutiny on the risks. And typically the risks, in my view, lie where the capital is most extended, and that is AI, and it is also government debt to a large extent. So we watch those areas carefully. On AI in particular, we don't see any immediate warning signs. AI adoption is trending higher. AI spending plans are still there. But there are, of course, risks with this amount of CapEx that we're seeing. And then on the government side, of course, we have record deficit levels. We have record debt to GDP ratios. But again, if we look at the macro conditions that are most helpful in this environment, which is elevated but contained inflation, rates that are benign, and then economic growth, those are the conditions that historically at least have helped to contain the budget deficit.
Will rates stay benign? Are these spreads going to stay so tight?
For the time being, we think so.
All right, great having you in here. Really appreciate you joining us on set. Ulrike Hoffman-Burchardi there from UBS Global Wealth. Let's get a look at what's going on in the market. Almost 10 minutes into the session here. We do see the S&P down, but only 3 points. So honestly, not a lot of movement, especially if you consider yesterday we closed at 69.01, so an all-time high. Right now we're at 68.98, so just a stone's throw, obviously, away from that. In terms of the point additions, you're going to see obviously the biggest stocks here, but Tesla leading the pack there ahead of NVIDIA as it bounces back, Apple, Netflix, and GE, Google, UNH. On the downside is where you see the earnings story coming through. So Broadcom is one of the concerns this morning. Yesterday it was Oracle, and Oracle is down again today, but only by about 2%. By the way, yesterday, I think Larry Ellison lost yesterday $25 billion of personal wealth with the 11% drop in Oracle shares. Still, he's made an extra $95 billion this year, so don't cry for the big stakeholder in Oracle. In terms of the industry groups here on the day, we're looking at materials, consumer discretionary, real estate, and utilities doing the best, so it's kind of a defensive leadership here, but this is interesting that you have so many sectors up. In fact, Joe, did we reset this? So many sectors up, and yet, yeah, that's amazing. So almost all of the sectors up, 9 out of 11, and still it's IT and energy. These drops, as slight as they are, enough to drag down the broader index. Okay, it's only off by a fraction. Coming up, Broadcom shares slide as investors look for a bigger AI payoff. More on that earnings report and the state of the industry next with Mandeep. This is Bloomberg Open Interest.
Fidelity Trader Plus with your preferred tools, customized charts, and streaming data, so you can start a trade idea on one device and execute it on another. Meet our most powerful trading platform yet, Fidelity Trader Plus.
Excellence takes drive, work, perseverance. Tiger Woods brings it to the course. Insperity brings it to your business. Want to be the best? Work with the best. Insperity, how HR matters. Learn more at insperity.com/tiger.
Premium benefits anywhere you go. Unlimited, zero trading fees. 6% back in crypto. And other exclusive benefits with Level Up. Take your wealth to the next level.
After 11 increases, the Fed has paused rate hikes.
In the fourth quarter of 2023, we wanted to anticipate the changes that would be coming from a rates environment. Our traders, portfolio managers, and credit analysts can collaborate on the fly as the tides change in the market. A deep bench of expertise is having people with conviction to make those calls. So where we find value, we will go and execute.
Advertising as we know it is dead. Consumers don't want brands to come and keep on bombarding them with advertisements. We need to keep the experiences frictionless and seamless. We keep saying, oh, attention is the new currency. No, it's trust which is the new currency. So we need to reinvent marketing with a new set of laws and theories. How consumers will actually make their choice is based on trust and the purpose of your company. Yes, we are here to make profits, but we're also here to make a difference. And this difference is not for political correctness, a sincere, genuine purpose. You have to connect the dots between your purpose, your passion, and your profitability, and make it an integral part of your business model.
Time now for our top call. Some of the analyst action in focus this morning. First up is Jefferies upgrading Lululemon after the, wannabe upscale retailer boosted its outlook. I guess it's fair to say still pretty expensive stuff, and reported encouraging holiday trends. Lululemon is also shaking up leadership after a sluggish year, with its CEO planning to step down in January. You can see the shares up almost 13%. Next up is JP Morgan boosting its view on Citi. The analyst says Citigroup is set to benefit more than peers from a firm economy and stronger markets activity into the new year, and Citi shares are up a little more than a third of 1%. Finally, Guggenheim is upgrading Bristol Myers. The firm says the pharma giant is headed into a catalyst-packed 2026 with low expectations, rising royalties, and a sturdy dividend. Guggenheim sees the stock slump as a buying opportunity, and investors are doing that today to the tune of 3%. Broadcom shares in the red as its AI sales outlook disappoints. Joining us now to talk about this is Mandeep Singh, Bloomberg Intelligence Global Head of Technology Research. And Mandeep, I'll say the same thing to you that I said to Ed Ludlow. You know, on the one hand, we're scrutinizing these hyperscalers because we're worried that they're spending too much. On the other hand, a $73 billion backlog is not enough for us at Broadcom.
Yeah, I think in the case of Broadcom, if you parse through the backlog, it's all tied to Google TPUs. And that is where, everyone is comparing what happened with the Apple exposure when it comes to the non-AI side of their semi revenue, too much dependence on Apple. And the same thing is happening here when even Anthropic added $20 billion of orders. They are using Google TPU design. So from that perspective, the ecosystems are forming where it's pretty much a duopoly at this point of time. Either you're using NVIDIA or you're using Google TPU. And in the case of Broadcom, 90% of their AI revenue is tied to Google TPUs. So even though they talk about OpenAI as a potential new customer with up to 10 gigawatt capacity, it seems very unlikely that any of that backlog will translate into revenue before 2028 or 2029. And that's where I think the dependency is what's hurting their margin expectations. And that's why you see that sort of a stock reaction today.
The Google TPUs sort of emerged as a threat potentially to NVIDIA's Blackwell chips and whatever's coming next. What does Broadcom have in terms of that kind of competition?
Well, so Broadcom really is working with Google, to be their partner when it comes to designing their TPUs. They're providing certain components for the accelerator, and they are ultimately liaising with all the suppliers to get the chip made and manufactured by TSMC. But when it comes to other ramp-ups, like from Meta or some other customers that they had talked about in the past, it seems like those haven't really panned out in a big way. In fact, we have heard Meta may end up using Google TPUs as well. So there was a lot of chatter about 2 new customers up until the last quarter that may be ramping up at Broadcom. But it turns out one of them was Anthropic, and Anthropic in turn is using Google TPUs and not really designing their own chip. The only one that had talked about using their own chip was OpenAI, but it sounds like that effort is likely going to get pushed out to 2028, 2029 before they can ramp up significantly. So from that perspective, all of Broadcom's $30 billion plus in AI revenue is mostly tied to Google TPUs at this point of time.
All right, Mandeep, thanks so much for joining us. Mandeep Singh there of Bloomberg Intelligence talking to us about the chip wars. And don't miss, by the way, a conversation about AI policy with White House Special Advisor David Sachs. That's on Bloomberg Tech at 11:45. Will be, no doubt, a fascinating interview. And let's get a quick check on 3 stocks we've been watching all week. Warner Brothers is up about 14% this week. Netflix is down, well, this is the intraday move that you're looking at, but Netflix is down 4% over a week, and Paramount is actually gaining. We're keeping an eye on the race to buy Warner Brothers, and to clarify the deal terms, $5.8 billion will be paid by Netflix in the event that the deal does not pass regulatory muster. But if Warner Brothers were to choose, shareholders were to choose to go with Paramount, Netflix would get paid $2.8 billion by Warner Brothers. So it all comes down to who does the breaking up. Coming up, President Trump plans a push to reclassify marijuana as a less dangerous drug. We'll take a look at some ETFs that could shoot higher. Well, some that have done pretty well year to date. This is Bloomberg Open Interest.
Wherever news and ideas meet, wherever earnings reports and saved orders intersect, the all-new Fidelity Trader Plus is there, giving you the freedom to trade how you want with your preferred tools, customized charts, and streaming data. So you can start a trade idea on one device and execute it on another. Meet our most powerful, consistent trading platform yet. Meet Fidelity Trader Plus.
Premium benefits anywhere you go. Unlimited zero trading fees. 6% back in crypto. And other exclusive benefits with Level Up. Take your wealth to the next level.
Don't miss Open Interest live weekdays.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jumana Bersachi in Beirut, and this is Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what's going on in stocks. 21 minutes after the bell, we see the S&P 500 down 0.25%. Reminder again, it did hit a record high at the close yesterday, 69.01, that level. The Nasdaq down almost 0.75% today, and the problem really is Broadcom earnings. We had a little bit of a rebound in Nvidia shares, but they are now back in the red, down only 0.1%, but it's a very heavy company, and Broadcom losing almost 1/10 of its value. Costco is off after earnings, only 1/3%, and we really do see encouraging signs for these big box stores that higher end consumers are moving down. Lululemon getting a huge boost as the CEO steps down, making way for a reset, and also Lululemon has a decent holiday sales forecast. And then here are, Tilray Brands, the weed company, I guess, out with a new lineup of products, up almost 30% today, and the Round Hill Cannabis ETF also up more than 30%. Let's talk about cannabis ETFs with analyst James Seyfert of Bloomberg Intelligence. James, clearly, a report that President Trump wants to not decriminalize or declassify, but I guess reschedule marijuana as a Schedule III drug rather than Schedule I is helping these assets.
Yeah, 100%. I mean, the way to look at this, right, there's a whole host of marijuana or cannabis ETFs out there on the market, but there's like two that are really purely focused on the U.S. type of market. And that's MSOS and weed, the Round Hill one that you mentioned. And it's because like MSOS is a ticker that seems weird, but it's because it holds only multi-state operators. And it's because there's this patchwork of regulation in the US for marijuana. It's legal in some states, it's illegal federally. And if you cross state lines, it's like you're in this gray area. So these stocks, these ETFs, while they're not going to be the most diversified exposure to the marijuana market, they give you exposure to the names that are most likely to pop on things like, what you just mentioned, changing the scheduling and any sort of regulation here in the U.S. that could maybe open it up federally. So those names are going to pop the most. And weed, specifically from Round Hill, it only holds 5 of those largest MSOs, multi-state operators.
All right, so we'll watch MSOS. They've had a decent year in terms of the gains that we see, especially now. Let's take a look at the decent year that ETFs have had. I mean, every year you and Eric and Athanasios are like, wow, our industry is just breaking new records across the board. This year is no different, and 2026 is also set to be a banger.
Yeah, I mean, so we had our ETFs in depth event yesterday at our New York headquarters where you are right now. And it was a really successful event, but Eric gave a presentation to look at like what happened so far in 2025. And he basically titled it, "Is this as good as it gets?" Because every record that we look at, every factor, everything we look at is a new record. And it's not just like slightly eking out. It's beating records by 25 to 30% over prior years. And we're not even done with the year yet. So, I mean, we're nearing in on $1.4 trillion of inflows this year. We have record volume. We have record new ETFs. Vanguard is going to take in over $400 billion alone. That's a record for an issuer. The Vanguard S&P 500 ETF is taking in $130 billion. That's a record for a single ETF. I mean, I could keep going if you really want, but everything has been really good for the ETF industry here in the U.S.
Well, it makes sense because the kids just want to voo and chill, right? If you buy that tracker, I guess you're diversified to some extent and good to go. And there are more catalysts to come, right? For ETFs specifically, could we see investors buying them in their 401ks and their IRAs?
Yeah, I mean, possibly it could go more into the retirement market. As you mentioned, like who doesn't love an S&P tracker where you can get it for 3 basis points? It's virtually free and you're getting exposure to the US large cap market, right? So that's what's happening. But it's also like we call them degens, the real heavy traders that like to trade on leverage. Lots of those products are coming to market and they're having a lot of success, which is part of why we had a record volume level this year. But yeah, as you mentioned, next year we just got approval for basically any mutual fund can add an ETF share class onto their mutual fund now from the SEC. They're approving these things for a lot of different issuers, so that's a tailwind that could happen. There's a whole bunch of other tailwinds. We're still seeing a lot of movement from legacy structures like the mutual fund moving into the ETF, and ETFs are just continuing to snowball. But one thing I do think is going to happen, we haven't seen a lot of liquidations. I would think that we're probably going to see a lot more liquidations next year because we just saw, as I mentioned, we're almost over 1,000 ETF launches alone in 2025. I mean, the numbers are getting crazy.
James, to be fair, they call themselves degenerates. They are smooth-brained apes, and they are crushing it. James Seyfert, thank you very much. Tune in to ETF IQ on Mondays at 12 p.m. New York time. Coming up, Cam Dawson joins us. She sees more room for stocks to run as more strategists turn bullish.
Meet the all-new Fidelity Trader Plus with your preferred tools, customized charts, and streaming data, so you can start a trade idea on one device and execute it on another. Meet our most powerful trading platform yet, Fidelity Trader Plus.
Excellence takes drive, work, perseverance. Tiger Woods brings it to the course. Insperity brings it to your business. Want to be the best? Work with the best. Insperity, how HR matters. Learn more at insperity.com/tiger.
Premium benefits anywhere you go. Unlimited, zero trading fees. 6% back in crypto. And other exclusive benefits with Level Up. Take your wealth to the next level.
Based mechanisms.
Does that mean banks such as yourselves issuing stablecoins?
We could. We are issuing Hong Kong dollar stablecoins today. We're in a sandbox for tokenized bank deposits in Hong Kong. We're effectively issuing tokens related to trade finance in Singapore. So it's all on the table, but we're always going to tie it back to what our clients want and need, because if we don't get that one right, the rest doesn't matter.
The market capitalization of both type of instruments, crypto and digital assets, are both very low. Stablecoins today have $20 billion of flows a day. It's less than 1% of the flows of the payment system in the world. But because they have the ability to be very helpful in use cases, particularly in retail to begin with, but then potentially on the wholesale side, I think we will see a lot more of that.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. Happy Friday. I'm Matt Miller, Danny Berger. has taken off today. And why not? We hit an all-time record high at the close yesterday. 69.01 was the level, and globally we're pushing to record highs. Wherever you look, we're seeing big gains, pretty much, in equities. And maybe that's set to continue. A Santa rally trying to take hold as global stocks hit records. But caution in tech remains as Broadcom falls short of some pretty lofty AI expectations, and investors are hearing from a string of Fed speakers this morning as the central bank becomes increasingly divided. But we begin with the S&P 500 on track for a third successive year. Cameron Dawson, New Edge Wealth Chief Investment Officer, says the path of least resistance is higher, writing, "You cannot argue that valuations are cheap, and you cannot argue that earnings estimates are little room for a chase higher." Cameron joins us now. Cam, great to have you here in studio. What is or who is driving us higher? Is this a retail play that's driving us up?
Retail is completely all in. We can look at AAII positioning data and you see it at prior peaks like we were back in times like 2018 or 2021. You can look at FINRA margin loan growth. It's grown by 40% over the last 6 months. So retail is completely in. Who's been sitting on the sidelines has been institutions. They've remained either underweight or neutral this market ever since the April lows. So if there is one cohort,
they've missed out on all of this. 17%. What? No, it's more from the April lows. Like 38% the rally from there.
It's been extraordinary.
Yeah.
But what you have seen is that discretionary institutional investors, so think long-short hedge funds, mutual funds, have remained in mostly an underweight position, which just means that as the market continues to scream higher, they get pulled into this market because they need to at least get to neutral and even to overweight to keep up with the performance.
It's like a replay of dumb money, but with the entire broad market.
Yeah.
Can that continue in 2026? I mean, I only hear about tailwinds, Cam, right? I hear about the stimulus coming from the one big, beautiful bill, AI productivity, an increase in that. We don't have any more immigration, so it's not like the labor pool is growing and
there's just really high expectations as we look into the overall earnings growth. And I think what's fascinating is
what are your expectations?
So current consensus is at $309 a share. And what that implies is a 200 basis points of margin expansion and an acceleration in revenue growth. You look one layer deeper on that, what gets really interesting is that revenue growth is implying a big acceleration in everything else and a deceleration in things like Mag 7. So the everything else, that equal weight, is expected to go from 1.5% revenue growth this year to 5% revenue growth next year, which means that current consensus is expecting a strong, very broad-based economy. And the question is that worth giving the benefit of the doubt?
I mean, we're going to talk with Matt Winkler, Editor-in-Chief Emeritus here at Bloomberg, at the end of the hour about tariffs and the costs that U.S. consumers are bearing. $1,000, I think we're looking at this year, $1,400 for the average U.S. household in 2026. So climbing. Are companies passing on these tariff costs, or are they taking a hit to their margins? Because when you say margin expansion, I'm wondering, where's that coming from?
Well, we think it's actually coming from some of this belt tightening and maybe why we're seeing the labor market weaken, because we do know that companies have borne the majority of the costs when it comes to tariffs, but they've been able to hold the line on margins, which suggests that they're looking for cost cuts other places. So when we see the layoff announcements, we're not necessarily thinking, oh, this is AI, this is some big revolution. We're seeing it as companies are looking anywhere they can to defend their margins, which means that even though profits are going up, it means that you're not necessarily seeing the labor market participate in that growth.
This is what my skeptical co-host suspects, that companies are using AI as an excuse to slim down headcount. You see that as the case?
I think it's very likely. From the anecdotes that we're hearing is that AI is a tool, but it's not quite a replacement yet. So maybe at the margin with some of the lower hiring and entry-level workforce, as you see things like college-age workers or right after college age, seeing that unemployment go up. But broadly speaking, we do not think that the weakness in the labor market, as we have seen the slowing in the pace of job additions, can be pointed to because of AI. We think it's margin pressure likely related to more things like tariffs.
Speaking of margin, I think you pointed out that we've seen incredible growth in margin, right? From FINRA data, loan balances.
Yeah.
I guess this is what investors what these degens are borrowing to get into this market. And to be fair, they're winning right now.
Yeah.
But does that set us up for a fall?
Look, it's an ultimate party on Garth kind of environment where you have seen a lot of leverage being added into this market. You see it in FINRA margin loan balances.
40%, up 40% in 60 months.
In the last 6 months. You also see it in leveraged ETF volumes. The ETF issuance that you've seen or new formations has all been mostly focused this year on big leverage ETFs, which all says that there is a lot of risk appetite in the retail cohort, which has been rewarded this year because you have seen such strong markets, and you have seen markets led by things like high beta, non-profitable tech, things like ARK, all of these areas that have a bit more of a speculative bent. And a lot of that does rely on expectations that the Fed's going to keep on cutting because you need liquidity and you need loose financial conditions for these things to do well.
Is the Fed going to keep on cutting?
We think that they set themselves up to keep on cutting in 2026. If you look at their unemployment estimate, holding at 4.4% from 25 to 26 suggests that the bar is pretty low for them to say, hey, the unemployment market is weakening more than we thought it would, which suggests that they could deliver those cuts. They also talked about this willingness to look through near-term inflation. By calling tariff-related inflation one time, they're effectively saying we're going to prioritize the labor market versus inflation.
It's just so interesting, and you're not a political strategist, obviously, but
I hope not.
Affordability is such a key issue, right? And yet, we're going to hold these tariffs off, on which the Tax Foundation has said are going to increase costs even more in 2026, and the Fed is going to cut into an inflation cycle that it calls transitory?
Yeah, and now we also have the prospect of medical costs going up pretty significantly as we see the Obamacare premiums potentially jumping. We think the biggest challenge with all of this is that we, as people who look at markets and the economy, we think of things in the terms of second derivatives. We look, hey, the inflation rate is slowing down. But we as consumers, as individuals, we live in this world of levels. And the level is still going up even as inflation decelerates, and that's why people continue to get pressured and feel that pinch from inflation, even though we'll say, hey, it's a win because inflation's slowing down.
All right, Cam, if I get a Christmas bonus this year, where do I put that, after I leverage it, where do I put that new money to work?
So we've been finding a lot of opportunity outside of just big, large cap growth, which of course has been driving this market higher, but things like mid cap, international, and value are all places that if we are to pay for active management, that's where we want to be. Those indices are far less concentrated. There's a lot more difference between winners and losers. So we're finding a lot of great opportunities to add value, look for alpha in those kinds of markets that had been left behind. And I would note that you are seeing a lot of perkiness in some of those areas over the course of the last couple of, or really the last month, where you're seeing some pro-cyclical things turn higher, small caps hitting a new all-time high, but we really think it's important to be highly selective in those areas.
All right, Cam, great having you here. Thank you so much for joining us. Cameron Dawson there of New Edge Wealth. Let's get a check on what markets look like heading into the 10 o'clock hour here. We're still looking at losses, but they're accelerating just slightly. And remember, we're coming from the highest level we've ever closed at on the S&P 500 at 69.01. Right now it's 68.72, down 28 points. The NASDAQ off almost 1% as the tech stocks have further to fall. 25,436, the level there. You can see the Dow Jones Industrial Average. I'm glad when the kids are out, we put that up here. 48,791 also hit, as President Trump pointed out, a record high. And the 10-year yield right now at 418.41 to go out 5 significant digits. It'll be interesting to see where that goes through 2026. Let's get a look at some of the single stock stories this morning. Broadcom delivered a sales outlook for the AI market that failed to meet high expectations. It has a backlog of AI orders totaling only $73 billion. Lululemon boosted its profit forecast and said the CEO, Calvin McDonald, will step down in January. Plus, pot stocks jumping higher on news that President Trump is expected to direct his administration to reclassify marijuana as a less dangerous substance. Tilray also apparently announced a new product line if you want to check it out. Coming up, Wealthfront raising more than $480 million in its IPO. We'll speak to the company's CEO about how he changed the landscape of money market funds next. This is Bloomberg Open Interest.
wherever news and ideas meet, wherever earnings reports and saved orders intersect. The all-new Fidelity Trader Plus is there, giving you the freedom to trade how you want with your preferred tools, customized charts, and streaming data. So you can start a trade idea on one device and execute it on another. Meet our most powerful, consistent trading platform yet. Meet Fidelity Trader Plus.
Premium benefits anywhere you go. Unlimited, zero trading fees. 6% back in crypto. And other exclusive benefits with Level Up. Take your wealth to the next level.
Chief Future Officer shines a spotlight on these dynamic leaders. Hasbro is transforming its business, taking classic brands in fresh directions. Could this be a winning strategy now that tariffs have changed the game?
Most of our capital is being spent on those businesses that aren't exposed to tariffs. The next pool of dollars is going to our transformation.
Watch Chief Future Officer Wednesday on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Bringing you up-to-the-minute global economic news whenever and wherever it happens. I'm Lizzie Burden in Florence, Italy, and this is Bloomberg.
Now to high interest, look what's making headlines around the world. New Jersey has declared a state of emergency as a major propane terminal outage threatens winter heat for nearly 186,000 residents. With temperatures freezing, the state is waiving trucking limits to rush fuel where it's needed. Suppliers are rationing loads, and long wait times are growing, raising fears of delays for home heating across the region. Millennium Management is putting over $3 billion behind two outside hedge fund teams. The London-based Fulcrum without another R maybe? Fulcrum Asset Management will receive about $2.3 billion to run an exclusive equities unit. Another $850 million will go to Armar Capital. It's the latest push by Millennium to seed fresh investment talent across its multi-strategy platform. And NASDAQ is tightening its listing rules, giving itself new discretion to reject small-cap IPOs, even if they technically meet the requirements. The exchange can now waive red flags like company location, board integrity, and advisors linked to past problematic trades. The move aims to curb extreme price swings and manipulation seen in recent micro-cap listings, especially from overseas issuers. Let's stick with the IPO market. Fintech company Wealthfront raising $486.6 million in its IPO. The company, which is best known for its automated investing products and online platform that's attracted younger customers, is set to trade under the ticker WLTH on the NASDAQ. And joining us now is the company's CEO, David Fortunato. And David, I think it's a fascinating thing what you've done, what Wealthfront has done with money market funds, getting investors a real return on savings that they can still use to do things like pay the rent. Do you see it as a sea change in money management?
Well, the way that we think about it is really by using technology and automating solutions, we're able to share more savings with clients, ultimately keeping more, clients get to keep more money in their pockets and they get to do more with their money. We're quite happy to operate on smaller margins, and we think that leads to better outcomes for the folks who use Wealthfront.
I wonder what you think about the new Trump proposals. Well, they're not really new, but the Trump investment accounts, bringing in a new generation of investors. Obviously, for those specific accounts, they have to be born now. But if you look at the money that Michael Dell gave, that's for kids up to the age of 10. Are they going to be attracted to platforms like yours more than they will be to, the incumbent banks on Wall Street?
One of the things that I think is surprising for folks about Wealthfront is that our new clients are coming in with a median age around 23, 24 years old. So a lot of young investors are getting started. They're interested in low-cost, globally diversified, tax-efficient investments. And we see that as an opportunity to get clients started early and really compounding their wealth for decades to come.
What are you going to do with the money, David? How do you grow Wealthfront with the proceeds that you've got?
We're focused on product development. Really, we've been a product-led company from the very early days, and so we see opportunity to continue to expand. You look at one of the products that we've started releasing over the last month is home lending. So helping folks get a great digital experience as they buy a home and save some money on their interest rate as well.
We saw at one point, I think Wealthfront accounts were yielding 5.5%, close to 6%. If you had brought in, other customers, you got a huge boost, and you still do. But that rate has come down to the 3s, maybe 4, if you reach with those incentives. Is it still going to be as sticky as the Fed cuts rates?
What we've seen is stickiness of clients. We don't focus on exactly what accounts assets are in. We focus on keeping clients engaged on the platform and growing their wealth over time. And so 75% of our assets are held by clients who hold investment accounts on the platform. As rates have come down a little bit, we have seen assets shift into investments. We think that's ultimately good for clients long term to be able to compound their wealth, over the next many years that they're on the platform.
How can you beat out the competition, because there's a lot of it, with robo-advisory services? How much can you do with AI, or do you still need to rely a lot on humans?
Well, half the company is software engineers. We've really been a technology-led company from the very early days. We focused on new technologies and pushing out new products to clients. Really, that's been the focus of the company from the beginning. I was the CTO for 10 years. I built our trading infrastructure and data infrastructure. And if you look at our investment products and our client experience, really leading with technology is the core of how we think about things. When we do human support, we have a great team that answers the phones and sends emails. But really, we see that as a way to prioritize to make our product better. If a client needs to call us, it's an opportunity for us to get better, and that's how we approach it.
I guess I focus on cash management, that portion of your business. But as you're saying, like, you've got a much broader portfolio of offerings, investment advisory services, financial planning, lending products, technology. What about your client? I mean, I'm sure that's just as diverse, but what does your average customer look like in terms of demographics, wealth, sophistication, et cetera?
Sure. Our median client is 35 years old today. They make $165,000 a year in annual income. They have about $250,000 of net worth. They're saving every month consistently, often putting away a few $1,000s a month and growing their wealth on the platform. We're investing it across a globally diversified portfolio. We're helping them earn more on their cash. We're providing them with quick liquidity through our portfolio line of credit product, where you can borrow against your securities for less than 500 basis points. So we're really trying to offer our clients a better deal in everything that we do.
Yeah, I hear almost a Vanguardian client service ethic there, and it makes sense. Burton Malkiel, your chief investment officer, focuses on that. Obviously, the writer of A Random Walk Down Wall Street as a financial news anchor for 25 years. I've been thinking about him for that long. How much influence has Burton had on your business?
I mean, Bert has had a huge influence on our business even before we started. You know, when I was 12 years old, I had a paper route and opened my first account at Vanguard to be able to start saving in my IRA. It certainly influenced me and how I think about investing. We're incredibly fortunate to have Bert involved with the company. He's really been a guiding light for how we think about what products we want to get into and how we want to present them to clients. And you know, he's fierce. He cares a lot about what we do and how we do it. And it's been great to have his voice of wisdom with the company for so long.
Some of your competitors, when they do IPOs, fintech companies often give a special offering or share allocation to their large base of customers. You didn't do that. Why is that?
We're a fiduciary to our clients on investments, and you know, the guidance that we've put out over time is that investing in IPOs can be a risky prospect. We really emphasize passive, diversified investing. And while we understand that many companies have given clients allocations in the IPO, it really sets up a dangerous conflict of interest precedent, and we really wanted to make sure that folks, you know, we were consistent in the way that we do things across all of our investment guidance.
One of the risks, by the way, to businesses like yours, like Schwab, like Robinhood, SoFi, is that they're very sensitive to rates, right? And that's a moving target right now. How do you diversify away from that?
So the way that we run our program is a little bit different. You know, many broker-dealers gain a higher spread and make more revenue when rates go up, and then they lose that revenue when rates go down. In our case, we seek to maintain a fixed spread relative to rates. So as rates are going down, the total fee rate that we earn on cash has remained consistent throughout both the cuts that happened in 2024 and the cuts that have happened recently. As we've been able, you know, to see rates come down, we've actually been able to drive cross-product adoption and see additional assets flow into the platform to help clients invest. So, you know, we think about the diversity of product offerings as really the strength in growing throughout the cycle, and it's been a focus of the company since 2019. It's why we first got into cash management in the first place.
So are you not concerned that and I've kind of asked you this already, but I'm trying to get your outlook on rates, your outlook on the Fed, what you expect, you know, as they cut at the short end. Obviously, we haven't really seen much of a drop in the 10-year. So how do you see the curve helping your business, and how do you forecast that out into 2026?
Yeah, so we don't try to predict the future. I think, you know, we have no expertise in predicting rates. Instead, what we try to do is prepare our clients for the future and many possible things that could happen. During the period in November and December, the yield curve normalized a little bit, and what we saw was clients loved our automated bond ladder product, which let them go out on the yield curve and get a little bit more yield. If the yield curve normalizes, we expect that product will do well. If the yield curve stays inverted, we expect clients to continue putting away money in cash and continuing to invest for the long term. Rather than focusing on one environment and trying to optimize our products for the current environment, we're focused on offering a portfolio of products that can continue to grow throughout the cycle.
Well, David, it's a truly fascinating company, a fantastic IPO today. Congratulations on that. Hope we can get you here in the studio to talk more about it. David Fortunato of Wealthfront. Now, obviously, we don't necessarily see that trading right away, but the shares indicated at $15.50 if you're following the IPO. It was at $14, and we'll bring you the trade as soon as they start to tick. Still ahead, we're going to speak with Brown Harris Stevens CEO Bess Friedman about her outlook for luxury real estate in 2026. This is Bloomberg Open Interest.
Wherever news and ideas meet, wherever earnings reports and saved orders intersect, the all-new Fidelity Trader Plus is there, giving you the freedom to trade how you want with your preferred tools, customized charts, and streaming data. So you can start a trade idea on one device and execute it on another. Meet our most powerful, consistent trading platform yet. Meet Fidelity Trader Plus.
Premium benefits anywhere you go. Unlimited zero trading fees. 6% back in crypto. And other exclusive benefits with Level Up. Take your wealth to the next level.
Is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute geoeconomic news whenever and wherever it happens. I'm Bonnie Quinn in Sao Paulo, Brazil, and this is Bloomberg.
Get a check on the stock market right now, almost an hour into the session. We've got the move screen up over here, and you can see that we have steadily come further down throughout the first hour of trading. We still have breadth to the upside, 279 gainers, only 221 losers, and you've got some big names on the top, but General Electric adding the most points doesn't really instill confidence here. That's because Broadcom put out earnings that kind of freaked out investors a little bit, as evidenced by the 10% drop. It's taking 23 points off the S&P right now. And you got Amazon, Microsoft, Nvidia, and Google, Facebook all falling as well. Coming up, Manhattan rents skyrocket, hitting an all-time high with stocks.
Meet the all-new Fidelity Trader Plus with your preferred tools, customized charts, and streaming data, so you can start a trade idea on one device and execute it on another. Meet our most powerful trading platform yet, Fidelity Trader Plus.
Excellence takes drive, work, perseverance. Tiger Woods brings it to the course. Insperity brings it to your business. Want to be the best? Work with the best. Insperity, how HR matters. Learn more at insperity.com/tiger.
Premium benefits anywhere you go. Unlimited zero trading fees. 6% back in crypto. And other exclusive benefits with Level Up. Take your wealth to the next level.
This is a book, but it's also a teacher. In 2024, nonfiction book sales reached almost 362 million copies. Bookstores and publishers are thriving as retailers reimagine stores as curated experiences, using connected technologies to track inventory, manage supply chains, and increase sales with tools that depend on reliable and secure connectivity from AT&T Business. Because reading is a journey of discovery, and a book is a compass that helps us find the way forward.
Our data showed from our survey that 41% ranked AI as the #1 area of investment in technology going forward. That was followed by cyber, and outside of more generic AI, agentics in particular were high on the list. While we've had a tremendous focus on back office, I think you're going to start to see companies taking more and more chances, especially with the regulatory environment, to be able to make a push to really start to transform their business and break out of the pack.
Manhattan rents surged to an all-time high. Data from appraiser Miller Samuel and brokerage Douglas Elliman shows the median lease price in the Big Apple hit $4,750. It's a 13% jump from just 1 year ago. Joining me on set is Bess Friedman, CEO of Brown Harris Stevens. Brown Harris Stevens is a luxury real estate brokerage in the New York metro area as well as South Florida. So you're focused more on the higher end of the market, but inflation is just crushing us. Yep. The rent is too damn high, as someone once said. Can anything stop it?
I think it's going to take time, you know, as we reset a little bit. We've seen more sales this year, which has been good, but there's a lot of pressure on rentals. And as people want to move here, they got jobs here. It's the talent capital of the world. You know, rents keep going up, up, up as people pause on the purchase, you know, avenue. They're just waiting to see what's going to happen with rates, with everything in the economy. Are we headed for a recession? All these questions loom. And so the rental market is a place that people can temporarily live and make decisions later on. So
what about your clients? I mean, people who are buying high-end real estate, they don't have jobs, right? These are just people with a ton of cash.
Yes, that's discretionary. And thankfully, even post the mayor's race, that market has been incredibly robust. People have not stopped. They have
really?
Not...
I thought everyone was leaving New York after this communist won. Wasn't that what we heard? Isn't that what everyone said?
That's what everybody said, but that's not what happened. In fact, we didn't skip a beat. The market has been really strong. People have pursued and bought and closed, and we're seeing a really strong luxury market because people made a lot of money in 2025, and that's a different market, obviously.
But you are in, like, if we do see an exodus from New York, those people are going to South Florida, another market you're in, right?
Yes.
So you're in a great position to tell me about the flows.
Yes.
Are we still seeing that flow south? Are any of them coming back?
I mean, we have been seeing that in drips and drabs, and we're not seeing anything substantial. People do move to the south for other reasons, because they retire, because they want different weather, because they got a job there. So we've seen a little bit of that, but there's been nothing that is remarkable. You know, people have returned to New York.
Yeah, that's what I'm wondering about.
Yeah, people want to be a part of New York City. I mean, look at the tourism percentages. Look at the office space. Look at, people are back to work. The city is doing really well.
Do you ever see people getting back to work at a pre-COVID level, like going into the office, or are we in a new era?
I think that
hybrid work.
I think that maybe a Friday, you know, working from home has been okay, but I think people are saying you got to show up. You can't build culture on a Zoom. You got to see the whites of people's eyes, see how they're doing, check in with them, and talk to each other. And I think the companies that are committing to that are building a real future for their, you know, whatever they're building and doing.
I'm going to talk to our economics and policy correspondent in a minute about Fed speak. And obviously the Fed has been cutting 75, 100 basis points now. Does that matter to your clients?
I mean, look, New York City in particular is a big cash place. I mean, people buy their homes, a lot of them in cash, like 60%, I think we saw. But yes, of course, it all matters. It matters for consumer sentiment. They want to know that rates may come down, but it's not going to be anything meaningful. It was 25 bips. It's not going to make a big impact on mortgages. And I think that it's really an affordability issue that we face throughout America that's a bigger topic of discussion that we need to solve for.
By the way, why is the New York market so cash heavy? Is it just because they have the money, or is it because they want to go into a co-op and the co-op wants to make sure that they don't have a big mortgage?
Well, of the housing stock that you can buy in New York City, you know, the majority of that, nearly 70%, they are comprised of cooperatives. And yes, there are certain requirements, but this is a discretionary market. It's expensive to live here. It's expensive to rent here. So people tend to, you know, spend cash because it's a pied-à-terre market as well. It's a second home, a third home market.
What are the hottest places right now? Where are you doing your best business? Where do people want to go and live?
I mean, all over the city, but the Upper East Side is like, they're saying uptown is the new downtown. Still? Sorry, it's not just because I live there. I'm not selling my book to you, Matt. I promise you, the Upper East Side is where it's at. I mean, downtown is always hip, but there's all these new places that have opened up on the Upper East Side. And you have parks, you have schools, you have temples, you have everything that people want. So, but the city all over is great.
And the boroughs, I mean...
Brooklyn is super hot and strong. The townhouse market there is incredible. You know, it's just, you know, we're moving out further to different places because there's no room for everybody.
Are you worried about the new mayor at all? I mean, what about your clients that own properties they rent out, right? You have, say, like some Saudi oil billionaire in here. He's got a whole building, and is he worried about price caps?
I think that's, you know, for the rent regulation, that discussion is scary because people won't improve those apartments if it happens. But I think it's going to be harder to do than what he says. And I think, you know, people have to give him a chance. You know, we have to give him a chance. I care about good policies, not labels. I don't call yourself whatever you want, but give me good policies, and we'll have a great city.
Bess, it's great to have you here.
Too, bud.
I hope you have a fantastic holiday.
Thank you.
Bess Friedman there of Brown Harris Stevens. Quick check on what's going on in the markets right now. We have seen a decline in the equity indexes, and that continues. So the S&P 500 now down 0.7%, 68.53. However, we were at 69.01 yesterday at the close, an all-time high. The Dow Jones Industrial Average also an all-time high, 48,735. The NASDAQ taking the biggest hit, down 1.4% on the Broadcom earnings story. In terms of the Fed, we got fresh speakers this morning. Statements from Austin Goolsbee, statements from Jeff Smid, who both dissented against the central bank's decision to cut interest rates this week. Let's break it down with Michael McKee, Bloomberg's international economics and policy correspondent. Mike, what were the reasons behind those dissents?
Well, Beth put her finger on it when she said there's a nationwide problem with affordability. The two dissenters basically saying it's inflation that is bothering them because they've been out talking to their constituents in their districts. Austin Goolsbee saying today, almost all business people and consumers we have spoken to in the district lately identify prices as a main concern. My unease is about too heavily front-loading rate cuts and just assuming that inflation will be transitory. And then Jeff Smid adding, I continue to hear concerns about inflation. I view the current stance of monetary policy as being only modestly, if at all, restrictive. Now, they have voted at their last meeting for this year. They roll off next year. 2 new members are coming on, and they're pretty much in the same boat, maybe a little more mixed. We did hear from Anna Paulson, the Philadelphia Fed president, who said she's still more concerned about labor market weakness than about upside risks to inflation. But then Beth Hammack from Cleveland, a hawk, says inflation has been too high. It's been much closer to 3% than 2%. I would prefer to be on a slightly more restrictive stance. So it doesn't look like we'll have much change from the rotation of the Fed presidents. We are looking at people coming on who are also worried about inflation, but inflation is what the people are telling the Fed is their concern.
Well, you know what's interesting is that it's not just the Fed's dual mandate, but there's this conflict between what's worse for consumers, higher unemployment or higher inflation, right? And I remember when a couple years ago, Joe Stiglitz came out and said, look, inflation is far worse and it's killing these people, but obviously if you don't have a job, then to you at least, the unemployment rate is more of a problem.
Yeah, exactly. But the situation is we still have jobs. Unemployment rate is historically low still at 4.4%. We'll see when it comes out on Tuesday. But we are not seeing big layoffs. We're not seeing people forced out. And so at this point, inflation continues to bother people much more. And you see that reflected certainly in all the polls.
What are the expectations? On Tuesday, we get non-farm payrolls, the delayed report. What are the expectations for that, and does it matter to the Fed going into 2026?
It matters less than people might think, even though there's been a big deal made of how much data we have not gotten, in part because they're combining the October and November releases, and they won't have all of the October data, so there'll be some blank spaces in there, and it'll be kind of hard to measure what the progress was. Right now, the consensus is for 40,000 jobs created essentially over the 2 months, but Jay Powell said on Wednesday that the Fed thinks that's overstated, so it could actually be negative. I think what we have to do is wait until we get the December payroll figures on January 9th, and that will be the number that will really matter to the Fed as they consider what to do at the end of next month.
Mike, Jay Powell and you, both big deadheads, and there's no dead shows planned that I know of right now, but obviously Phish is coming to Madison Square Garden. Will you go and see a Phish show? because you just need that live music?
I think there's probably a good chance of it. The fish is also going to the Sphere.
Yes.
So even if the Dead aren't playing there, we could go out to that and get our, well, you don't get the same experience, but you get the good jam band experience.
Yeah, I think it would still be an eye-opening, like a Drew Carey kind of thing at the Sphere.
Well, we want to know what the ticket prices are because obviously inflation matters.
But I'm sure you know, what are the ticket prices? It's like $1,000 to go see Fish at the Sphere, right?
Yeah, something like that. It's well, the Sphere is very expensive, but it's a worthwhile show. I will put in a plug for the Sphere.
For the actual building, you're saying?
For the building, yes. The experience of a concert.
Well, and apparently the Fish show is insane there because they really tailored everything to that venue.
They should really just do Fish and Dead back to back.
Yeah, I agree.
Over and
I
over
agree.
again.
The Dead and Company should come back. Michael McKee, their international policy and economics correspondent and resident Deadhead, coming up. To share or not to share, Wall Street Week weighs the risks and rewards of open sourcing information in the age of AI. This is Bloomberg Open Interest.
Tiger Woods built his career on focus and resilience. It's the same in business. Insperity helps you adjust and keep moving forward. Insperity, how HR matters. Learn more at insperity.com/tiger.
Wherever news and ideas meet, wherever earnings reports and saved orders intersect, the all-new Fidelity Trader Plus is there, giving you the freedom to trade how you want with your preferred tools, customized charts, and streaming data. So you can start a trade idea on one
대리님 건강
device
챙기시고 빠른 회복하시길.
and execute it on another. Meet our most powerful, consistent trading platform yet. Meet Fidelity Trader Plus.
Premium benefits anywhere you go. Unlimited, zero trading fees. 6% back in crypto. And other exclusive benefits with Level Up. Take your wealth to the next level.
Americans, they didn't choose addiction. Go to shatterproof.org/findtreatment. Watch the film No More Secrets and find out how you can get help. That's shatterproof.org/findtreatment.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? On this episode,
the goal is to expand in terms of countries, in terms of geographies, but also in terms of products, new services that we can launch in the geographies that we have presence.
Premieres December 19th, only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jumana Bersachi in Beirut, and this is Bloomberg.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Week conversation. In the age of artificial intelligence, is open sourcing information a catalyst for innovation or an opening for bad actors? David Weston sits down with AMD Chair and CEO Lisa Su to discuss what's really at stake.
Lisa Su is chair and CEO of AMD, the chip maker with hundreds of billions of dollars at stake in the development of AI. When it comes to the software that runs on their products, she and her company have made their choice in favor of open source technology, sharing where they can.
The difference with an open source or open standards is the idea that you set out a set of standards that people can follow, and then different companies can choose to implement in a different way. And the whole idea is to provide platforms that the entire ecosystem, lots and lots of developers can develop, and that you can be able to interchange sort of the best of breed from different sources.
Why is there so much passion around open? I mean, is it a matter of business or is it a matter of philosophy?
The philosophy is, do you believe that there's any one company or any one group that will have all of the best ideas in the world? Or do you believe that if you have an open ecosystem where different researchers and different groups can contribute, that you will end up with a better product overall? And philosophically, I think, from an AMD standpoint, actually, if I think about, throughout my career, I look at, sort of the different inflection points on technology. Things often start, new ideas often start in a closed environment, but when you actually think about when they get big and when, a lot of people adopt, you like to be in an open environment. And, that's philosophically. Now let's talk about the business aspects of it. The business aspects of it are, we all have to make choices of where we invest. And do you want to trust, all of your crown jewels and all of your data in a closed ecosystem that, may or may not be the most competitive at any given time, or, may have, a flaw or any of those things. Whereas, in an open ecosystem, you have choices. You can decide who is the best at any given time. You can decide, if I have my data in a cloud environment, I can easily move it to another environment. If I have my applications that are built on one chip, if there's a better chip, a few years later, you can move, quickly. That's kind of the idea of both.
What, broadly speaking, are the advantages of open? And let me throw one out. For example, in a new technology, is it more likely, all other things being equal, that the technology will develop more quickly if it's open?
I would say that the main advantage of an open ecosystem is that you can get many, many more developers on that ecosystem, and they will contribute, sort of in their special way. So, an example I can give you is, when we think about supercomputing, like the largest supercomputers in the world, we usually like to develop them on open software stacks so that researchers from all different labs can actually contribute to those applications and those learnings.
That was David Weston speaking with AMD's Lisa Su. You can catch Wall Street Week every Friday at 6 p.m. New York time. Coming up, Bloomberg's Matt Winkler says American families are getting a lump of inflation for Christmas to the tune of $1,000. He joins us next to talk about this tariff-driven increase in prices. This is Bloomberg Open Interest.
Meet the all-new Fidelity Trader Plus with your preferred tools, customized charts, and streaming data, so you can start a trade idea on one device and execute it on another. Meet our most powerful trading platform yet, Fidelity Trader Plus.
Excellence takes drive, work, perseverance. Tiger Woods brings it to the course. Insperity brings it to your business. Want to be the best? Work with the best. Insperity, how HR matters. Learn more at insperity.com/tiger.
Premium benefits anywhere you go. unlimited, zero trading fees, 6% back in crypto, and other exclusive benefits with Level Up. Take your wealth to the next level.
Let's take a look at what's ahead for markets. Next week, Tuesday, November payrolls. That's the delayed report we were talking about with Mike McKee and October retail sales. Wednesday, the latest earnings from Micron, so we'll get a read on DRAM. Thursday, we get U.S. CPI data and rate decisions from the ECB and the BOE, plus Nike and FedEx report results. At least one of those really a bellwether for the economy, or has been in the past. Finally, next Friday, we'll get a BOJ decision. Increasingly important to pay attention to that, and the University of Michigan consumer sentiment out. And sticking with the consumer, in his latest column for Bloomberg Opinion, our editor-in-chief emeritus, Matt Winkler, writes about the impact of tariffs on your holiday gifts this year, really, and next. It's going to cost $1,000 more for the average U.S. household this year. Matt joins us on set, I'm happy to say. And that cost, that increased tariff cost, is going to rise in 2026, according to the Tax Foundation, to $1,400. Why is the administration telling us something completely different?
Who knows? I mean, it's total chaos. And what's really sad about this is that while big corporations have a way of dealing with this, and we've seen that already, it's really individuals and small business. And small business is the backbone of the American economy that is getting punished. And one of the ways we see this is for example, Dallas Federal Reserve Bank does a survey of its economy. And Texas, of course, is the second largest state in the country. And business across Texas are suffering because of the tariffs in all sorts of ways. Mostly because of uncertainty, but they don't really have any recourse. And as you say, what all of us are finding out is if we buy anything, say online, that comes from somewhere else, Canada, for example, the UK, for example, in my case, we're going to find out, to our surprise, and it's really going to be unprecedented. For me, it was a shock that I get this letter from United Parcel Service. I never got a letter before from United Parcel Service, and I thought it was a scam initially. And then I see government charges, brokerage charges, and I'm thinking, what is this? And then I realized it was for a relatively minor purchase in the UK, a specialty item, happened to be, by the way, bow ties. And I find out that I'm going to pay that magic number 10, as it turns out, above and beyond what I normally would pay.
10% more.
Yeah, exactly.
And you know what? There were two things about that anecdote that I found fascinating. Number one is the obvious. It wasn't the UK exporter that was paying that bill. It's you. It's the end buyer, the consumer. And number two is that you had, for some unexplained reason, different tariffs, on each bow tie?
Yeah, it makes no sense because they were exactly the same. And, I'm teaching a course next year at a university, and I just wanted to have those ties because it's that university, to present to people. And they're all the same.
Columbia or Kenyon?
No, it's Berkeley.
Ah, okay, so a completely different. I always connect you with Kenyon because of our shared Ohio roots. In the Supreme Court, there are currently arguments about this tariff policy and whether Trump can use IEEPA to put tariffs into effect or not. One of the weird arguments I've been hearing from the administration is that if these tariffs are reversed, refunds are out of the question because that would be too complex. But as your case illustrates, it's just the importer who pays the tariff. So do you think that's a reason that we wouldn't have to pay refunds?
I have no idea how this is going to resolve itself. All I can tell you is that it's now chaos. And I can't see how, regardless of what the Supreme Court does, even if it rules that the tariffs are in fact unconstitutional, as courts have already ruled, how this gets resolved. To my benefit, your benefit, anyone's benefit. I don't see it. And, what is so sad about this, it's Americans punishing Americans.
Yeah, I mean,
that's really what it is. It's Americans punishing Americans. It's truly proud to be stupid.
That's All right, so the counter argument, Matt, I mean, not to that, but to the concern on tariffs is that markets are at all-time highs, right? Growth looks pretty solid. Unemployment may be going in the wrong direction, but still 4.4%. When does this catch up to us?
So wait a second. I think I'd have to qualify what you just said. Yes, the rich are getting richer. The most powerful are becoming more powerful. The stock market reflects that. On the other hand, if you look at where inflation is, it hasn't come down. And it would have come down had we not had these tariffs. That we were on a glide path to lower inflation in 2025 before we had the tariff imposition. So people are paying already, most Americans are paying a much higher cost than they otherwise would. Stock market doesn't really mean much to them. And the outlook is not actually favorable. You just had Fed officials say, in fact, this week, that there is a hesitancy to see lower interest rates because the tariffs have raised inflation. Another thing that you're seeing is the dollar continues to get weaker. Why are bond yields going up? Yeah, when the Fed is easing credit, bond yields are going up. Why are they going up? Because the whole outlook for the U.S. economy is becoming more precarious. And who better, by the way, to tell us that than Paul Krugman? What did he receive the 2008 Nobel Prize in economics for? Precisely this issue, tariffs and trade.
Yeah,
and he has called this an unmitigated disaster.
Well, I mean, and I think your Dallas Fed point is also important because whereas Paul Krugman is clearly a Democrat, this is a red state where they're having significant problems with these things. I highly recommend people check out your column, Matt Winkler, Editor-in-Chief Emeritus here at Bloomberg, writing on inflation for Christmas. Coming up on Monday, Kate Moore joins us from Citi, Ethan Devitt of Moneta, and the CEO of Angara. This is Open Interest.
Meet the all-new Fidelity Trader Plus with your preferred tools, customized charts, and streaming data, so you can start a trade idea on one device and execute it on another. Meet our most powerful trading platform yet, Fidelity Trader Plus.
Premium benefits anywhere you go. Unlimited, zero trading fees. 6% back in crypto. And other exclusive benefits with Level Up. Take your wealth to the next level.
There's a lot of good and bad that comes downstream from that.
I don't know if you can break down what the average person is seeing right now in terms of stuff that's AI generated versus, maybe more traditional human generated, but what's that going to look like in a year or in 5 years?
There's actually a lot of hybrid content, and too often we talk about synthetic content and organic content, and never the two shall meet. But there's a lot of content where AI is part of the workflow, right? Like you might not even know it. It might be whatever app you're using to do color correction might be using models to do so. Stamp tool in Photoshop in the old days to get rid of a pimple, those types of things. But that line is going to be more and more blurred. So it's going to be a little bit less like what is organic content and what is AI synthetic content and what the percentages are. I think there's going to be actually more in the middle than pure synthetic content for a while. But you will also see experiences that are purely AI, right? You see this in the last 2 weeks with Vibes in the Meta AI app and with Sora 2 from OpenAI. So I think you're going to see both.
Bringing you up to the minute news whenever and wherever it happens. I'm Shevrian in Seoul, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Bloomberg Tech is live from coast to coast with Caroline Hyde in New York and Ed Ludlow in San Francisco.
This is Bloomberg Tech. Coming up, Broadcom suffers a stock slide after its sales outlook, or lack of, failed to meet investors' lofty expectations.
Plus, China eyes the largest ever state-backed chip incentives, with as much as $70 billion of state money considered for the pivotal sector.
And our conversation with White House AI czar David Sachs on President Trump's executive order aimed at limiting state-level regulation of AI.
First, Ed, we check on these markets that are dictated by tech. Dictated by them. I'll re-say that word. We're off by 1.8%. Let's look at it. On the NASDAQ 100, we are under pressure as we consider not just the macro perspective and bond yields move, what's happening underneath the surface. I'm looking at the Golden Dragon Index. Look, this is showing what Chinese names trade in the US in terms of the ADRs are up to. What a dichotomy we've got going. What a juxtaposition. China higher. We'll get to that news later. US lower, and in large part it's by one key stock you're looking at.
Some breaking news. Bloomberg reporting, citing sources, that Oracle has pushed back some of the completion dates of data centers that it's developing with and for OpenAI. That pushback is to 2028 from an earlier plan of 2027. The market reacted. Look at the right-hand side of the squiggly line. It's paired some of that decline, but at one point session low well beyond 6%. I think, Cara, later in the show, we're going to get an opportunity to talk to Brody Ford, who broke that story, get more of the details. Right now, the top story is Broadcom. It is on track for its biggest decline since January of this year. A $73 billion backlog, AI specific. But what the street wanted was a very different number. During a conference call, CEO Hock Tan held off giving an annual AI revenue forecast, saying it was, quote, a moving target. Listen to this.
It's hard for me to pinpoint what 26 is going to look like precisely. So I'd rather not give you guys any guidance, and that's why we don't give you guidance, but we do give it for Q1.
Carl Ackerman, Managing Director of Semiconductors and Networking Hardware at BNP Paribas, joins us for more. His new price target, $475, among the highest now for analysts covering the stock. So that's the point. You have different sets of data. They gave us a figure which was a $73 billion backlog. Yep. This morning, quite clearly, the market would like to see a revenue number that's forward-looking.
Yep, that's true. So you're right. I think what's interesting here, the reason why Broadcom is down is not about how revenue has perhaps missed expectations. First and foremost, some of the company actually beat and raised guidance. AI sales were above expectations. The outlook for next quarter of $8.2 billion far exceeded consensus of $6.8 billion of AI sales, which doubled on a year-over-year basis. When queried, the company Hawk indicated that revenue could perhaps accelerate into fiscal 26 versus that 100% accelerated growth number. We have over $50 billion of AI sales in fiscal 25. I think the reason why the stock is down, Ed, however, is in part because there are some investors a bit worried about the margin structure of the Anthropic deal. So of that $73 billion in AI sales, $21 billion will go to Anthropic as part of a TPU system sale, and that TPU system sale is going to be lower margin than what Broadcom generates today.
It's about content. How much of the content of a server do you own beyond just the chip? But you like this name, right? Like you've just raised the price target to $475 from $385. That's correct. Right, math? Well, what is it that you like about Broadcom?
Sure. I mean, Broadcom, I think, is in a league of its own, akin to NVIDIA, really, where NVIDIA and Broadcom dominate two of the three main buckets of AI infrastructure spending. Those include compute, memory, and networking. They, of course, control two of them, networking and compute, more than anyone else. And I think what is happening here, what the investment community, I think, is overlooking today on this sell-off is the fact that Broadcom is moving toward a full solution stack akin to what NVIDIA is doing on providing AI compute and AI networking as we move to a scale-up domain, where you're going to need optical for both the for both the networking ASICs and the compute, and they offer that entire IP stack in-house, and that is what I think people are missing today.
You're calling it short-sighted, Carl. I know you don't cover NVIDIA as a name, but does Broadcom's success come at the expense of others in the market?
Thanks, Caroline. It's a good question. I think it's in a vacuum. We try and pigeonhole Broadcom versus NVIDIA, or Broadcom versus AMD, or GPUs versus custom accelerators. I think what we found out is that it is not a winner take all. It is not a singular approach. What you're seeing is that hyperscalers are adopting custom compute as well as GPUs for frontier model training. And that will continue to progress as we move toward inferencing. So it's not so clear-sighted there. I think what's important here is that Broadcom offers the full solution stack across networking and compute. And similar to NVIDIA, those are about the only two companies in all of tech, including semis, that offer that capability.
Of course, Hock Tan's very much aligned in terms of his own pay package with hitting certain revenue numbers for AI in particular. But from your perspective, is there a supply-side headache going on at the moment? We're hearing reports that Dell, for example, is having to jack up pricing because of the pricing that it's feeling on memory. More broadly, we're seeing the breaking news that Oracle's having to delay some of its data centers. There is a tussle for the infrastructure that's necessary right now. And is that just not going to happen in the overnight way that the market is anticipating?
Great question, Caroline. I think what's interesting to hear is I would like to tie in this idea that are we in a bubble of AI infrastructure? I think that's no. The answer is a definitive no. I think gigawatt capacity and announcements take time to ramp. That ramp and that qualification and filling up that fab is now extending the visibility across the entire supply chain, whether it's hard drives, whether it's memory, whether it's networking, whether it's compute. And that is giving companies like Broadcom, companies like NVIDIA, companies like everyone across the supply chain, a very long visibility. And right now, things are very tight. And so some of the areas that are the most tight in our AI ecosystem coverage include lasers for optical transceiver components. There are ways to ameliorate that tightness among the supply chain, and Hock and Broadcom announced how they have the sufficient capacity for their chips to meet the demand that they see in fiscal 26 and in fiscal 27.
Who doesn't love talking lasers? Carl Ackerman of BNP Paribas. It's been great getting your take as we do see stocks fall between the NASDAQ more broadly now under pressure of some 2%. We want to keep up the discussion that's happening between the US and China because, look, chip markets are in the eye of the storm there. China planning to pour up to $70 billion of state money into the sector, deemed pivotal to its technological conflict with the United States. Bloomberg's Maggie Eastland joins us now. And $70 billion would be an extraordinary amount of government support that we've ever seen worldwide, right?
Yes, this is a huge number. This would be, China's biggest semiconductor-specific packaging. And according to Bloomberg reporting, that number could be anywhere between, as you said, 70 billion, and it could go down to 28 billion. So it depends here. We'll see how large it is. That compares to the U.S. effort at industrial policy for semiconductors, which is $52 billion. So this is a similar scale to what the U.S. has undertaken in recent years.
Maggie, there are some questions to which we just don't have answers, and that largely relates to what China specifically will do with the funds and where they'll go. But within that Bloomberg reporting, where do we think China's going to prioritize using the funding to, which champions is it going to elevate?
Yes, so of course, China is always really looking to support its AI chip makers that compete with NVIDIA. So that includes companies like Huawei and Cambricon. But there are other chip companies, including SMIC or SMIC, which does the manufacturing. So that would be the corollary to TSMC. So there's a range of companies that could see this investment. But China will face headwinds because it still has restrictions on many of the equipment technologies and the foundries. It can't access TSMC for those advanced node chips.
You have many worrying about just what the yields are like from an SMIC, from a SMIC, when they're actually producing these homegrown, domestically made chips. But I'm looking at NVIDIA under pressure again today, Maggie. More broadly, are we getting any sense of whether this is meaning that China will say no thank you to the H200s in the same way that they did the H20s?
As you note, China has certainly never been shy about saying no to U.S. technology when they have their own local champions. But what I will say is we don't know the exact number of H200s China will accept, if any. What we do know is they're clearly not backing down on their commitment to their own chip supply chain, and they're not going to readily give way to this U.S. strategy of selling advanced AI chips in order to undermine their local competitors. So we'll have to wait and see what happens on H200s.
Bloomberg's Maggie Eastland, who's been across China's chip efforts all week long. Thank you very much. Coming up, we're going to get more on that breaking news report from Bloomberg about Oracle delaying OpenAI-specific data center project by 1 year, back to 2028. It had an impact on the markets. The NASDAQ 100 is now 2%. Actually, Caro, as of Thursday night, the state of play was the NASDAQ 100 was flat for the week, so we are now down 2% on the NASDAQ 100 on a weekly basis. Of course, the reaction to Broadcom and some other AI angst is part of what's weighing on this market, and we're going to get a lot more on that very, very soon. Stay with us. This is Bloomberg Tech.
Meet the all-new Fidelity Trader Plus with your preferred tools, customized charts, and streaming data, so you can start a trade idea on one device and execute it on another. Meet our most powerful trading platform yet, Fidelity Trader Plus.
Tiger Woods built his career on forward thinking, staying ahead of the curve and away from the expected. Insperity believes that in business, it's no different. They're dedicated to driving your business forward, providing the HR support you need to innovate and win. You don't become one of the greats by doing things the same as everyone else. You take a swing, knowing you've got the right partner by your side. Insperity, because how you HR matters.
Premium benefits anywhere you go. Unlimited, zero trading fees. 6% back in crypto. And other exclusive benefits with Level Up. Take your wealth to the next level.
Wherever it happens, I'm Lizzie Burden in Florence, Italy, and this is Bloomberg.
Okay, shares of Oracle are down almost 5%. They'd hit session lows of 6.5% decline after Bloomberg's Brody Ford broke the story that the firm will be delaying data centers for OpenAI to 2028 instead of a previously planned 2027. The reason, labor and material shortages. Bloomberg's Brody Ford runs to set and joins us now. Important reporting for you, because this is what a part of Oracle's debate is. Okay, great, you have a great backlog of business, but we are very closely monitoring the ability to execute on it and then book revenue on it. And OpenAI is a big chunk of the exposure. Fill the blanks for us. More reporting. What other details have you got?
These are unprecedented scale data centers, right? I mean, gigawatt scale data centers, unprecedented, and Oracle's trying to do effectively 5 of them at once. And so what we have today is that the initial completion dates, the initial full delivery dates, have been pushed back in some cases from 27 to 28. And, you know, I think if you've spoken with data center folks over the last couple months, it's not a huge shocker because, I mean, these are such crazy projects, right? And the idea of getting them done in 2 years was always going to be ambitious. So now getting them done by 28, it's still a tight timeline. It's still, frankly, an impressive turnaround, but it's maybe just not as quick as the company had initially hoped.
We're looking at Abilene, Texas right now, where on the conference call during earnings, we had the co-CEO, one of them, saying that they had more than 96,000 NVIDIA chips delivered, giving you the sense of scale. But is it a hindrance to what the revenue is ultimately for Oracle here? Or is it just investors having to be like, oh, it's still jammed tomorrow, not today?
Right. I mean, Oracle, I'm sure will say that as you put, they deliver these sites in chunks, right? And so Abilene is already being turned on, this massive data center in West Texas. Once you get the servers running, OpenAI uses them, that's revenue recognition, right? And so really what we're thinking about is the further out sites beyond Abilene, right? We keep seeing these Stargate announcements for Michigan and New Mexico, right? These sites which are still being kind of put together, and Oracle and other vendors too are finding that, wow, there's a lot of stuff out there that's backlogged.
Labor for one of them.
There's only so many electricians, right? I mean, you want to build in rural Texas, it's a smaller pool of people you have access to.
It's a fascinating story. It's going to run and run. Bloomberg's Brody Ford with a real market-moving bit of reporting there. Let's talk more about the market implications. We've got Margie Patel with us, Senior Portfolio Manager and Head of Capital Allocation over at Allspring Global Investments, which has $629 billion in assets under advisement. And Margie, are you worried these drip bits of information that maybe the revenue streams aren't able to be booked tomorrow? It has to be weighted out a little bit more in terms of the returns on AI investment?
No, I think the long-term trends are still in place. I actually thought that Broadcom's numbers were quite good, and people were just, I think, very nervous at the end of the year, particularly with some bad news we've seen, such as from Oracle. And I think it's really more just end-of-year jitters rather than anything fundamental. I think when you look out into 2026, you still have to like the tech sector, especially the semi, the memory, those companies. I think you still have to stick with them, that they're going to continue to be high growers. And these little hiccups we have here and there don't change the fundamental trend of very, very strong growth in a year which should be very modest growth next year. So we still like the whole sector.
So Margie, on a day where Broadcom's off by 11%, when the Nasdaq's off by 2%, is that hiccup a buying opportunity?
Well, I think it is actually, because if you look at the leading stocks that have stuck to their plan, that have great growth, great profit margins, great innovation, and they're down 10, 15, even 20% from their peaks of a few months ago. So I think that looks like a pretty attractive time to add to these names, because there's end-of-year uncertainty. A lot of short-term traders want to preserve their gains, cash out, and I think that's what you're seeing is this pressure on the sector rather than the change in the fundamentals. The cash flow, the big companies is so large, this isn't going to be derailed anytime soon. So I think next year looks pretty good sailing too.
Margie, it's good to see you. It sounds like at year end you don't personally have many jitters. One of the best read stories on the Bloomberg terminal today is about the debt and the lending that is behind the build out in that infrastructure. Where does the debt as a factor in consideration sit for you when you are tracking all sorts of different hard and soft data sets to work out what's going on here?
Well, I look at the debt as really a company's choice of how they want to allocate capital. Do they want to borrow? Do they want to increase the dividend? Do they want to do share buybacks? And particularly the large, successful companies really have no need to borrow. Even paying for the CapEx, they still have plenty of excess cash flow that they have to decide how to utilize. Whereas I think Oracle has really taken on a lot of debt compared to their cash flow. But the rest, I think, all look pretty good. It's a volatile sector, and that's why the returns are higher, because you have to be prepared for these little downdrafts in order to get the upside.
Margie, Brody's report on Oracle was very specific, that Oracle's delaying those projects by a year because of labor and material shortages. Elsewhere in the US economy, we have all the chips we need, clearly. Are we good at the other stuff, and is the other stuff where it needs to be to support this build-out?
Yes, I think it is. I think when you have this explosion in demand of these very complex centers, I think you should expect there will be short-term problems of supply and so forth. But really, it's a good problem to have rather than lack of demand or pricing pressure. And we're really seeing very strong pricing for the semis that are going into the data centers. So we think it's just nothing to worry about, and the fundamentals are still very strong.
Briefly, though, there's reports today from other outlets saying that Dell's going to have to jack up its prices because of pricing strength in memory. Are there areas of this AI trade that are overvalued that you shouldn't be piling into from a margin perspective?
Well, I think when you look at tech, it's like any other sector, is the best companies usually trade rather richly. The cheap companies usually have problems. They don't have the leading edge. They don't have the innovation. And when you look at tech, it's just, and you can see even here with the data centers and concern about what approach that companies are using, Broadcom or NVIDIA, whatever, in the new products. It's really about innovation and who are the leading innovators. And so companies that don't have that innovation are just going to fall behind. So I think this year up till, say, the summer, everything moved up, and now we're seeing a separation between the companies that have leading edge and the companies that are really falling behind and aren't going to catch up. So I think it'll be much more stock selection next year than we've had for the first part of this year.
With a message that in tech there's nothing to worry about, Margie Patel from Allspring Global Investments, great to have you back on the show. Thank you very much. Now, coming up, we're going to bring you Bloomberg's exclusive conversation with Uber's CEO on the company's international ambitions, particular focus on Asia. That's next. This is Bloomberg Tech.
Meet the all-new Fidelity Trader Plus with your preferred tools, customized charts, and streaming data, so you can start a trade idea on one device and execute it on another. Meet our most powerful trading platform yet, Fidelity Trader Plus.
Excellence takes drive, work, perseverance. Tiger Woods brings it to the course. Insperity brings it to your business. Want to be the best? Work with the best. Insperity, how HR matters. Learn more at insperity.com/tiger.
Premium benefits anywhere you go. Unlimited, zero trading fees. 6% back in crypto. And other exclusive benefits with Level Up. Take your wealth to the next level.
Opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Uber CEO Dara Khosrowshahi says the company expects to offer robotaxi services in more than 10 markets by the end of next year. He spoke with Bloomberg Tech Asia's Annabelle Drulas about why he's optimistic in particular about growth potential in Asia.
The APAC market and in particular the North Asia markets as well, they are huge growth markets for us. And if you look, for example, in the rideshare business, over 30% of our global first trips coming into the category come from the APAC region. The area is growing very quickly, including taxi as well, which is actually one of our newest products on the platform. So for me, coming here, seeing the teams, meeting with local business people and regulators, and talking about how we can be part of the future growth of the region is really what my agenda is.
Early this year, you also put out a statement on the robotaxi push as well.
Yes.
And so the Middle East and Asia were the markets for 2025
Yes.
to launch. And we've seen, of course, that initial deployment in the Middle East already. What's happening on the Asia side?
Well, lots of discussions on the Asia side. I think what's really important is to set up a regulatory framework to go forward. For example, Hong Kong has various trials and pilots going on, and in many other markets, we're talking to regulators about how we can be a part of shaping rideshare and autonomous rideshare going forward. The technology is absolutely getting there. These are the robot driver, it doesn't get tired, doesn't get distracted, and we very much look forward to working with various authorities to introduce rideshare into the markets. We're now live in 4 markets now as we speak, in the US and in the Middle East, and I expect to be in 10 plus markets by next year, and we want those markets to be in the Asia Pacific region as well.
Where then in Asia do you think is the most likely place?
We'll see. I think that certainly Japan has great potential. They
are behind on their regulation.
They are behind on their regulation, but I think that they also understand that with an aging population, there's a real need for transportation, not just in the large cities, but in the rural areas. And for example, I experienced that personally going to Kaga City, and where we have communal rideshare, and kind of took a rideshare trip and understood what the needs are there. So we're talking with various countries, regulatory authorities. I think Japan is going to be part of it. I certainly hope that Hong Kong is going to be a part of it. Australia, where we were just talking about, is a huge market for us. So we're having those dialogues, and I think that the picture will shape up over the next 2 years because the technology is definitely getting there.
Uber CEO Dara Khosrowshahi there, along with our Annabelle Drowers. Now, sticking with Uber, the company, along with DoorDash, is suing New York City to block requirements that the delivery tipping option be available at the time of checkout and set to at least 10%. The two companies argue this would worsen sticker shock for inflation-weary consumers. New tipping laws are set to become effective January 26th. Caro.
Want to watch, Ed? Meanwhile, coming up, you're reporting to watch how Rivian is replacing NVIDIA's tech in future vehicles with its own chips. From New York, from San Francisco, this is Bloomberg Tech.
Meet the all-new Fidelity Trader Plus with your preferred tools, customized charts, and streaming data, so you can start a trade idea on one device and execute it on another. Meet our most powerful trading platform yet, Fidelity Trader Plus.
You can't control the course or the competition, but you can control what you do next. Tiger Woods built his career on the ability to reset, adapt, and make the next shot count. Insperity is built to help businesses do the same. You deserve an HR partner that's there to help you thrive, no matter what comes your way. Insperity, because how you HR matters.
Premium benefits anywhere you go. Unlimited, zero trading fees. 6% back in crypto. And other exclusive benefits with Level Up. Take your wealth to the next level.
That they can do with that interactivity.
Zombie
people travel to see the world. I travel to question the forces that shape entire nations.
How is it possible?
My name is Professor Hannah Fry. I want to meet the people with unexpected stories to tell and dig up the peculiar and wonderful treasures that reveal what a country is made of.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Welcome back to Bloomberg Tech. Rivian. Take a look at its shares, up currently 16%. At one point in the session, up more than 19%, trading at its highest level since January of 2024, so its highest level in 2 years. Yesterday, it fell quite a lot after it told investors and the world its plans for autonomous driving. Rivian's plan for autonomous driving is based on two big technology bets, and we went to see them. Rivian's developed its own artificial intelligence chip for its future cars. That gamble might pave the way to fully autonomous driving. A lot of the tech world imagines a future where we don't own cars at all. We're talking about fleets of robo-taxis that are summoned through an app, maybe no steering wheel or driver controls at all. But Rivian's in the camp that does see people owning their own cars in the future and being willing to pay top dollar for a software platform that allows the car to drive itself. If this idea seems familiar, Tesla has been selling a version of it for years. Full self-driving supervised is not technically full autonomy if you read the fine print, but it can get you from point A to point B without needing to put your hands on the steering wheel. Rivian's path to autonomy is rooted in two big bets. The first, a custom AI chip developed in-house, which marks a big break from NVIDIA.
This is a RAP1 chip. It's a multi-chip module. In the middle is a Rivian-designed custom silicon surrounded by memory on two sides. The decision to build it in-house was based on a very rigorous analysis of the benefits we could come, and those benefits are velocity, or ability to get to market very quickly with it, performance, and cost.
The second, a major change in how Rivian vehicles see the world. The next generation Rivian R2 will have indented LiDAR sensors in it.
It's not just about the compute, it's also about the sensors, and it's about how they all come together.
This is Rivian Mark 1.
What the Gen 3 architecture does with compute levels that are dramatically expanded. So just to put some numbers to this, at the platform level, 1,600 sparse tops. We can process 5 billion pixels per second, beautifully integrated LiDAR. That raises the ceiling to allow us to take your eyes off the road.
This will cause some debate. Tesla vehicles only use cameras as sensors for their systems, and what Elon Musk's company has always argued is that other sensors like LiDAR or radar are too expensive to scale. Until now, Rivian didn't really have an autonomous system. It had advanced driver assistance tools powered by cameras and radar. And Rivian used NVIDIA chips as the brain in the vehicle to interpret the world around it. Rivian says its new AI model will keep improving those older cars too, eventually adding capabilities like hands-off point-to-point driving. Rivian doing its own chip and ditching NVIDIA is a surprise.
On the Rivian processor side, this represents a significant cost savings to us. There is a lot of margin, of course, in the semiconductor space, and working directly with TSMC, we have a great relationship with them.
The new hardware is the unlock. It should allow Rivian to go from that driver assistance software in its existing lineup to true autonomy in the next Gen R2.
And the next big step is personal level 4. And what I mean is the vehicle can operate empty. It can operate without anyone in the driver's seat. It can pick your kids up from school. It can drop you at the airport. It's a complete shift in how we think about the vehicle experience.
Looking back, this was the company that pulled off the 6th largest IPO in US history, and it was first to market with full-size battery electric pickups and SUVs, beating out Tesla, Ford, and General Motors. But today, Rivian's struggling with the basics. Production of its EVs hasn't really scaled. Rivian's sole plant in Illinois is capable of building 250,000 units a year, but in 2025, it probably won't hit 50,000. The truest representation of that struggle, the stock is at a fraction of its peak. Right now in the world of tech, you have to have something to say about AI, and Rivian is diving deep into autonomy to appease its investors. An AI chip, LiDAR, and a large driving model. Right now, it's a promise from Rivian that their next generation vehicles will have genuine autonomous capabilities.
Extraordinary reporting, deep dive, and Rivian, as you said, Ed, doing very well on the day, unlike the rest of the markets. Just checking what's happening to the NASDAQ. We are down on the week, we are down on the day. NASDAQ 100 off by more than 2 percentage points. Tech in the line of fire today, even dragging Chinese names now into the red. They started the trade and our show in the green as we understood that the Chinese government was going to be going all in on funding its own domestic chip supply, up to $70 billion worth of government incentives is the reporting coming out of Bloomberg News at the moment. But even China starts to dip at the moment. We see Broadcom in the red, Nvidia in the red, Palantir, Amazon, Micron, some key names currently on the downside as we have that AI bubble anxiety all over again.
Right, coming up. Actually, Caro, we're going to talk about the United Kingdom. We're going to be joined by British Business Bank CEO Lewis Taylor for his take on the UK's tech sector. He's in town, in San Francisco and Silicon Valley, to think about how technology might work across the Atlantic. That's next. This is Bloomberg Tech.
Meet the all-new Fidelity Trader Plus with your preferred tools, customized charts, and streaming data, so you can start a trade idea on one device and execute it on another. Meet our most powerful trading platform yet, Fidelity Trader Plus.
You can't control the course or the competition, but you can control what you do next. Tiger Woods built his career on the ability to reset, adapt, and make the next shot count. Insperity is built to help businesses do the same. You deserve an HR partner that's there to help you thrive, no matter what comes your way. Insperity, because how you HR matters.
Premium benefits anywhere you go. Unlimited, zero trading fees. 6% back in crypto. And other exclusive benefits with Level Up. Take your wealth to the next level.
When DeepSeek hit the App Store, it was called a Sputnik moment. Were the US and China in an AI space race? Why were the stocks of so many sectors being punished? Yes, the Chinese company had built an open source model for only $6 million. But some in Fidelity's investment division thought the market might be overreacting, and that now wasn't the time to sell.
There was a sense of urgency, but there was a lot of focus. It was some of the best work I've seen the department do.
But YouTube is crushing it. I mean, I have both.
Absolutely. But one thing YouTube has is like, I don't have to pay for YouTube. Are these real threats to Netflix?
Netflix is the luxury equivalent. Consumer product is consumer tech.
Don't miss Open Interest live weekdays.
Didn't
really think I had a problem.
I would isolate, self-medicate.
Like 48.5 million Americans, they didn't choose addiction. Go to shatterproof.org/findtreatment. Watch the film No More Secrets and find out how you can get help. That's shatterproof.org/findtreatment.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg.
The UK economy is at risk of its first quarterly contraction since Labour returned to power after growth disappointed again by shrinking ahead of Chancellor of the Exchequer Rachel Reeves's tax-raising budget. Can the UK's tech sector come to the rescue? Louis Taylor, CEO of the British Business Bank, joins us now, and it's great to have you in town, in San Francisco.
Really great to be here, Ed. Thank you very much indeed.
You have an annual budget, essentially, to invest in and lend to and support the technology industry in the United Kingdom. Why are you in San Francisco, then? What brings you here?
Why are we in San Francisco? Well, look, we're here pitching to US VCs a really great new growth opportunity for them, which is based on three things. Firstly, as you say, the quality of the UK tech industry. 4 of the top 10 universities globally producing great research with some really excellent entrepreneurs and the ability to scale businesses as well, although that's where they come in. Secondly, a new pool of capital coming on stream domestically in the UK from pension funds, hopefully. And then thirdly, the opportunity to partner with the bank, which is the biggest LP in UK venture and growth equity, connected and knowing the landscape pretty well.
Louis, the landscape we know so well is fintech. I think of Revolut, I think of Monzo, the standouts. But where else is really thriving? Where else should VC come in and support in the UK?
Well, look, I think you're absolutely right. Fintech is very strong, and just today, Go Cardless did a deal with Molly, and that a unicorn that we invested in 12 years ago. So you need a bit of patience on this. So fintech's very strong. AI in different places is very strong. Not so much on the hardware side, not so much on the large language models, but more broadly, if I think about companies like Synthesia or 11 Labs, all of those companies coming out of the UK. So I think those tech areas are great, but also the application of AI into life sciences is incredibly strong as well. And the UK has an incredibly strong life sciences industry. So I think we see AI as being a theme across the sectors of the industrial strategy the government announced, and the UK being strong in those.
To be fair, many of those companies that you named, they come on this program regularly, and they are making advancements in their respective fields. I want to go back to what you said, a big pool of money coming online. A little bit more, please.
Yeah.
How big? How certain is it?
Yeah.
And that's important, right? Because the lesson of AI in this country, at least, is the capital requirements are much bigger.
Much bigger. So the UK, we incubate companies incredibly well. We scale them less well, and we haven't had the scale-up capital we need. It's not that we don't have the money, because we have the second largest funded pension scheme in the world at around £4 trillion. But we have an allocation issue with that pension money, which is changing. The government encouraging pension funds to invest more in the domestic economy and in the growth economy. But I think what we're looking for is some of the expertise here in the VC industry in the US about scaling those companies. As I say, we incubate well, but it's that scaling stage and the expertise needed there, where of course you need capital, but you need other things as well, networks, capabilities, and many other things, mentoring of leadership teams.
Louis, what is the state of brain drain when you actually do get a really successful company? Now, 11 Labs are staying there, Synthesia is as well, but many up and leave and come to Silicon Valley or to the US. Is that something that's still happening?
Well, look, I think it does happen to an extent. I think we really want to try and address that and try and stop it and actually capture some more of the value in the UK economy. As I say, the companies have largely come over here because it's where the capital is. If we've got a new capital stream with some expertise based on it in the UK, we're going to hope to retain those companies in the UK longer. And actually, the innovation ecosystem, I think, is quite self-perpetuating. Success breeds success. We've got a lot of the right things in place, but it's just this top end that we need to really make sure that we realise more potential and keep the flywheel going.
So your strategy here, and one of the reasons you're in town, is to go to the American VCs, the Valley VCs, and say, give us your capital, come to the UK, we have something to offer. But that strategy then carries risk with what you were just talking with Caroline about, right?
Yeah, Ed, we're not quite saying that. We're saying bring us your expertise. We'll help you raise capital locally. This is a growth opportunity for you.
Raise capital locally. That's a key point of distinction.
Absolutely. And the connections that we have with all the GPs, LPs, but also the pension funds. I mean, we actually are raising our own fund at the moment for a co-invest fund in the UK from UK pension funds, and we'll do the first close end of January, early February, and this is a thing. It's a real thing.
It's a real thing, and we'll let you go out and have real conversations with those VCs in the Valley. But Louis Taylor, thanks for stopping by, CEO of the British Business Bank. Coming up, White House AI and crypto czar. David Sachs joins us to talk about the President Trump executive order on AI regulation. This is Bloomberg Tech.
Excellence takes drive, work, perseverance. Tiger Woods brings it to the course. Insperity brings it to your business. Want to be the best? Work with the best. Insperity, how HR matters. Learn more at insperity.com/tiger.
Wherever news and ideas meet, wherever earnings reports and saved orders intersect, the all-new Fidelity Trader Plus is there, giving you the freedom to trade how you want with your preferred tools, customized charts, and streaming data. So you can start a trade idea on one device and execute it on another. Meet our most powerful, consistent trading platform yet. Meet Fidelity Trader Plus.
Premium benefits anywhere you go. Unlimited, zero trading fees. 6% back in crypto. And other exclusive benefits with Level Up. Take your wealth to the next level.
And a trip down memory lane as iconic Macy's tries to restore the luster of department stores.
It's a storied retailer, but we never want our rich history to get in the way of our brighter future.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Welcome to our global radio and TV audiences. President Trump signed an executive order aimed at limiting state-level regulation of AI. The move is supported by tech leaders who have argued local rules could stifle innovation. We're joined by David Sachs, the White House AI and crypto czar, or senior advisor. David, I think it's a really good place to start. In your work with the president in consulting and advising on the formulation of this executive order, what was the problem that you were trying to solve for? And what is it that you said to the president about why this EO was the right approach to focus on state-level laws?
Well, Ed, thanks for having me. The problem that we see is that you've got 1,000 different bills going through state legislatures right now to regulate AI, and over 100 measures have already passed. Some of these bills are contradictory, and you've got 50 different states running in 50 different directions. That type of compliance regime is going to be very hard for small companies and startups, especially innovators, to comply with. And so what we need is a single federal or national framework for AI regulation, and that's what the president has supported. And by the way, he supported this for a long time. If you go back to his July speech on AI, he called for a single national framework then, And what we've done with this EO now is to make clear that that is the administration's policy and to task members of the administration to work with Congress to try and enact that framework through legislation, because ultimately this needs to be a law. And in the meantime, create tools that the administration can use to push back on examples of the most onerous and excessive state regulations.
David, there is, of course, some pushback, on the executive order from the states themselves, from other Republicans. As you know, I studied the July speech and strategy closely. A big part of it, was infrastructure related and about deregulation. The concern about this latest executive order is that while it addresses your concerns about many different pieces of state regulation, it does not provide for a single federal framework.
Well, at the end of the day, that single federal framework has to be enacted through law, and we need Congress to do that. And so the president has asked Congress to do that, and he's tasked members of the administration to work with Congress to produce that framework. In the meantime, what we've done here is articulate a set of principles. We've said what values are important to us. We said that we want to protect child safety. That's important. We want to respect copyright. We want to preserve the ability of local communities to choose what infrastructure is in their communities. We're not seeking to preempt the states in any of those areas. So this is an important set of principles that we have put forth. And at the same time, the EO provides for a number of tools that can be used to push back on excessive state regulation. And just Ed, let me just illustrate why I think this is so necessary. Because what we're really talking about here is regulation of AI models and algorithms. Well, think about how an AI model is developed. You can have developers in one state or multiple states writing the code. It can then be trained in a data center in another state. You then can have inference happen in another state, and the entire service is provided over the internet using national telecommunications infrastructure. So you're dealing there with at least 4 different states, and all of them can lay claim to regulating those AI models. And those regulations can be in contradiction with each other. Even Democrat governors have admitted this is a problem. So just the other day, Kathy Hochul, the governor of New York, it basically said that she might prefer to enact California's SB 53, which is a regulation that they just passed in California, rather than the bill that her own assembly gave her, the RAISE Act, because she sees that, wait, do we really want to create this patchwork of different regulations? So even Democrat governors are realizing this is a problem, and if they all run in different directions, then we're going to end up with a patchwork or a mishmash of regulations that are impossible for companies to comply with. What the president is calling for here is just common sense. We want to get to a single national framework of compliance as opposed to 50 states running in different directions.
Meanwhile, Kathy Hochul actually is getting a bit of criticism, perhaps, for narrowing and what some are saying is bowing down to business. David, I'm really interested in how you oppose that view, because there is anxiety in the population. AI versus jobs, AI versus energy bills. How are you giving them the sense that we haven't seen federal government and indeed now state governments just handing over the reins to big tech billionaires, as people call them?
Right. No, I understand there's a lot of fear out there about AI and job loss specifically, and a lot of those fears have been drummed up. Let me just say on the job loss question, because I think this is really important, that Yale just released a study, and it showed that in the 33 months after the launch of ChatGPT, there was no discernible disruption to the U.S. job market. None. They said no discernible disruption. And in fact, if you look right now, more jobs are being created than being lost. So this whole idea of job losses just isn't true. There was an article in the Wall Street Journal just last week talking about the construction boom that's happening, that's benefiting construction workers like electricians, like plumbers, like workers who pour concrete or hang drywall. Their wages are up 30% because of this infrastructure boom that's happening right now. And there's actually a job shortage in many of those trades, meaning we need more workers going into those trades. So what we're seeing right now is an overall AI boom that's benefiting the economy. You know, the GDP growth rate was tracking at about 4%, and half of that, up to half of it's been attributed to AI. So I just think that this narrative about job loss has been blown out of proportion. Certainly there could be job displacement in the future, but we haven't seen any of that so far. It's been quite the opposite. It's been job gains.
David, final one on the EO, if I may. You know, what this EO allows for, is it the sort of hope that it will lead to the DOJ suing states like New York and California? And if that's the case, you know, the president and the administration's confidence that you'd win them?
Well, that is one of the tools that is in the EO, is that the DOJ has been tasked to form a litigation task force that would have the ability to push back on excessively burdensome state laws, laws that may be unconstitutional, violate the First Amendment, things like that. By the way, the DOJ already had that power, so this is not a novel power. But what's being done here in this EO is we're marshaling all of the resources of the federal government behind the strategy of the president to create a national framework. Now, in terms of what laws we go after, that's a decision that has been made. We haven't decided whether California and New York should be targets in that way. The one that I think is probably the most excessive is this Colorado law that seeks to prohibit algorithmic discrimination.
Right.
What that basically says is that if an AI model has a disparate impact on a protected group, then that model is violating the law. Model developers, by the way, have no idea how to comply with this because they're not aware of all the downstream uses of their model. I mean, if a business decides to use an AI model in a hiring decision, for example, that business is already on the hook for discrimination. So how would the model developer know that it was being used in that way? But what Colorado is trying to do there is get their ideology inserted into the model. That's very concerning to us. We think there's a First Amendment issue there. But look, we haven't made any decisions in terms of how that litigation task force to be used.
David, briefly, all of this is set in the context of US versus China and are deemed to run forward on AI development. Meanwhile, it's been a busy week, and H200s might indeed be able to get to China. How many do you think you'll do in volumes? And what do you think the appetite is of China to buy NVIDIA's more sophisticated chips?
Well, it's interesting. I just saw an article that said that China was rejecting the H200. So apparently they don't want them. And I think the reason for that is they want semiconductor independence. The same way that the United States wanted to be energy independent, they want to be semiconductor independent. So they're rejecting our chips. And that's part of the calculation that goes into the decision of what we authorized to be sold to China. The U.S. policy has always been that we don't allow the leading edge chips, and we're not. This H200 chip, it was state-of-the-art a couple of years ago, but now it's been superseded by the newer Blackwell architecture and the Rubin architecture that's coming out next year. So this is now a lagging chip, not a leading chip. But what you see is China is not taking them because they want to prop up and subsidize Huawei. They want to create a national champion. And that was part of our calculation of selling not the best, but lagging chips to China, as you can take market share away from Huawei. But I think the Chinese government's figured that out, and that's why they're not allowing them.
David Sachs, we always wish we had more time. White House, AI, and crypto czar, we thank you for joining us today on the executive order and indeed on NVIDIA's H200s. That does it for this edition of Bloomberg Tech. The market is in sell-off mode, Ed, as we wrap up this week. We're down by more than 2% on the NASDAQ more broadly and indeed for the week, but really all eyes on, well, Broadcom and its numbers.
Yeah, Broadcom in the earnings context, investors wanted more. But Bloomberg reporting on Oracle is what moved the needle. Believe it or not, this is my last show of 2025. An astonishing year. And a lot of the themes in today's show are what we've been talking about all year long. Recap on the podcast. You can find it on the terminal and online. You know where to. Caro, I'll see you in 2026.
Have a great break.
Wherever news and ideas meet, wherever earnings reports and saved orders intersect, the all-new Fidelity Trader Plus is there, giving you the freedom to trade how you want with your preferred tools, customized charts, and streaming data. So you can start a trade idea on one device and execute it on another. Meet our most powerful, consistent trading platform yet. Meet Fidelity Trader Plus.
Tiger Woods built his career on forward thinking, staying ahead of the curve and away from the expected. Insperity believes that in business, it's no different. They're dedicated to driving your business forward, providing the HR support you need to innovate and win. You don't become one of the greats by doing things the same as everyone else. You take a swing, knowing you've got the right partner by your side. Insperity, because how you HR matters.
Premium benefits anywhere you go. Unlimited, zero trading fees. 6% back in crypto. And other exclusive benefits with Level Up. Take your wealth to the next level.
Tariffs. The next pool of dollars is going to our transformation.
Watch Chief Future Officer Wednesday on Bloomberg. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility. There's still room to maneuver. We do see opportunities. It allows you to increase significantly your net income.
Watch Horizon's Middle East and Africa every trading day at midnight Eastern Time, only on Bloomberg.
From New York City for our viewers worldwide, I'm Matt Miller. Bloomberg Real Yield starts right now. Coming up, the Federal Reserve cuts rates for its third consecutive time this year, despite growing dissent, while committing to purchase $40 billion of Treasury bills per month, starting today to ease short-term funding costs. And Oracle's credit risk surges to a fresh 16-year high as AI spending fatigue hits the markets. We begin, though, with the big issue, the next steps for a divided Fed.
I was hoping for a Fed that was more divided.
There could have been a lot more dissent in favor of no rate cuts.
The changing nature of the debate within the Fed itself is telling us there's going to be uncertainty.
Powell came out and really justified why there was yet another rate cut.
They really want to tell us that the base case is a hold for January.
The pause is in.
There's pretty good consensus that if they're going to move further from here, you either need to see a weakening in labor or a improvement in inflation.
There's certainly a risk here that you could see inflation that's a bit more sticky.
I think the Fed is well aware of the fact that inflation remains a very sizable problem.
If the labor market is clearly weak, the Fed's cutting a lot more than what's priced in.
So this concern that the Fed has about the weakness in the labor market, I think it's a bit overdone.
There's a risk that this data comes in much weaker than we're expecting.
The sort of volatility we get in economic surprises keeps us in this scenario.
And we don't just have divergence on takes, we have divergence in rates as well. Take a look at the 10-year yield here in blue versus the Fed funds rate in white. Since this cutting cycle began and we've come down 125 basis points, on the front end we've seen the 10-year yield actually rise to right now 418, 419. Take a look at the dots function as well, because the markets are predicting a different path than we see from the dot plot. Here in blue is Fed funds futures, and you can see we come down to between 3 and 3 1/4. Meanwhile, the dot plot doesn't get down to 3 1/4 until 2027. So there's a little bit of tension there. Tension in the Fed's dual mandate only hardening, growing dissents at the central bank, leaving Fed Chair Jay Powell caught in a balancing act.
There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. It's a close call. We have to make decisions, and we always hope that the data will give us a clear read. But in this situation, you have competing. If you look through the SEP, you'll see that a very large number of participants agree that risks are to the upside for unemployment and to the upside for inflation. So what do? You've got one tool. You can't do two things at once.
Let's dig into all of this with our roundtable. With us today is Mike Kontopoulos, the Deputy CIO at Richard Bernstein Advisors, and Alexander Wolf, the Global Head of Macro and Fixed Income Strategy at JP Morgan Private Bank. I'd love to start with your take on what we heard from Powell and the Fed yesterday. Alex, I'll start with you. What did you think?
So I think they were pretty clear that for a further cut, we need to see weakness in the labor market. They will respond to weakness in the labor market, and they've signaled somewhat of an extended pause. They are facing a difficult balancing act, as we heard from a number of guests on the show, where inflation is still sitting above their target, as everyone widely knows, but we've also seen weakening in the labor market. It's not clear exactly, is that going to weaken further, or will we see it rebound next year? We think it will rebound. At the same time, this is what makes it complicated, is that a lot of the inflation that we're seeing is really tariff-induced, tariff-driven. So that should fade into next year. Even the St. Louis Fed showed that tariffs are probably contributing about 0.5 percentage points to inflation right now. So you could actually see both at the same time, where the labor market improves slightly, but inflation comes down, still allowing for more cuts. We do still expect one more cut next year. Timing is less certain, though. It'll depend how data shapes up.
So only one more cut, but you think the labor market can improve while inflation comes down. That's good news. Mike, what do you think?
You know, I think there's some truth to everything Alex just said. But at the end of the day, I'm not really certain as to why the Fed is cutting to begin with. You know, you had over 17% year-on-year earnings growth in Q3. You have inflation that is 3% and bottomed in April. You have jobless claims that are very, very healthy. Maybe you can make the argument that the labor market is weakening, but it certainly isn't weak. But I think what many forget is, what is the purpose of monetary policy? Like, why cut or raise interest rates anyway? Is to affect the lending channels, and yet spreads are at all-time narrow levels, and you have no problem getting credit anywhere in the country. And so I'm not really sure what the logic is to cutting here. I think if Alex is right and employment ends up being stronger in 2026, and the Fed, with this latest cut and maybe one more next year, you likely see higher inflation, not low inflation, as growth would reaccelerate. So I think the market's reaction has been very rational. It's very similar to what we saw last year when the Fed cut interest rates. You're cutting rates, you're juicing inflation, you're juicing growth, steeper yield curve, and higher long-end yields, and that's what we're seeing.
Mike, what do you expect as far as rate cuts in 26? Because Alex expects only one, and I know that you think we could see inflation rise. So normally I would take away from that the possibility of one or no rate cuts, but President Trump is putting in his yesist yes man as the chair of the Fed, and there's talk about trying to potentially get rid of the regional Fed presidents and replace them as well. So isn't this Fed going to be one that wants to cut regardless of what we see in the data?
I don't worry too much about that, Matt, because at the end of the day, I think the markets will do the Fed's job. If you cut interest rates at a time when inflation's going higher and growth is accelerating, rates aren't going to go down. They're going to achieve the exact opposite of what the administration wants, which is lower interest rates in the long end, lower mortgage rates to juice housing, et cetera. And so I don't worry too much about what's happening within Fed leadership, because I think the market will punish them if they make a mistake. With that said, I think it's highly improbable that this Fed is going to all of a sudden defer to whoever the Fed chair is without putting up a fight. And at the end of the day, the Fed chair's job is to represent the committee, not his own views. And so it's not something that that concerns me too much.
All right, well, we did get the Federal Reserve Board of Governors unanimously reappointing 11 of the central bank's regional presidents to new 5-year terms. Nonetheless, Scott Bessent has said he wants these governors or these Fed presidents to live in their districts for 3 years, which a lot of them don't. It does seem like this administration wants to take control of the Federal Reserve. Does it bother you at all, Alex?
We definitely see it as a risk. It's a concern if we were to see a loss of Fed independence, certainly, because you would see longer dated yields rise, and that is a key part of the policymaking institution is Federal Reserve independence. We're not, similar to Mike, we're not that concerned. I think the governors that have been reappointed is a good sign, and as Mike said, replacing Powell is just one seat, and that's unlikely to have a broad influence over the overall committee. It's just one voting member. And we're generally still viewing the Fed as one that can independently pursue its mandate. And it's also not new. We've seen administrations through modern history want to exercise more control over the Fed, and throughout that, if you go back to Nixon even, throughout that, the Fed has been able to independently set monetary policy. And so, yes, it's definitely a risk, I think, to keep an eye on, but we're not that concerned about it getting much worse.
Fixed income has had a great year. Where do you put the incremental dollar, though? When your client wants to invest more money, what are you buying right now?
Within fixed income or overall?
Well, within fixed income.
Within fixed income, so we still like higher grade credit. So we still like investment grade. We've seen spreads tighten across the board. We think they've tightened probably a bit too much in high yield. In investment grade, they've certainly tightened, but we're still okay with the all-in yield. We're broadly still okay with just earning carry. We don't see spreads tightening much further, but we think the all-in yield is okay. We also like corporate hybrids. It's a much bigger market in Europe, more deeper, more liquid, more issuers. We see that market growing in the U.S., and so you're getting extended credit-like returns from investment-grade issuers, and you're just moving out the capital structure instead of moving out the risk structure. So we have been more focused for going into next year on hybrids as well.
Mike, what do you do with new money right now? Where do you put it in fixed income?
Well, it wouldn't be a fun show if I only agreed with Alex. So I would take the exact opposite view on investment grade corporate credit. From my perspective, I'm not sure what the upside to owning credit risk is here. When you can own, munis or agency mortgage-backed securities with similar, if not better, yield, with a government guarantee, with the backing of tax receipts, and more spread tightening potential relative to historic lows in mortgages, say, than investment-grade corporates. So, the path to hell is paved with carry. Don't like carry trades, and so for us, it's mortgages and munis here.
Mike, great having you with us. Thanks so much for joining us. Mike Kontopoulos of Richard Bernstein Advisors. And Alex, just before I let you go, you intrigued me with that. Where would you put money overall or just fixed income? Do you have other ideas that you like better?
Well, if you're thinking from a multi-asset perspective, it depends, again, what your risk return profile is or your return expectations, but certainly we still like equities. I think given our growth view and our earnings expectation view and given where spreads are, fixed income absolutely has a role in a portfolio. But the reason I ask is we still certainly see upside to equities from here.
Yeah, you're not alone in that bullish take. Alexander Wolf from JP Morgan Private Bank. Up next, the auction block, Oracle credit risk rises alongside the slide of its stock. We'll discuss the state of credit as fears grow around the financing of the AI data center boom. This is Real Yield on Bloomberg.
Meet the all-new Fidelity Trader Plus with your preferred tools, customized charts, and streaming data, so you can start a trade idea on one device and execute it on another. Meet our most powerful trading platform yet, Fidelity Trader Plus.
Excellence takes drive, work, perseverance. Tiger Woods brings it to the course. Insperity brings it to your business. Want to be the best? Work with the best. Insperity, how HR matters. Learn more at insperity.com/tiger.
익스요공님 멤버십 가입 환영합니다.
Premium benefits anywhere you go. Unlimited, zero trading fees. 6% back in crypto. And other exclusive benefits with Level Up. Take your wealth to the next level.
This week, Glenn Hubbard on this week's Fed Decision. Lisa Su of AMD on the open source approach to AI and why it matters. Going nuclear to get all that power data centers need. And a trip down memory lane as iconic Macy's tries to restore the luster of department stores.
It's a storied retailer, but we never want our rich history to get in the way of our brighter future.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
I'm Matt Miller. This is Bloomberg Real Yield. Time now for the auction block, where we highlight the debt sales of the week. And we start with sovereigns and U.S. Treasury auctions. We had 3, 10, and 30-year sales this week. All three came in with expected yields and saw demand near recent averages. Over in U.S. high grade, after a hot start to the month, sales cooled a bit this week with only $4.7 billion sold. December's issuance is now about a quarter below that for all of December of 2024, but still above average. And the strong pace of sales in high yield was able to be maintained. We are now looking at a December bond sales of more than $20 billion for only the second time in 6 years, making this the busiest December since 2020. Sticking with credit when it comes to hyperscalers like Oracle, Victor Koshlo, the founder of Strategic Value Partners, says there will be more pressure on spreads as these borrowers finance the rollout of AI, while Oaktree co-chair Howard Marks still sees a healthy market.
Spreads can blow out to 600, 800, 900 over. And that's sort of what happens when in a recession. I don't think we're in a recession in the next year or two. Don't get the wrong idea.
Some of the greatest moments that I've seen, some of the greatest signals of danger in the markets have been when people were not applying any prudence at all, like in 06. And this market seems healthier than the 2000 market.
The hyperscalers are coming to borrow in the high yield. The amount of supply is just going to increase a lot. I think, to our point of view, the pressure on spreads is likely to go up, barring a recession. And those spreads will have to kind of widen.
Joining us now for our credit roundtable, Amanda Lynham, head of macro credit research at BlackRock, and Maureen O'Connor, global head of high-grade debt syndicate, Wells Fargo Corporate and Investment Banks. Welcome. Thanks so much for joining us. Let's start with issuance, Maureen, because there's been a lot, and I guess we should expect even more if these CapEx plans are to be financed. How do you expect this to turn out?
You're absolutely right. We had a huge year already this year, just under $1.7 trillion in investment grade supply, and we are anticipating about 10 to 15% year-over-year growth next year. Will be a record year for primary volumes in 2026, somewhere in around 1.85, 1.9 trillion of supply. Biggest drivers behind that, actually, the biggest one is the probably the one that people don't want to talk about. It's just that we have elevated maturities. We have $900 billion of maturities coming due in 2026 that will just need to be refinanced. So that's going to be a tailwind for issuance. On top of that, we are expecting a tailwind in M&A supply as well, something like 25% year-over-year growth in terms of debt-financed M&A. Pretty healthy pipeline, obviously, in the last couple of weeks in particular. But clearly, it's all about CapEx expansion right now, and what do the hyperscalers do in terms of unsecured debt financing next year. Tech supply this year was up 70% year-over-year. We're expecting that number to nearly double next year. So there will be some large benchmark supply coming through our market. But I think the balance here is that most of these names are amongst our highest quality credits, right? These are low net debt, highly cash flow generative companies, AA rated for the most part. They have a lot of room to expand their debt footprint in our market before we really meet a saturation point. So I think there'll be some interesting sector dispersions next year, but our market can absorb the supply and is well set up to do so.
Yeah, I don't think there's a problem with multi-trillion-dollar companies issuing a couple tens of billions of dollars of debt, right? And on the demand side, there's cash that needs to be put to work, right? I mean,
Absolutely.
So that's going to keep spreads tight.
Absolutely, and what we've seen, the experience from 2025 and even going back to 2024, is that periods of spread widening ultimately have proved short-lived. And so really what we expect for 2026 is a pretty constructive backdrop. It's going to be full of dispersion across sectors, even within sectors, across parts of the asset class, but we're not anticipating widespread market disruption. And I think probably the one thing that will tweak on the margin for 2026 is that we're really leaning in more to this idea that if you're allocating to credit, you should be allocating for carry and income and yield, not because there's room for spreads to move tighter because they're already quite tight, and actually not because we think intermediate or long end interest rates are going that much lower. So don't rely on that potential total return boost from tighter spreads or lower rates, but still have a compelling yield opportunity in corporate credit.
Can I just ask in terms of issuance, I'm not, yield is not my day job, right? I'm an equities guy, so I'm not as smart as the two of you. you. But when I hear something like the Fed is going to start buying $40 billion a month worth of bills, I start thinking, like, where's the line between, managing reserves and quantitative easing? Is that going to stay on that trade? How does it look? How does the Federal Reserve balance sheet look to you, and how much do we need to be issuing?
Well, I mean, I think the Federal Reserve is going to continue to support short-term funding, right? And I think they delivered on a promise that they probably were maybe a little bit late on at this most recent Fed meeting. I think the bigger question is, what does the shape of the curve look like next year if the Fed is continuing to support short-term rates, if we potentially see a more politicized Fed and more cuts next year than what the market's anticipating, and long-end yields do remain elevated, which is indeed our call as well. What does that do to the overall landscape for just risk appetite more broadly as the curve gets steeper? For now, it's been a strong demand technical in my market. As Amanda rightly points out, the yield buyer is the predominant buyer of credit right now. We did actually have a healthy total return year, about 7% for the asset class, which in IG terms is a pretty big number. But in the end of the day, yields are still screening very attractive from a historical perspective, even though spread valuations are quite rich. So we agree with the thesis that spreads are likely to remain somewhat range-bound, maybe even pressure a little bit wider based on some of the supply dynamics we discussed, but that the yield buyer will keep a lid on how much wider spreads can really go next year.
So from a strategy perspective, or from the Fed's perspective, even, if that's the case, if the curve gets steeper, and I don't know if you agree with Maureen.
Yeah, we do.
If yields at the longer end are going to remain high, even though the Fed is cutting lower, what are they helping?
Well, I think first and foremost, I think what we're most focused on is what are the depths and the drivers of this Fed rate cutting cycle if it persists into 2026. For most of 2025, we've been of the view that the Fed is really in a normalization cycle, not an easing cycle. So I think that's first and foremost, that maybe there's one more cut left in 2026 if the labor market stabilizes. And I think that's much more important, I think, from our view, because that will determine whether risk premia gets added back to credit markets. If the Fed is cutting because the labor market has shown real signs of deterioration, and we'll look to the data on Tuesday for that, then you should expect wider spreads and lower equities. I think getting back to your point, Matt, a steeper yield curve is in some ways a normalization, right? We were in this flat yield curve environment for a long period of time. And I think incremental relief for floating rate borrowers has had an impact on the market. The Fed's delivered 175 basis points of cuts. As a result, we've seen interest coverage and fixed charge coverage in the private credit market improve for 6 consecutive quarters. You've seen similar improvement in the leveraged loan market. There are vast cohorts of the consumer base, especially lower income with floating rate debt, that will benefit from that. So I think, it's parsing the different areas of the economy and recognizing that they can't all be serviced with the blunt instrument of Fed rate cuts. But for sure, there are nuances on the credit spectrum. But I think from a broader perspective, doesn't become disorderly has actually been a net tailwind for credit demand.
By the way, Maureen, will we see issuance from companies that see CDS, what looks like big jumps, even if they're still low absolute numbers?
Well, so I think you have to kind of bifurcate the two markets. The CDS market can be driven by a number of different factors, including how banks hedge their risk. These obviously were big capital providers to a lot of the names that you're probably alluding to there. The answer is yes, there is still access. Our market is quite efficient at pricing risk and supply overhang. I would equate it back to when you saw the big 6 U.S. banks during the TLAC expansion years, that kind of 2016 to 2019 cycle, where you saw the debt footprints of these big U.S. GSIB banks expand pretty dramatically. The net result of that was that spreads trended wider in those names relative to the index, but these companies still efficiently fund in our market on a quarterly basis post-earnings, and we would expect the same for a lot of these technology companies where you're seeing a little bit of noise in the CDS. Obviously, there are some names that have fared better than others, but for the most part, again, these are high-quality credits with unfettered access to our market, and it doesn't all have to come in dollars either, right? You've seen some cross-currency transactions. I would expect to see more of that as well next year. But there's other capital market solutions as well, ABS, CMBS, bank solutions, other private credit solutions, including some of these sponsor-backed structures. So I think it's going to take all forms next year, not necessarily just about unsecured bond issuance.
Amanda, I work with Danny Berger. She talks with all the private markets people, right? So there's a lot of cockroach conversations. Just 10 seconds. Are you concerned at all about private credit?
No, we're not. I would say aggregate fundamentals look pretty solid, but just like liquid credit, there's a significant amount of dispersion under the surface, and we expect that trend to be evident next year.
All right, excellent. Thanks so much to both of you for joining us. Amanda Lynham of BlackRock and Maureen O'Connor of Wells Fargo. Still ahead, the final spread, the week ahead, a massive global data dump heading into the final full trading week of the year. This is Real Yield on Bloomberg.
Meet the all-new Fidelity Trader Plus with your preferred tools, customized charts, and streaming data, so you can start a trade idea on one device and execute it on another. Meet our most powerful trading platform yet, Fidelity Trader Plus.
You can't control the course or the competition, but you can control what you do next. Tiger Woods built his career on the ability to reset, adapt, and make the next shot count. Insperity is built to help businesses do the same. You deserve an HR partner that's there to help you thrive, no matter what comes your way. Insperity, because how you HR matters.
Premium benefits anywhere you go. Unlimited, zero trading fees. 6% back in crypto. And other exclusive benefits with Level Up. Take your wealth to the next level.
I'm Matt Miller. This is Bloomberg Real Yield. Time now for the final spread, the week ahead. Coming up Monday, Fed speak from Myron and Williams. Plus, we'll get a host of economic data out of China. Tuesday, the much anticipated November U.S. jobs report, bit delayed. Plus, retail sales and the U.K. jobs report. Wednesday, a slew of data out of Europe. Japanese trade figures, plus earnings from Micron and General Mills. Thursday, U.S. CPI and jobless claims, rate decisions from the BOE and ECB, and earnings from Nike and FedEx. And then Friday, Putin's year-end news conference and a Bank of Japan rate decision from New York. That does it. From us, same time, same place, next week.
Meet the all-new Fidelity Trader Plus with your preferred tools, customized charts, and streaming data, so you can start a trade idea on one device and execute it on another. Meet our most powerful trading platform yet, Fidelity Trader Plus.
Tiger Woods built his career on forward thinking, staying ahead of the curve and away from the expected. Insperity believes that in business, it's no different. They're dedicated to driving your business forward, providing the HR support you need to innovate and win. You don't become one of the greats by doing things the same as everyone else. You take a swing, knowing you've got the right partner by your side. Insperity, because how you HR matters.
Premium benefits anywhere you go. Unlimited zero trading fees. 6% back in crypto. And other exclusive benefits with Level Up. Take your wealth to the next level.
A lot of our inspirations for new features comes from experiences in our own daily life.
The other day, I needed to double check an important meeting schedule by finding a specific call recording. Thankfully, with call summarization feature on my Galaxy, I could quickly find it.
Our users ask complex questions, and our model has to be able to speak multiple languages. What seems impossible now can quickly become possible.
What happened? Some bad people tried to hack me with sad affirmations.
Sad, Craig?
No. We're protected. AT&T Dynamic Defense help protect us because small businesses need us.
So he's not sad. Guess we don't need these.
I think we do.
Day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Welcome to Bloomberg Markets. I'm Matt Miller. Let's get a quick check on the markets right now with the S&P down more than 1%. Of course, yesterday we closed at an all-time high, 69.01. Now we've lost 76, 77 points of that, down at 68.24. The NASDAQ off almost 2% as the tech stocks fall harder, led down by Broadcom. You can see it's off 467 points to 25,215. The VIX is up, but still at 16 handle, 1688, so we're not freaking out yet. And the 10-year yield is up about 3 basis points, even after a cut at 418.60. So the 10-year yield holding steady at these levels. Let's highlight a couple of individual movers. For that, we go to Bloomberg's Emily Grafeo. And Emily, let's talk first about Broadcom. What happened there?
Yeah, it's the biggest decline in that stock since April. The chip company's sales outlook for AI computing revenue missed expectations, down about 11% right now. The company has $73 billion in AI product orders that will be shipped over the next 6 quarters. Investors here seeing that that's a backlog that they were disappointed in. Oracle shares are also lower after a Bloomberg report that the company has pushed back completion dates for some data centers that it's developing for OpenAI, pushed back those dates to 2028 from 2027. The report was due to people familiar who also said that the delays are largely due to labor and material shortages. So we have that stock down about 5.3%. We're going to end on a high note, though, Matt. Rivian shares soaring right now, up about 9%, highest level since January after the company unveiled its own AI chip designed to replace NVIDIA tech as part of a broader push that the EV company has right now to enhance its automated driving features in future vehicles, Matt.
All right, highest level since January. Absolutely fascinating. Emily, thanks very much. Bloomberg's Emily Grafeo there. Bloomberg Tech co-anchor Ed Ludlow actually spoke with the CEO of Rivian, RJ Scaringe, ahead of that big announcement yesterday. Scaringe gave his view about whether the AI hardware will eventually enable in Rivian vehicles.
The way we'll launch eyes off is it won't be eyes off everywhere. First, it'll be eyes off on highway, and that'll be coming after point-to-point. So that'll be in the 27 timeframe. And we'll expand eyes off highway to eyes off everywhere. And then the next big step is personal level 4. And what I mean by personal level 4 is the vehicle can operate empty. It can operate without anyone in the driver's seat. It can pick your kids up from school. It can drop you at the airport. It can go between houses. So it's a complete shift in how we think about the vehicle experience. But that's enabled by this very high level of compute we have in the vehicle, this very large driving model that we're building, and of course the enhanced perception platform.
For more on this, we're joined by Ed Ludlow. He had early access to a new Rivian self-driving model. So first off, give me your review of that car.
Yeah, I mean, it's very distant from what Tesla's full self-driving supervised can already do. You know, I drive hundreds of miles a week using FSD in my own Tesla. I start at home, I put the address of Bloomberg in San Francisco in, press start, it gets me there with my hands off the wheel, but eyes on the road, right? Because there's attention monitoring. Rivian is so far from that. And it was so interesting, like Emily Grafeo, Bloomberg's Emily Grafeo showed us that 2-day chart of Rivian. So it's up 9% over 2 days. But investors reacted really negatively yesterday, Thursday, when all this news actually came out, and it's now up today 17%, because it took time to understand that directionally, like, Rivian is on the right track is the consensus from investors. But in that answer that you just played from RJ Scaringe, clearly it's drip by drip, and that they're still a few years away from anything that you would call real autonomy.
I mean, she said that the shares are at the best level since January.
2024.
2024,
so
exactly.
Yeah.
So the best
Yeah.
in 2 years. It's actually doing rather well. And to me, it's fascinating, Ed, because I hear about Rivian from you all the time, and they don't really plan to produce many more cars this year than they did last year or next year than they did this year, right? We're still just looking at 50,000 vehicles a year.
Yeah.
Where else is the business growing? Why are investors rewarding them?
So this is why the whole autonomy situation was utterly confusing. The AI chip that they've developed in-house is impressive. It has performance specs, and if we believe Rivian, it's going to save a lot of money per vehicle versus using a chip from NVIDIA. But it's going into the R2, which is their next mass market car. The confusing bit is it won't go into the R2 straight away. So they're basically going to build thousands of R2s that have older generations of chip and no LiDAR. And then at some point, which they haven't specified, start adding their own chips and LiDAR. And that hardware is what's going to allow for this like genuine level of autonomy. And investors over a 24-hour period have kind of looked at this and been like, huh? We don't understand. So there's going to be your sort of more niche products, R1 pickup and SUV, where there's only 40,000 or 50,000 in existence anyway on public roads that will have limited capabilities. But in the future, your other car, which you say will be a mass market vehicle, will have much higher capabilities. You're just waiting to install the hardware. That is literally the explanation. But the consensus is directionally doing your own chip, doing your own large driving model, a foundation model for it, and adding LiDAR, it will get them there in the end.
Right, and contract work for others like Amazon, and working with Volkswagen on the Scout, which looks a lot like a Rivian R1.
It does.
So I think it's just a fascinating story, and I'm glad you're on top of it, Ed. Ed Ludlow there, co-anchor of Bloomberg Tech. Sticking with autos, as U.S. car prices rise, China is facing the opposite problem. China's market regulator has issued new draft guidelines aimed at stopping automakers from pricing vehicles too cheaply to curb the cutthroat competition going on there. For more on this discussion, let's bring in Bloomberg's autos reporter Keith Naughton. So Keith, this is a problem I would say that we wish we had, but we really don't, right? Because Ford and GM don't ever want to be in the situation where they're just throwing incentives at the customer and trying to take market share from each other in this way.
Yeah, what drives this problem, Matt, is that China has capacity to build 55 million cars a year, and the industry is using less than half that. So they're trying to keep the factories running by cutting prices to below what it costs to build the vehicles. And that's what the Chinese regulators are trying to stamp out with this proposal that says if you price your car below what it costs to build it, you face significant legal risks.
So, what is the option then for these Chinese automakers? I imagine, and I'm just thinking about this because of the Mexico tariffs that went on yesterday or were announced yesterday, they're going to start trying to invade other territories. When are we going to start seeing BYD Seagulls, on the road in Cabo?
Yeah, well, that is the issue, is that with all this overcapacity, China has to send their cars somewhere because the market can't absorb 55 million vehicles, nowhere near it. So that's creating tensions with trading partners. As you know, here in the United States, there are 100% tariffs on Chinese electric vehicles, so they're not essentially in this market. So this is part of what the Chinese government is trying to control. They want to reduce the tension, and they want, particularly it's the lower, smaller players in China who are guilty of this. BYD, for example, supports these price controls because their factories are running near 90% capacity. They don't have this problem. It's really the smaller players. There are 130 players in China selling, new energy vehicles, EVs and plug-in hybrids. And Alex Partners thinks that's going to shrink to about 12 by 2030.
Keith, what about in the U.S.? Just got 20 seconds here, but I'm increasingly looking at what I would consider to be middle-class cars for, normal families in the Midwest to buy that are priced at six figures.
Yeah, it's really crazy when the average price of a car in the United States is over $50,000, which is luxury pricing. And you add on extras, and all of a sudden you're in six figures, Matt. We have runaway inflation in car pricing here in the United States, which is, of course, why Congress is going to start looking into this with the hearing that's coming up in January.
Yeah, all I want is, a pickup truck with a factory lift and a supercharged V8. I'm not asking for so much. Keith, thank you so much for joining us. Keith Naughton covers autos for us out of Motown. Another big story this week was on the tech front. Perhaps unlikely partnership has started between the two of the world's leaders in media and AI. In his latest column for Bloomberg Opinion, our next guest writes, quote, "Bob Iger, you crafty fox." That's all I could think as I watched the Walt Disney CEO talk about his company's blockbuster deal with OpenAI. OpenAI is going to license the use of 200 or so beloved characters like Mickey Mouse and Cinderella to be remixed with the Sora generative AI video app. Disney, meanwhile, has agreed to take a $1 billion stake in OpenAI. For more on this story, let's get to Bloomberg Opinion. U.S. tech columnist Dave Lee. So, Dave, you think this was a masterstroke by Bob Iger. Why?
Yes, I do. I think this is Bob Iger essentially standing up for the value of Disney's intellectual property. I mean, this is a company that's been storytelling for, a century. They've been breaking new ground in animation for, as long as that time as well. And when you think of this sort of the broader question on, the creative industries and the AI, many in the AI business think they should just be able to use this material for free and let people remix it. And when you do that with text, there's a debate over whether the text is sort of new text, a new product. But when it comes to images, when someone creates Mickey Mouse hanging out with your friend, it's clearly an infringement on Disney's, on the stuff that Disney owns. And so I think what Bob Iger has done is really set something of a precedent for how these companies should interact with the creative industries. And I think other owners of IP are going to be looking at this and saying, I wonder what deal we can get from this now. So I think it's a very sort of bold move from Disney.
By the way, Dave, I got this totally wrong when I was just looking at the headlines of the deal announced yesterday morning. I thought, wow, Disney's going to pay OpenAI. And usually you would see OpenAI paying Disney to use Mickey Mouse and Moana and, Elsa and whoever else, the Star Wars characters. But that actually is going to happen, I learned from reading your column, right? So yes. Disney takes this billion-dollar equity stake in OpenAI, but OpenAI is still going to have to pay license fees to use all these characters, right?
Yeah, that's our understanding so far. And also one of the interesting things that Bob Iger mentioned yesterday is that this is only exclusive for a short amount of time, around a year. They didn't quite specify exactly how long, but about a year. So after that, presumably Disney might be looking at this and thinking, oh, well, great, we can, maybe make deals with other AI companies. And at the same time, they also sent a letter to Google, a cease and desist letter to Google saying, obviously they clearly hadn't made a deal with them. So that was the consequences of not making a deal, I guess. For Disney, what's also interesting is that the deal allows them to put some of this Sora technology into its own product. So in the Disney Plus app, there's going to be a place, and they're still working out the details here, but there's going to be a place where you can remix those characters within Disney's own product, which in a way is perhaps the bigger opportunity because the Sora app, let's not forget, it's not meant to be used by children. There's an age limit of 13 and above. So if you're thinking of all those kids that want to, make a video of Elsa from Frozen or any of those loved characters, I think they're more likely to be doing that within the Disney app, right? So I think that's another reason why I think this is such a sort of smart move from Bob Iger. The stake is another big part of this because I think what they're saying there is we want to get that because this could be a long-term thing and it gives them a holding in, the most valuable private AI company in the world.
Dave, awesome stuff. Thank you so much for joining us. Bloomberg Opinion's U.S. tech columnist, though obviously he's not from the U.S. originally. Dave Lee, writing about technology in America. Coming up, Lululemon is rising as its longtime CEO Calvin McDonald leaves. And the retailer also raised its outlook. We'll bring you more details on that story next. This is Bloomberg.
Shell Group, 100% of our industrial water will be reused or recycled in our plants by 2030. This is how we create the beauty that moves the world.
Wherever news and ideas meet, wherever earnings reports and saved orders intersect, the all-new Fidelity Trader Plus is there, giving you the freedom to trade how you want with your preferred tools, customized charts, and streaming data. So you can start a trade idea on one device and execute it on another. Meet our most powerful, consistent trading platform yet. Meet Fidelity Trader Plus.
You can't control the course or the competition, but you can control what you do next. Tiger Woods built his career on the ability to reset, adapt, and make the next shot count. Insperity is built to help businesses do the same. You deserve an HR partner that's there to help you thrive, no matter what comes your way. Insperity, because how you HR matters.
Premium benefits anywhere you go. Unlimited, zero trading fees. 6% back in crypto. And other exclusive benefits with Level Up. Take your wealth to the next level.
I'm Romain Bostic, and this is The Close.
Every weekday from 3 to 5 Eastern.
Only on Bloomberg. Context changes everything.
This is Bloomberg Markets. I'm Matt Miller. Time now for the stock of the hour. Lululemon shares are surging, on pace for the company's biggest gain since May. Lululemon boosting its full-year outlook and announcing that its CEO would step down after a period of sluggish growth. For more on the story, let's bring in Bloomberg Intelligence's Geetha Ranganathan. And Geetha, I recently spoke with the head of Tanger Outlet, Stephen Yaloff, and he said Lululemon's doing great there, but those are the outlet malls, right? And as I understand it, the problem is this company, these products aren't getting the premium that you see now some other sort of luxury yoga pant makers able to demand. Is that the case?
Yes, Poonam Goyal here. So what we see here is that Lululemon is really drowning because it hasn't had the product innovation that it should have and what it's expected to have. The quarter's results were better on international strength, but if you look behind the covers, the underlying trends are still very weak. They called out a slower start to the fourth quarter. They said the weakest month of the third quarter was October, so things aren't getting better. The silver lining is new leadership in 2026.
All right, first of all, let me apologize, Poonam, because it said Geetha Ranganathan in the prompter, and I know who you are, but I'm Ron Burgundy, essentially. So let me ask you about the holiday sales forecast, because it was better than expected. If this CEO isn't impressing, what is happening what is going right at Lululemon?
So there's two things that you could argue are going right. They are trying to improve the product pipeline, but we won't see that until spring of 2026. In terms of the holiday forecast, what you saw was that the full year guide was raised, but that was raised because of the beat that they saw in 3Q, which was driven by international. When you look at the fourth quarter guidance, it was actually not that great. So we do see continuing softness in the fourth quarter. And in all honesty, 2026, I think, there's still a lot of work to be done. Competition isn't giving up. The gap between what Lululemon provides to their customers and what its competitors like Alo and Biore provide are narrowing.
All right, Poonam, thanks very much. Sorry to cut you short. We're running up against the clock here. Poonam Goyal there with Bloomberg Intelligence. She, of course, covers these retail names. Coming up, the crypto company BitGo gets conditional approval to become a federally chartered bank, opening the door to nationwide regulated services. BitGo founder and CEO Mike Belshi joins us next. This is Bloomberg.
The all-new Fidelity Trader Plus with your preferred tools, customized charts, and streaming data, so you can start a trade idea on one device and execute it on another. Meet our most powerful trading platform yet, Fidelity Trader Plus.
Excellence takes drive, work, perseverance. Tiger Woods brings it to the course. Insperity brings it to your business. Want to be the best? Work with the best. Insperity, how you HR matters. Learn more at insperity.com/tiger.
Premium benefits anywhere you go. Unlimited, zero trading fees. 6% back in crypto. And other exclusive benefits with Level Up. Take your wealth to the next level.
Is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg Television. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
This is Bloomberg Markets. I'm Matt Miller. BitGo has received conditional approval from the Office of the Comptroller of the Currency to convert its South Dakota Trust Company into a federally chartered national trust bank. Joining us now is Mike Belshi. He's the CEO and co-founder of BitGo. And Mike, I guess congratulations, first of all. And what does this mean in real terms? What can you now do if you get full approval?
Thanks, Matt. Thanks for having me. Actually, some slightly breaking news. It's no longer conditional. It's actually fully approved as of now. We met the conditions just about an hour ago. But what this means, look, BitGo's been operating as a digital asset infrastructure custodian provider for the last decade. We've been doing it through a number of regulatory licenses, previously state chartered, both in South Dakota and New York. Now we're upgrading that to an OCC nationally chartered bank. So it's a big upgrade. It means that everybody in the industry knows that you can count on the BitGo regulatory stance to service pretty much any need.
Yeah, like what? I mean, what are you going to be able to do, and how does this cross through crypto to fiat?
Sure. Well, look, as a national bank, we now preempt the state's licensing. So instead of having to have these multiple licenses across multiple states, we have it at the federal level. Additionally, for the last couple of decades, people have wondered when it came to federally chartered things like, FINRA registrations, SEC, et cetera, do you need to use a nationally chartered bank or is a state chartered bank sufficient? This takes that away. This is the highest level regulatory oversight you can have. So it's really positive for us. But maybe more importantly, what is this for the industry? For the last 4 years at least, we've been facing kind of a regulatory uncertainty. This marks the end of that regulatory uncertainty. You might have seen, in addition to BitGo, several other companies are also converting into OCC chartered banks. So now we can enter into the innovation phase and really take digital assets as a first-class asset into the financial system.
You've already seen pretty incredible growth, Mike. I mean, I read that you had $4.2 billion in revenue during the first 6 months of 2025, which is almost quadruple what you had in the year before. So what kind of growth do you see ahead with this?
I'm not supposed to talk about financial numbers because we've got public company plans, so you can read our S1 statements and you can see that kind of thing. But look, overall, the climate for digital assets is very strong. In 2025, we really saw a turnaround as all of a sudden everybody can participate in this asset class. So we expect continued growth. Obviously, there's growth on money coming in, so you've got custody and kind of the basic wallet services, but on top of that, trading volumes are growing. And the plumbing is being built to connect these markets, not just inside of the crypto native components, but also over to traditional finance. So the ETFs had a big boom last year, January 2024, finally approved after so many failed ETF attempts for Bitcoin. This year, of course, we've had BlackRock's ETF be the fastest growing and now the largest digital ETF that they've had. So anyway, we've seen tremendous growth. We expect that to continue well into 2026.
In terms of your IPO plans, I was thinking that you would go public this year. It looks like we're running out of time. Have you had to move your schedule a little bit?
Well, as you know, the government was shut down for a little while, so obviously that impacted everybody that was in that process. Can't quite comment on it, but it's still underway.
Do we know ballpark? Like, are you going to go public in Q1?
I'm not sure if I'm supposed to say that or not. Look, we're working on it. We want to get out there as a public company. The reason for doing that is because, look, we've always been about transparency and trust. And, in the early days, it was like, what's this technology that BitGo's developed and pioneered? And then later it was like, who is the company run by? What's the balance sheet look like? What are the SOC audits? What's the insurance look like? All of these are ways to prove to folks that we are worthy of servicing their financial assets. So look, being a public company gives us another level of transparency, allows people to scrutinize our business. We want that. We welcome that. It's really just part of making sure that we're doing everything we can to be the most transparent provider we can.
Got it. Mike, thanks so much for joining us today. Mike Belshie there, the CEO of BitGo. Now, this is Bloomberg Markets, and I am actually Matt Miller. That does it for this program. Have a fantastic weekend, and we'll see you back here same time, same place next week.
Wherever news and ideas meet, wherever earnings reports and saved orders intersect, the all-new Fidelity Trader Plus is there, giving you the freedom to trade how you want with your preferred tools, customized charts, and streaming data. So you can start a trade idea on one device and execute it on another. Meet our most powerful, consistent trading platform yet. Meet Fidelity Trader Plus.
You can't control the course or the competition, but you can control what you do next. Tiger Woods built his career on the ability to reset, adapt, and make the next shot count. Insperity is built to help businesses do the same. You deserve an HR partner that's there to help you thrive, no matter what comes your way. Insperity, because how you HR matters.
Premium benefits anywhere you go. Unlimited zero trading fees. 6% back in crypto. And other exclusive benefits with Level Up. Take your wealth to the next level.
Brighter future.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Bringing you up-to-the-minute geoeconomic news whenever and wherever it happens. I'm Bonnie Quinn in Sao Paulo, Brazil, and this is Bloomberg. Live from Washington, D.C., this is Balance of Power with Joe Matthew.
The drumbeat gets louder over war powers in Washington. Welcome to the Friday edition of Balance of Power. As members of Congress demand a say in the administration's military actions in the Caribbean, we're going to talk with the author of a war powers bill that's set to hit the floor coming up when we're joined by Democratic Congressman Jim McGovern of Massachusetts. He's with us in studio today, and we'll tackle the health care debate with our political panel after dueling health care bills failed yesterday in the Senate, setting us up to go over the cliff. Later, our conversation with the CEO of Anchorage Digital, the first federally chartered crypto bank. All after a look at Wall Street. It's not been fun so far. Charlie Pellet has the latest from World Headquarters in New York. What's going on, Charlie?
Right now, we are lower across the board, Joe Matthew. The key takeaway, perhaps, at this hour, we are off session lows, but still looking at a loss of almost 1% in the S&P 500 index. Down 63 now at 68.37. The real damage, though, being done among tech names. Case in point, Oracle, the stock down again today, tumbling 4.2%. Broadcom, after earnings, down 10.8%. NASDAQ down 1.4%. The NASDAQ 100 index down 1.7%. Keeping it all in context, S&P 500 index lower by 64, down 0.9, while the Dow is down 151, a decline of 0.3%. So stocks are extending losses, a sell-off in technology, dragging global gauges from the brink of records. The 10-year, 4.18%, the 2-year, 3.53%, and the 30-year, 4.85%. Gold at $42.92 the ounce. Spot gold up 0.3%. Silver down 3%, $61.67 the ounce. West Texas Intermediate crude, we'll call that flat on the day now, $57.62 a barrel. And Bitcoin down almost 3%, $90,161 on a Bitcoin. President Trump says Thailand and Cambodia have agreed to stop fighting after he spoke with their leaders to urge them to end, quote, the very unfortunate reawakening of their long-running war. Recapping, S&P down 65, down 0.9%. Right now, Balance of Power continues. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
All right, Charlie, we thank you. 20 minutes from now, we'll check in the markets one more time with Charlie Pellet as we make our way through a bumpy Friday here on Wall Street. Here in Washington, it's matters of war and peace making news today, and we just got a string of headlines from the White House after the president took to Truth Social to let us know about a call that he had a short time ago. Again, matters of war and peace. Trump says he had a good conversation with the prime ministers of both Cambodia and Thailand, knowing that he helped these two countries end a conflict recently. He talks about it frequently as he dials up the number of wars that he says he helped to stop. In this case, Thailand, Cambodia will go back to their original peace accord. Both agreed to cease all shooting. A ceasefire will be effective this evening, according to the President of the United States. We still have a lot of questions, though, about Ukraine. With the headline on the terminal, Trump says U.S. would help with Ukraine's security in a peace deal here. And this is a bit of an update based on what we have seen and heard from the president most recently. President talking as well about this idea of potentially going to Europe as soon as this weekend for peace talks. He's not planning to. Here's what the president said.
We'll see whether or not we attend the meeting. We said we'll attend the meeting if we think there's a good chance of they want me to attend, they want us to attend. And we'll be attending the meeting on Saturday in Europe if we think there's a good chance. And we don't want to waste a lot of time. We think it's negative. We want it to get settled. As you know, in the past we spent could be $350 billion, giving it to Ukraine. We got nothing in return. but we gave it to Ukraine. I ended up getting rare earth in return, even though I didn't spend money. And we are now selling weapons to NATO. We're not selling it to Ukraine. We're selling weapons at full price to NATO, as you know. They distribute those weapons probably to Ukraine for the most part.
All right, so it doesn't sound like we're going to the meeting on Saturday. But the president again says the U.S. would be willing to contribute assistance to Ukraine as part of a security agreement to end the war. And this really could be seen as progress. Bloomberg Washington correspondent Tyler Kendall's been tracking it for us, having just come back from the White House. Tyler, are we talking about assistance militarily, financially, or both?
Well, it could be both, Joe, though we haven't gotten those exact details from the White House yet. But you're exactly right. It is significant that President Trump is speaking openly about this when it comes to any potential security guarantees for Ukraine, because this has long been a sticking point that Ukraine and our European allies have been pushing this White House to commit to. Because as you well know, for months, we often heard from U.S. officials that any sort of guarantees would be implicit guarantees because the U.S. would have a vested economic interest in Ukraine after inking that critical minerals deal earlier this year. Then the tone started to shift, and we know that the U.S. had committed to things like intelligence sharing and air cover defenses in that way. But we know what Ukraine really wants is something a little more similar to NATO's Article 5 mutual defense clause, and it has yet to be clear whether or not the U.S. would go that far to make such a commitment. But we know that really what the U.S. wants to do is see some forward progress when it comes to these ongoing peace discussions. And while it is unclear and at this point doesn't seem like the U.S. is going to take part in these talks over the weekend, it is worth mentioning, Joe, that the Ukrainian President Zelensky did have a phone call earlier this week with Secretary of State Marco Rubio, with Special Envoy Steve Witkoff, and it is becoming very clear that the U.S. is pushing European allies and pushing Ukraine to get on board when it comes to this peace proposal that's been evolving.
Hey, Tyler, we're going to be talking in a moment with Congressman Jim McGovern about a War Powers Act following the activity that we have seen in the Caribbean. We just seized an oil tanker, as you and I have been discussing. There are big questions about the legality surrounding all of this and exactly what we're going to do. But the White House is signaling that there will be more where this came from. What can you tell us?
Right, and that confirms some pretty incredible reporting from our colleagues at Bloomberg News. People familiar telling us that the U.S. has now entered a new phase when it comes to their strategy with Venezuela amid the seizure of the oil tanker, but also additional sanctions this week from the Treasury Department against oil companies, oil tankers, and close associates of Maduro. This is designed to block off Maduro's access to these critical oil revenues in a bid to get him to relinquish power. Keep in mind, about 80% of Venezuela's export revenue is tied to oil. So our understanding is Venezuela right now is preparing potentially for the U.S. to go further and seize additional oil tankers. And this is going to be really critical, one, to their economy, but also as we look at those broader geopolitical relations. And we know that so much of Venezuela's oil ultimately makes its way to China. So it's something that we're going to be watching very closely here. Now, this specific tanker that we are discussing, as you and I discussed last hour on Balanced Power, it's now heading for Houston. The White House Press Secretary Caroline Leavitt confirmed yesterday that the U.S. does have intent to seize the oil on board. According to satellite imagery, we're tracking about 1.85 million barrels of Venezuelan crude on that tanker.
Wow. Yeah, map go on your terminal. Tyler, thank you so much for the update. Speaking of the terminal, this headline just went red. States to sue Trump over $100,000 H-1B visa application fee. This has been a pretty controversial idea, and it looks like it's going to court. Let's stick with Venezuela for a moment, though, knowing that this boat has been seized. And look, we've got another 6 tankers that have been sanctioned. So we could soon have our own shadow fleet, it sounds like. The president talked about this yesterday at the White House. Listen.
It's about a lot of things, but one of the things it's about is the fact that they've allowed millions of people to come into our country from their prisons, from gangs, from drug dealers, and from mental institutions, probably proportionately more than anybody else. So it has to do with a lot of things. They've treated us badly, and I guess now we're not treating them so good.
That's where we start our conversation with the gentleman from Massachusetts who has authored a War Powers Act that could soon hit the floor. Unless, of course, the speaker doesn't want to see that happen. This is a conversation that Democrats and Republicans are having here in Washington. Jim McGovern, Democrat from Massachusetts. ranking member on the House Rules Committee, with us in studio right now. It's really great to see you.
Happy to be with you.
Thanks for coming in,
Oh, my
Congressman.
pleasure.
You've introduced this War Powers resolution some time ago. Will it hit the floor soon?
Yeah, I expect to force a vote on it next week. It'll be ripe to be considered on Wednesday or Thursday of next week. We have Republican co-sponsors, Representative Massey and Representative Bacon and Marjorie Taylor Greene are on board on this resolution as well. Again, this is not a Democratic initiative. I mean, this is a bipartisan effort by those of us who actually believe the Constitution means something, and Congress has a role to play. And we don't want this president going into a war without a debate and without a vote and authorization by Congress.
Would this be specific to Venezuela or more broad?
It would be specific to Venezuela because that's the conflict we seem to be getting sucked into. Yeah. Although the clip you just showed of the president, he went on to further threaten Colombia, where he might do further action. But look, wars are easy to get into; they're hard as hell to get out of. And we have a history, of talking tough, of getting sucked into these wars that cost, billions and billions of dollars, and then we find ourselves in a quagmire that we can't get out of.
Now, I know for a fact that you understand the politics of the Caribbean better than most on Capitol Hill. You helped to begin normalizing relations with Cuba in the Obama administration. You've spent a lot of time in the region. So what do you think the president's aim is here? Is it regime change or something else?
Yeah, I think it's oil, quite frankly.
Yeah?
I think this president is not about promoting human rights. He doesn't give a damn about democracy. And this is not about drugs. I mean, he pardoned the former president of Honduras, who's one of the biggest narco traffickers in the world.
Hundreds of tons of cocaine.
So I think, there must be some financial interest in pursuing this policy for the president, because that's all he really cares about, making money for his family and money for those who are close to him. Look, our history in Latin America has been one of arrogance, has been one of putting profits ahead of human rights. And by the way, this administration doesn't give a damn about human rights. They just issued their national security strategy, and this is the first administration that has removed the word human rights from the strategy. So this is about Donald Trump's ego, and it's about, I think, oil. I think that's, at the end of the day, I think that's what
Is that why we're seizing tankers?
Again, it would be nice if we had a functioning Congress that would call his administration up and ask these questions like, why are we doing this? Why now? Again, this is not about drugs. More drugs are coming from Mexico and China than from Venezuela. So what is the strategy here? And the president's threatening, action on the ground in Venezuela. Now that's war. He's threatening to cut off, air traffic.
Says we're going to do the land.
Right. So
do you think that he would actually strike ground targets in Venezuela?
Well, if he does, that's an act of war. Yeah. That's an act of war.
Is blowing up drug boats not an act of war?
Well, I think it is. We have some of my colleagues are debating that issue, but we're not only blowing up drug boats. It appears that we are guilty of serious human rights crimes by actually bombing survivors who are begging for help. Again. Congress ought to be demanding a clearly defined mission in terms of what he is doing in Venezuela. And up to this point, there have been very few questions, and he's provided very few answers.
You said something interesting, a functioning Congress. Yeah. Just back off what we're talking about here for a minute. We are in a world now where it does seem that discharge petitions and reconciliation bills are the only way to get anything done in the Congress. Do you feel that way? Yeah, you're on the Rules Committee. You know how this works.
Yeah, this Congress under Republican leadership does not function. It is not working. It is a terrible disservice to the American people. This is a place where trivial issues are getting debated passionately and important ones not at all. We have a healthcare crisis right now. People are seeing their healthcare premiums skyrocket. People are deciding to go without health insurance next year because the costs are so high. We need to be talking about extending the ACA tax credits so that people can afford their health insurance. And we're not doing that. We're talking about stupid stuff, stuff that is probably not even going to even be considered by the Senate, that is going nowhere. Again, Congress, a functioning Congress means that we do the work of the American people. And I'd like to think, no matter, what your politics may be, making sure that we are addressing issues of affordability, which includes the cost of health care, are front and center. I mean, if the Republicans have a plan, then bring the plan to us. Let's debate it and vote on it.
Yeah.
They've got nothing.
Well, let's talk about health care because Republicans put up a bill in the Senate yesterday. It failed. Then the Democratic plan failed. The Democratic plan, of course, would extend Obamacare subsidies. The Republican plan produced by Bill Cassidy would have health savings accounts. Congressman, I spoke with Nicole Malliotakis yesterday, who has signed on to a bipartisan effort in the House, D's and R's, that would extend the subsidies, would add some eligibility controls as well. Because someone like Nicole Malliotakis is not a fan of the Affordable Care Act, as she told us yesterday. Let's listen.
There's so much fraud here, which is why we think we have the proper balance. And this gives us enough time, by the way, to then work over the next year or two to be able to come up with something that can truly replace the Affordable Care Act and bring costs down. Now, what the Speaker and leadership are saying is that we're going to take up a health savings account measure, which will help people certainly with their medical costs, and I support that initiative, but it doesn't go far enough.
Okay, but this is unlikely to see the floor unless the discharge petition makes that happen.
And even if we do the discharge petition route, we won't be able to get to it until probably in early January.
Sure.
My question to Representative Malliotakis is, like, where the hell have you been? I mean, you're a Republican. Your party's in charge. We've been talking about this issue for months. This is not something
Since before the shutdown.
Right, since before the shutdown, well before. We've been talking about it during reconciliation, right? So we go back months and months and months, and we've been saying we got to focus on this. And all we've been hearing from Republicans is like, oh yeah, we'll get to it, and now we're out of time. People are going to lose their health insurance. Healthcare ought to be considered a fundamental human right for everybody in this country. You know, I mean, you need healthcare. If you don't have healthcare, you end up in an emergency room.
Right.
You know, I mean, this is crazy. So look, there are a number of discharge petitions that have been introduced with various approaches to helping people afford their health insurance. I mean, let's figure out what the best one is and let's move on it. But the stalling and the excuses and the finger pointing, it has to end. You know, we want to debate this issue. We want to vote on this issue. We want to help the millions of people in this country who are about to get screwed.
What's the conversation in Worcester, Massachusetts right now? If you stop in Kelly Square and ask somebody about their health insurance, are they seeing these increases and dropping off the rolls? Or are they saying, I can't afford it anyway, so to your point, I'm going to go to the emergency room when I get a call?
So, I mean, we're hearing some really terrible stories of people basically saying, I can't afford my health insurance. Our office is getting inundated with calls. Look, people in Worcester just want us to do our job. And they get it. There are differences between Democrats and Republicans. But at the end of the day, they want us to get something done. You don't have to agree on everything to agree on something. But whatever that something is, it has to be about improving the quality of life for the people who live in Worcester and all around the country. And the problem with what the Senate did on the Republican side is the stuff that they're proposing, you know, it doesn't mean anything in anybody's life. I mean, you know, saying I'm fixing health care, but in reality not fixing health care, not making it more affordable, well, that doesn't help anybody, right? You know, we ought to have a larger discussion on how we fix our entire healthcare system because it's a mess. It's too for-profit oriented. But we're not going to do that in a week or two, right? Right now, we need to extend these tax credits so that millions of people don't see their premiums skyrocket and millions don't lose their health insurance.
We've only got about a minute left here. A terminal user just wrote us while we're talking. Ask the congressman why the ACA failed that they designed. Maybe I can reframe that a bit. A lot of Republicans come on the air and they say this thing was never affordable. Obamacare itself has raised premiums. Is this plan broken?
No, I think it's not perfect.
Yeah.
But it is better than the alternative, which is no ACA, right? I mean, the bottom line is millions and millions of people have coverage because of the Affordable Care Act. You know, if we extended the tax credits, it's affordable. But as I said, we need to have a bigger conversation. Look, if it was up to me, we would have a Medicare for All system. When I was the chairman of the Rules Committee, we were the first committee in either the House or Senate to do a hearing on Medicare for All. And I'll tell you, it was a very, very powerful hearing. But, you know, to fix healthcare holistically, you know, it's going to take some time. In the meantime, let's extend those tax credits. Let's help people afford their health insurance.
Let's talk when the War Powers Act hits the floor. We've got a lot more to talk about, Congressman. Let's do this next time at Coney Island.
All right, I'm with you.
Onions or no?
Yeah, with onions.
With onions. It's the only way to do it.
Best hot dogs in the world.
They really are, too. I'm Joe Matthew in Washington. Congressman Jim McGovern of Massachusetts. This is Bloomberg.
Wherever news and ideas meet, wherever earnings reports and saved orders intersect, The all-new Fidelity Trader Plus is there, giving you the freedom to trade how you want with your preferred tools, customized charts, and streaming data. So you can start a trade idea on one device and execute it on another. Meet our most powerful, consistent trading platform yet. Meet Fidelity Trader Plus.
약값 에디님 없으니까 많이 못 먹었잖아. 아부고 풍호 왔을 때 탑승했으면 뒤질 뻔했네요. 회복 가자.
Premium benefits anywhere you go. Unlimited, zero trading fees. 6% back in crypto. And other exclusive benefits with Level Up. Take your wealth to the next level.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg.
I'm David
에디님
Weston.
없으니까
Join me
심심하네요.
for the
히읗.
next
주말에
generation
푹
of
쉬고
Wall
다음
Street
주에
Week.
봐요.
This week, Glenn Hubbard on this week's Fed decision. Lisa Su of AMD on the open source approach to AI and why it matters. Going nuclear to get all that power data centers need. And a trip down memory lane as iconic Macy's tries to restore the luster of department stores.
It's a storied retailer, but we never want our rich history to get in the way of our brighter future.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? On this episode,
the goal is to expand in terms of countries, in terms of geographies, but also in terms of products, new services that we can launch in the geographies that we have presence.
Premieres December 19th, only on Bloomberg.
It's 121 on Wall Street. We do check markets all day long here at Bloomberg. Techs are tumbling. We are off session lows. The Dow, the S&P, NASDAQ all in the red. S&P on track for a loss this week. S&P right now down 55 to 68.46. That is a decline of 0.8%. Yesterday, the S&P closed at a record. The Dow down 156 now, down 0.3%. NASDAQ down 292 for NASDAQ. The composite index down 1.2%. The NASDAQ 100 index down 1.5%. 10-year 4.18% with the 2-year currently yielding 3.53%. The 30-year 4.85%. Gold is up 0.4%, $42.99 the ounce. West Texas Intermediate crude flat on the day at $52.61 a barrel. And Bitcoin now down 2.7%, 90,356 on Bitcoin. Sources tell Bloomberg Oracle has pushed back the completion dates for some of the data centers it's developing for the AI model developer OpenAI to 2028 from 2027. Oracle shares, they're down right now by just about 2.6%. After earnings, Broadcom shares, they're plunging 10.4%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. Balance of Power continues now. Once again, your host here is Joe Matthew.
All right, Charlie, thank you. Not a very fun ride today on Wall Street, and we'll check back in for more on the markets in just about 20 minutes here on Balance of Power. Thanks for being with us on the Friday edition here on Bloomberg TV and radio. The question of states' rights being debated fiercely here in Washington when it comes to AI regulations. This is not a new issue, but it's one the president decided to step into. Signing an executive order just yesterday, it happened late in the day, to essentially make it impossible for states to have their own AI regulations. This is a nationwide blanket, as the president says, to help companies cut through the red tape and continue growth to compete with China. We talked about this earlier today. A fascinating conversation on Bloomberg TV and radio with the president's crypto and AI czar, David Sachs. Let's listen.
The problem that we see is that you've got 1,000 different bills going through state legislatures right now to regulate AI, and over 100 measures have already passed. Some of these bills are contradictory, and you've got 50 different states running in 50 different directions. That type of compliance regime is going to be very hard for small companies and startups, especially innovators, to comply with. And so what we need is a single federal or national framework for AI regulation, and in the meantime, create tools that the administration can use to push back on examples of the most onerous and excessive state regulations.
So what does this do? This order directs the U.S. Attorney General to establish what they're calling an AI litigation task force to challenge state AI laws that they feel are inconsistent with the policy. It also directs, in this case, Howard Lutnick, the Commerce Secretary, to publish an evaluation of existing state AI laws and issue a notice specifying which ones can stay and which ones need to go. Let's play it to the panel. Bloomberg Politics contributors Rick Davis and Jeannie Shanzano are with us. Rick is our Republican strategist and partner at Stone Court Capital. Jeannie is Democracy Visiting Fellow at Harvard Kennedy School's Ash Center, our Democratic analyst. Rick, have Republicans turned away from states' rights?
Oh, that's a legitimate question. Certainly this president doesn't think much about them. He's railed against state actions a lot, and he's obviously used the full power of the federal government to institute things like law and order in states against their interests. So, yeah, I think that this president is creating a new dynamic within the Republican Party that basically treads on the states' rights issues pretty well. Although, that being said, there are a number of Republican governors who have also opposed this effort by the president to have a blanket AI regulation usurping the states' rights. And so I don't think this debate is over.
This is, again, not new. In fact, there's been legislation. Senator Ted Cruz has tried to push this over the line a couple of times here, Jeannie. So what's going to happen? Are we going to have 50 lawsuits to track here?
Probably more than 50, Joe. We also had Steve Scalise, who also had a bill. They've been unable to push those through. And I think that that is absolutely where our attention should be. Donald Trump is not wrong to say we need federal policy regarding AI. The problem is just what you were talking to Representative McGovern about. We have an inept Congress, a do-nothing Congress. You can't turn to Congress and say, why don't you get on top of this? I mean, we all know, for instance, we have a huge privacy problem in this country. For years, we have yet to have federal regulation of privacy rights. What do we have? 50 states doing 50 different things, same thing in AI. It is a problem. So on that, the president's instincts are right here. The problem is doing it through an EO, of course. And then the other part of the problem is the fact that the president is so cozy with all of the big people who are in charge of AI in this country. I mean, I'm just reflecting on Time Magazine's cover of, the person of the year this year is the architects of AI. They're all sitting like on that bridge building the new century. That's a problem when AI is threatening young people graduating from colleges who can't get jobs. That's a problem when you have a president who has so much himself personally and his businesses invested in this. And they are all surrounding him at the inauguration and coming in and out of the White House. So on the one hand, Trump is right. We do need federal policy and regulation. We don't need it this way. It is the job of Congress, and yet we can't turn to them on this or much else these days.
So it sounds like Jeannie has a bit of a bad taste in her mouth when it comes to these relationships. Rick, she's right. Everyone's sitting on that girder on the cover of Time magazine's been spending time in the Oval Office recently. But I'm struck by something that Scott Bessent said. He uses this line a lot. It's pass-fail versus China. We have the lead. We've got to maintain it. There's no second place in the AI race. Is that something that Americans need to start getting their heads around?
Yeah, look, I don't think it's insignificant what Secretary Bessent says. It is a race against time for technology that'll transform our economies. And just like the Industrial Revolution bolted the United States into a prime spot in the global economic sphere, so will AI. And so I tend to agree with Jeannie on this idea that you do need a general plan for the country related to that. And I doubt if Bessent disagrees, because that's basically what Trump is saying. But like, the place to have that debate is in Congress. Congress is the only body that can pass a law that usurps state law, and so an EO can be thrown away in the garbage the minute a new president steps in. And I would remind Jeannie, all these guys who are now for Trump were all for Biden 4 years ago, and so I think it's a good thing that industry is cooperating with the government. I think if it were the opposite, we would really have significant problems. So yeah, let's win the race. Let's improve our own economy by having this kind of productivity.
Well, Jeannie, if everybody's going to court over AI, looks like they're going to court over the president's new visa plan. This is a story that broke after we came to air. A group of states here announcing that they will be suing the administration to block this $100,000 fee for new H-1B visa applications, which allow employers to hire what they call skilled foreign workers. This is a different program than some you might see for agriculture, et cetera. These H-1Bs are specific to the companies we're actually talking about. Jensen Huang was asked about it. He seemed to indicate, Jeannie, that $100,000 was worth it based on the incredible amount of work that they have to perform here in the United States when it comes to AI and other emerging technologies. How's this going to pan out when it comes to the H-1B?
So, Joe, if I can just circle back to Scott Bessent for a moment, can you please ask him if that's the case and there's no second place, why then are we selling NVIDIA chips to China? I just have to ask that. Going back to the H-1B visas, I think the problem is that we want to use what has long been our most important strength, and that is the fact that so many of us are either immigrants or the children or the grandchildren of immigrants. And when you say it is going to cost $100,000 to come in on one of these visas, that is a whole scale switch from where we've been in multitudes that I can't even count because I'm no mathematician, but it's a lot of money. So yes, if companies want to pay that on behalf of workers, great. But you should not make our system one in which you can only come in if you are wealthy or beholden to wealthy people. We should be bringing in and supporting the best and the brightest in the world, if indeed we want to win this competition against China and other parts of the world that Scott Bessent is talking about. So many of these things just don't seem to add up if you're talking about competing with China. You know who's welcoming people without this kind of cost? China. So we should be doing the same.
Really interesting point, Jeannie. This case is being led, by the way, from Massachusetts Attorney General Andrea Campbell and California AG Rob Bonta, who put out a statement, Rick, that says, as the world's fourth largest economy, California knows that when skilled talent from around the world joins our workforce, it drives our state forward. The Trump administration thinks it can raise costs on a whim, but the law says otherwise. Can the president do this?
It's a little sketchy. Executive action doesn't have the impact if they actually ran a bill through Congress where they amended the H-1B visa program and made it a statute. It'd be ironclad. Again, I think we're just tripping over ourselves as a party by not really instilling these ideas into some kind of, hard legislative agenda that will become the rule of law rather than the whim of the presidency. And look, I mean, remember, nobody gets in on an H-1B visa who isn't sponsored by a company that's going to already have them hired and put them to work. Right. It's not like you just wander into the United States and go looking for a job if you're a computer engineer. And so, like, it's a little more structured than I think Jeannie wants to portray. But at the end of the day, it does limit the people who can pay for this to the Jensen Huangs, because not everybody can afford an extra $100,000 on top of what they're already going to pay somebody like this. So I do think it's an unfair advantage for very wealthy trillion-dollar companies when you talk about the distribution of this kind of talent into the United States.
You could just buy a Trump gold card, Jeannie. We didn't talk about this. The administration debuted the website Wednesday. It's online right now, opening up applications for the gold card, which is basically an expedited visa here. If you pay $1 million, makes $100,000 sound pretty cheap, doesn't it?
It absolutely does. Again, you're going to make the talent coming in here be beholden to the wealthiest billionaires, and the president, of course, as the polls show, he's comfortable there. That's where he lives. He doesn't understand why people feel like they're suffering economically. But the reality is not that for most people in the United States and certainly around the world. And no, I'm not thinking that people are wandering into the country, but the reality is you want to make companies who are building not have to spend $100,000 to bring talent in.
Great analysis, as always, from our signature panel. Jeannie Shanzano, Rick Davis. They'll be back on the late edition of Balance of Power. Thank you both. I'm Joe Matthew in Washington. This is Bloomberg.
Meet the all-new Fidelity Trader Plus with your preferred tools, customized charts, and streaming data, so you can start a trade idea on one device and execute it on another. Meet our most powerful trading platform yet, Fidelity Trader Plus.
Premium benefits anywhere you go. Unlimited zero trading fees. 6% back in crypto. And other exclusive benefits with Level Up. Take your wealth to the next level.
Dear Marcella.
Dear Jordan.
Due to a higher risk of destructive weather events,
your homeowner's policy will see an overall rate increase of 22%.
See a rate change of 45%.
You will not be insured under this policy after the above date and time.
Due to more extreme
due to increased destructive storms,
frequency of wildfires.
A team in England, is that right?
Yes. I bought a team called London City Lionesses, and that is the only one of the two teams in the entire, potentially Great Britain, that are independent. 99% of the teams in Europe are part of the men's team. But this is one of the only two teams that was independent.
So now you have two soccer teams, one in England and one in the United States. So I would think for most people that might be enough, but you decide to buy a team in France as well?
Yes. Olympique Lyonnais Féminin is actually the best women's team in the history of women's football. In terms of how many trophies the team has won, they are the 8 times champions of the Pan-European League. And I can't even count how many times they won the French domestic league, the most successful team. I want to professionalize women's sports, right? I don't want people to think that somehow women's sports is a charity or a corporate DEI project. This is a legitimate entertainment product, and it is a business.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Every weekday from 3 to 5 Eastern.
Only on Bloomberg. Context changes everything.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Some people travel to see the world. I travel to question the forces that shape entire nations.
How is it possible?
My name is Professor Hannah Fry. I want to meet the people with unexpected stories to tell and dig up the peculiar and wonderful treasures that reveal what a country is made of.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jumana Bersachi in Beirut, and this is Bloomberg.
It's 1:40 on Wall Street. We do check markets all day long here at Bloomberg. Stocks are lower across the board. Techs are tumbling. We begin with NASDAQ down 287 points right now, down 1.2%. The NASDAQ 100 index down 1.4%. S&P extending losses down 54, down 0.8%. Yesterday, you'll recall, the S&P had been at a record. Today, the Dow down 158, a drop of 0.3%. The Mag 7 index down 0.5%. The 10-year 4.18%, the 2-year 3.52%, and right now the 30-year 4.85%. Gold at $42.98 the ounce. Spot gold up 0.4%. A retreat for silver down 2.5%, $61.94 the ounce. West Texas Intermediate crude oil down 0.1%. WTI $57.53 a barrel, and Bitcoin down 2.5%, $90,600 on Bitcoin. Among retailers with earnings out last night, we did hear from Lululemon Athletica. The stock today up by 10%. Also reporting last night was Costco. Costco shares down now by 1.2%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. Balance of Power continues right now. The Friday edition, wrapping up the week. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
All right, Charlie Pellet, thank you so much. And pass the hot sauce. As Nathan Dean likes to say at Bloomberg Intelligence, there's hot sauce on the pot stocks today. And if you've been listening to Charlie, you know why. A report in the Washington Post getting us back around this idea of President Trump warming up to weed. Must have got a call from Roger Stone. Trump seeks to cut restrictions on marijuana through planned order. This is rescheduling we're talking about here, and it's something that a lot of folks expected during the campaign. Maybe not so much after the president took office. This is, by the way, an idea that was pursued by the Biden administration. Never ended up happening, as the president now is expected to direct agencies to reclassify marijuana as a Schedule III drug, similar to common painkillers. It is currently in the same class as heroin. And this would not legalize marijuana, but it would allow cannabis companies to see the light of day and potentially use a bank. Would also mean a different tax status, and that's why we're seeing these stocks take off. We thought we'd dial up Nathan Dean to get his take on this. Of course, at Bloomberg Intelligence, our senior U.S. policy analyst who's fielding calls on this all the time because, as you can tell us, Nathan, welcome back. Cannabis investors are passionate and very active, and they have been waiting for good news for a long time. But Lucy keeps pulling the football. Is this actually going to happen?
You know, that's the number one question we got this morning from the clients is this for real now? And what we're telling our clients is that, look, you know, yes, these equities have hot sauce, lots of volatility. MSOS is up 38%. But really, I think what we need to do is see what happens with this order, because the president does not have the authority to unilaterally reclassify it from Schedule 1 to Schedule 3. What I think the order is going to say is that it's going to direct the Department of Justice and the DEA to restart this process of a rulemaking change. Now, they're about 70% of the way through, so, I mean, obviously, it's not going to be that long. But if the DOJ comes out and says, right, we're going to do this on a speedier method, meaning we're going to forego a hearing, we're just going to move straight to the rulemaking process, they can get this done by the first half of next year. The question, though, is what is going to be in that order? Because obviously, if that order just says I'm going to deem it valid and therefore it's Schedule 3 today, then that's going to have court challenges and uncertainty still reigns.
What's the DEA think about this? Because I thought the tension was coming from within the administration last time we spoke.
Yeah, and it still is. I mean, so obviously we've heard anecdotally that the DEA is not, the staff there is not really on board with this idea. That was prevalent during the Biden administration. We saw no reason why it would change under the Trump administration. In fact, the administrator of the DEA, Terrence Cole, has a 30-year history of fighting marijuana, and he didn't really seem to be that on board with the idea. You know, the Washington Post report even talks about how Speaker Johnson tried to rebut some of President Trump's arguments here. So what we're telling our clients is that, look, even if reschedulization goes forward, it's not legalization. It doesn't lead to increased market share for these companies. What it does is it changes the tax code, something called 280E. So rather than paying a 40% tax rate, you're down to around 10 to 15%. So that's obviously good for those companies. But, you know, this resistance still remains, and that's why we're at a 30% chance of legalization. And that is what would prohibit market share growth, organic growth, everything like that. This is really just about tax.
Okay, this is good to understand and not to conflate with the Safe Banking Act, right? Was I correct about that? Or these companies would still not be able to use banking services?
Yeah, that's correct. I mean, under the Safer Banking Act, banks would be able to service marijuana businesses. But our theory on that is until it's legislatively changed at the federal level, meaning until the drug is federally legalized, banks, especially the big banks, the publicly traded banks, they're not going to touch marijuana because you're going to be afraid of running into the Bank Secrecy Act or anti-money laundering. And honestly, the revenues just isn't there for the risk. So for these companies, there's two things for market participants to keep in mind. One is the tax issue, and the second is there's a lot of retail sentiment in this hot sauce right now. If you look at the Canadian pot equities, they're also up 30%, and this largely doesn't apply to them. So there's a lot of folks out here saying, you know what, this is good, but just keep in mind there's a lot of retail sentiment here as well.
Well, and that's important because you pointed out MSOS. That's the Advisor Shares Pure U.S. Cannabis ETF, because a lot of these other ETFs fold in, to your point, Canadian companies, right, or tobacco companies, a lot of different grow companies. I think you find a lot of different stuff that you might not expect. For instance, in the MJ ETF, is this what your clients are looking at? Is this what our audience should be tracking?
Yeah, I mean, honestly, what the reschedulization does is that it really opens up the mom and pop aspect for marijuana. So think of like the mom and pop farms in Oklahoma and Colorado and so forth. Those are the businesses that this is really geared towards. Now, the reason why it's positive for the bigger companies is because we do anticipate that there's going to be significant consolidation in this industry as incrementally things get better and better and better in terms of the legality of the drug. This is not an easy business to be in right now. And so as you know, you get more of a regulatory framework, usually it's the big players that gobble up the smaller players, and then they are the ones that have the technology spend, the compliance spend, the legal spend that can deal with these regulations. So if President Trump does reclassify this, let's just say middle of next year, you know, the tax relief will be there for the 2026 tax season in 2027, and then you will start to see, I think, some consolidation amongst the bigger players gobbling up the smaller players. But again, it doesn't really change the idea in terms of organic market share growth or anything like that. It just really just changes the finances of the system.
All right, makes a lot of sense. MSOS is the ticker as we spend time with Nathan Dean, backed by his iconic image of Stumpy at the Tidal Basin in Washington. There's got to be some connection here. for a plant that grows freely from the earth, Nathan Dean. I want to ask you while you're with us about crypto, because you're out with the 2026 Outlook, U.S. Crypto Policy on Bloomberg Intelligence. To what extent will this industry and this investment class evolve in the new year?
So 2026 is going to be a tremendous year for crypto, and there's really three things to keep in mind. One is stablecoins. Now, the FDIC and the Fed, they're expected to release a proposal almost, I think, within the next week or so, implementing the Genius Act. This is the first of two proposals we think are coming. This is more about applications and registration, not all that exciting, but at the end of the year, stablecoin issuers are going to have a regulatory framework. You have the SEC and the CFTC moving forward with Project Crypto, taking off the enforcement risk, allowing these companies to innovate without the fear of that regulatory albatross hanging around their neck. And then you have the House and Senate discussions for this broader crypto market structure bill. Yes, there was a little bit of hiccup this week, but I do stand by our call that we do think that there's a 70% chance of this passing in the first half of next year, which would then give additional regulatory clarity for companies like Coinbase and Robinhood.
Pretty big deal. Watching crypto today, a little bit lower. We're down 2.5% on Bitcoin. Nathan, thank you so much. Have a great weekend. Nathan Dean at Bloomberg Intelligence with smart analysis on weed and crypto. We'll pursue the latter now with an important conversation that I've been looking forward to. Nathan McCauley. We go from one Nathan to another. The CEO and co-founder of Anchorage Digital, which you may not have heard of, but you should know about. Anchorage is the first federally regulated crypto bank in the country. Nathan, welcome. It's great to have you as part of our conversation on Bloomberg TV and radio. Are you getting what you need from Washington? And what do you expect in the new year?
Well, listen, first of all, it's wonderful to be here. Thanks so much for having me on the show. We are absolutely getting what we need from Washington. Genius Act passed earlier this year, which created the federal regulatory framework for stablecoins. Since then, we have announced 4 partnerships with stablecoin issuers, including the stablecoin giant Tether that is going to be working with us to issue their U.S. version of their stablecoin. So the Genius Act has just been incredible. Really excited for market structure, which is coming next, which will lay the groundwork for how to think about trading, securities, and the whole landscape across the digital asset ecosystem.
Well, this is really interesting. To what extent has this changed the crypto landscape as we see stablecoin usage increase dramatically following the legislation that's passed? And some have suggested that it has turned investors away from Bitcoin, from Ethereum, from other tokens. Do you see that happening?
No, I see quite the opposite. I see that among institutional investors that are looking at the digital asset ecosystem, their conviction in Bitcoin as a store of value is only growing. We're seeing an incredible amount of inflows into our custody system from institutional investors looking to invest in digital assets. In fact, now all of the large ETFs in the country are now utilizing Anchorage Digital as a custodian, listed on all of their S1s. But even further than that, what we're seeing is as stablecoins grow, stablecoins are not going to be competitive with the blockchains. In fact, they are going to be using blockchains. And so I think one of the biggest benefactors of the stablecoin trend is going to be the chains themselves. Ethereum, Solana, and the other chains where these stablecoins settle and live are going to see a lot more growth there. So I think it's an accelerant both for the stablecoin ecosystem and for the entire ecosystem at large.
Well, that's really interesting, and I appreciate you describing that at a time, of course, where we've seen some real volatility in crypto, and specifically, my gosh, what we've seen in Bitcoin and Ethereum specifically over the past couple of weeks has prompted a lot of concern. And we've had people on this program, Nathan, suggest that we could be going into another crypto winter. What would you say to them?
The way that I think about it is that these are assets that are best measured in decades in terms of their investment thesis. Thinking about your entry price for assets can definitely be something to think about. But as Bitcoin grows as a store of value on a global basis, as we have smart contract languages like Ethereum and Solana that have a kind of a long run track record here, I think what we see among our institutional investors is that long-term time horizon, 10, 20, 30 years being the thing that matters, and a little bit less focus on, say, the cyclical sine wave that is the crypto bear and bull cycles.
Talk to me about security, secure usage, ensuring the fact that these assets are not used for criminal enterprise, as Senator Elizabeth Warren frequently warns. We hear this conversation a lot in hearings in Washington, D.C. What do you have to think?
Sure. So I think there's a couple ways to think about that. The first one is software security considerations. Can you hold the assets and keep them secure and safe? My company, Anchorage Digital, operates a national bank where we hold assets for institutional investors. And the primary thing we provide to them is security, safekeeping of their assets. And so we've developed a ton of security procedures, and that's really well appreciated and is really central to any investment thesis in the crypto assets, is thinking about the security of your assets. The second part of your question is around, what do we think about how stable coins and other assets are used on a global scale?
Yeah.
As I mentioned, we operate as a national bank, so we completely comply with all federal regulations around BSA, AML, sanctions, and all of that. And so I think in many ways we have proven that it is possible to operate like that and to operate crypto asset businesses fully and completely within the regulatory perimeter of the laws and regulations of the United States.
Well, in our remaining moment, Nathan, what does your charter mean for the rest of the industry? Will we see more banks like yours and create a new class of banking?
I hope so. So we are the first and as yet only operational federally chartered digital asset bank. But I expect that we are the first of many. The way I like to say it is that there used to be such a thing as internet companies. Now that is just called a company. And we are a crypto bank, and I think there one day will come in the U.S. where every bank will be a crypto bank. And so we are one of one at this point, but I look forward to be one of 4,000, and we look to help enable all the rest of the banks to come into this space. And so looking forward to even more adoption there within the banking industry.
I appreciate your being with us. He's the co-founder, CEO of Anchorage Digital, Nathan McCauley, with us on Bloomberg. Thank you, sir, for the insights. I'll meet you back here on the late edition of Balance of Power. And we could have news from the White House as the president is set to tangle with reporters about an hour from now. Much more to follow as Bloomberg Business Week Daily kicks off here. We'll have a look at the market straight ahead, and I'll meet you back here at 5 p.m. This is Bloomberg.
Meet the all-new Fidelity Trader Plus with your preferred tools, customized charts, and streaming data, so you can start a trade idea on one device and execute it on another. Meet our most powerful trading platform yet, Fidelity Trader Plus.
Tiger Woods built his career on forward thinking, staying ahead of the curve and away from the expected. Insperity believes that in business, it's no different. They're dedicated to driving your business forward, providing the HR support you need to innovate and win. You don't become one of the greats by doing things the same as everyone else. You take a swing, knowing you've got the right partner by your side. Insperity, because how you HR matters.
Premium benefits anywhere you go. Unlimited, zero trading fees. 6% back in crypto. And other exclusive benefits with Level Up. Take your wealth to the next level.
But that line is going to be more and more blurred. So it's going to be a little bit less like what is
organic content and what is AI synthetic content and what the percentages are. I think there's going to be actually more in the middle than pure synthetic content for a while. But you will also see experiences that are purely AI, right? You see this in the last 2 weeks with Vibes in the Meta AI app and with Sora 2 from OpenAI. So I think you're going to see both.
In case you missed it on Bloomberg Open Interest.
It's Netflix versus YouTube.
100%. I do think in the world of more AI slop, people are going to look for destinations where they really want higher quality, curated, high production storytelling.
But YouTube is crushing it. I mean, I have both.
Absolutely.
But one thing YouTube has is like, I don't have to pay for YouTube. Are these real threats to Netflix?
Netflix is the luxury equivalent. Consumer product is consumer tech.
Don't miss Open Interest live weekdays.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up to them in the news whenever and wherever it happens. I'm Sherian in Seoul, and this is Bloomberg.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
All right, everybody. Yes, indeed. It is TGIF Friday, December 12th. Why do I have December 11th in the script? Why am I always a day off?
I can't.
Do you know what's up with that?
That's above my pay grade.
Man.
I'm not qualified to make that assessment.
All right, can we get the doctors on that? Because there's something going on, I think.
Well, it's the 12th. It's better than Friday the 13th, Carol. And that's where we are.
Triskaidekaphobia.
Yeah, well, look at this. The NASDAQ 100 off its worst levels today, but still down 1.7%.
Maybe it's Friday the 13th in the NASDAQ trade.
Okay. Well, there is a rebalance later today, so.
Maybe.
You know. The S&P 500 down 1%. We're going to have much more from Charlie Pellet in just a minute. He's going to give us all the details.
Yes, indeed. We're going to get off. No. We're going to get to that in just a moment. We're going to get into that sell-off when it comes to, it feels like, AI winners, because that is dragging down the overall trade. Hey, we also did get that disappointing sales outlook from chipmaker Broadcom that's weighing on rivals, fueling some of those investor anxieties about that AI bet. And then we also have some mixed messaging from Fed officials. So, yeah, you know what that means? Michael McKee's sitting right next to me because we got to, pressure's on you, Mike, in just a moment.
All right, we're going to get to Mike in just a minute. In the meantime, what to take note of when it comes to the Fed speak and, of course, Broadcom's results as well.
Yeah, let's not forget, too, we're going to get a read on the C-suite. We've also got Stephanie Gill, Chief Investment Officer at Robinhood Markets. She's going to talk about flows, volume. And on that vantage point from the C-suite, we've got the CFO of UiPath. That stock has been on a tear this year. So we see what they have to say. He's got an AI angle as well.
All right, looking forward to that over the next hour. First up, though, a check of the day's trade and top business stories. Here he is, Charlie Pellet.
Thank you very much. Indeed, got to begin with Oracle. Stock is down 3.9% right now. Earlier, we reported that Oracle had pushed back the completion dates for some data centers that it is developing for OpenAI to 2028 from 2027. That, according to sources. But right now, we have got an Oracle spokesperson providing an update saying the company remains confident in its ability to meet its obligations and future expansion plans, and that there have been no delays to any sites required to meet its contractual commitments. Again, Oracle shares trading lower now by 3.8%. We're looking at a down Friday right now, on track for a losing week on the S&P 500 index. The Dow, the S&P, NASDAQ, they're all in the red. S&P 500 index trading lower by 1%, 68 points lower at 68.32. Yesterday, you recall the S&P was at a record. The Dow down 220 now, down 0.5. NASDAQ down 1.5%. NASDAQ 100 index after Broadcom earnings down 1.7%. Broadcom, by the way, down 11.2%. 10-year 4.18% with the 2-year 3.52%, and the 30-year 4.85%. Gold up $11 the ounce now, $42.91, up by about 0.3%. West Texas Intermediate crude oil down 0.1%, $57.52 a barrel. And Bitcoin just above $90,000, but Bitcoin today down now by just about 2.9%. Keeping an eye on those pot stocks right now. We have got shares of a number of those companies advancing, surging right now. Let's begin with the ETF. MJ on the ticker, the Amplify Alternative Harvest ETF. It is up now by just about 37%. Tilray up 39%. And Canopy Growth up by 51% right now. Sources tell Bloomberg President Trump is expected to direct his administration to move to reclassify marijuana as a less dangerous drug. Recapping, S&P down 70, drop there of 1%. And for on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, got it, Charlie. Thank you so much. We're going to talk more about Oracle in our next block. In the meantime, we want to get to, we're still thinking about Fed because it's definitely playing out in the trade today. Fed officials, including two who will become voting members next year, offered strongly opposing views earlier today on what to do with interest rates, Tim, continuing a debate that will grip the U.S. Central Bank into the new year. I am imagining that it's going to be a spirited conversation around the table there at the U.S. Central Bank.
Holiday dinner.
Yeah.
I like that.
Yeah, exactly.
With us on All Things Fed and more, Bloomberg TV and radio international economics and policy correspondent Michael McKee joins us here in the Bloomberg Business Week studio. So Goolsbee cites the need for more data in a dissenting vote. Hammack says she prefers slightly more restrictive rates. Schmid cites too high inflation as reason for dissent. We're hearing from some of the dissenters. What's the collective voice that we got today?
A collective voice was dissent. These were mostly the people who opposed the idea of cutting rates farther. The interesting thing about Jeff Schmidt, the Kansas City Fed Bank president, and Austin Goolsbee from Chicago, was they both tied it to visiting their constituents.
So the anecdotes.
Being out in the districts and having people tell them that prices are their major issue and that they are really concerned about inflation. And as Goolsbee put it, we just can't assume that inflation is going to be transitory.
Okay, so you make a really good point about consumer behavior and inflation expectations. What does it mean for the way a consumer behaves if they're worried about inflation?
Well, in theory, you would spend more money today, but that's not necessarily what's happening. It's more that people's decision-making will be affected by the idea that they think prices are going to be higher. So they may or may not spend, and the economy slows down, and the Fed, if inflation is higher, is going to be raising interest rates, not cutting interest rates. Now, there's still a minority on the Fed, but it's a growing minority. And as you mentioned, Beth Hammack is going to be a voter next year. Now, Goolsbee and Schmid they're done voting for this round. But Beth Hammack is going to be voting next year, and she's definitely in the hawk camp.
Mike, we've done some reporting. Bloomberg News has put out some stories about K-shaped economy, but really talking about which consumer matters most to the U.S. economy, and they tend to point to the higher end consumer. So are they feeling the inflationary pinch as well?
No, not really. I mean, I thought the most important consumer was you, but...
Don't tell my husband.
When you go shopping, yeah. No, the people who have enough money spend just on what you would call discretionary. They're not worried about grocery prices and things like that. And those people are the ones that are holding up. Those people are the ones that are going to the luxury brands and still spending a lot of money. But with the lowest quintile and maybe the lowest two quintiles, they're the ones who are clipping coupons or cutting back or switching from. Everybody switched away from steak to chicken, but they're switching to other products that are cheaper because they're having trouble making ends meet. And Jay Powell made a point that is not incorrect. It's not so much that inflation is accelerating too much. It's only at about 3%, but that people are just used to, they're comparing to what we saw before the pandemic, and prices are high now, and they're not feeling that their wages kept up.
I guess my point is, like, there's a social conversation. We've had it many times that this is not an economy where everyone benefits equally, right? And we know that. But I guess what I'm trying to say, if we just put on the economic hats, as you do so well, is it that the higher end consumer in terms of the U.S. economy is a lot more important? So that we care from an economic perspective what they are doing, that's more important?
Well,
again, I'm not. I'm taking my heart out of the equation.
There are fewer people in the highest quintile or in the highest decile, and so if the rest of America decides to
pull
pack
back
it in and the economy goes into recession, then everybody loses. And of course, if companies think things are going bad and they start firing people, then that spreads. And as you see today, the stock market's going down. We've been talking for weeks about, are we in a bubble? Is this going to be it? And maybe this is it, maybe it's not. But at some point, the stock market goes down, and then even the wealthy people stop spending. They've got the money, but it's the wealth effect, the idea that I'm going to have the money to pay this bill when it comes in the door.
Before we let you go, just pushing ahead to next week, we get some data, housing starts, new home sales on Monday, November payrolls. On Tuesday jobs day.
Tuesday jobs day.
What are you expecting? What are we expecting?
Very confusing jobs report.
Because first of all, the fact that it's on a Tuesday, you think you have trouble with the date today?
It's already confusing.
Well, we're going to get this all the way into the new year. It's going to be 2026 everywhere except the Bureau of Labor Statistics. They are combining the October and November numbers, but the October numbers will only have jobs created, and it may not have the entire data set.
So do we just throw it out?
We won't get an unemployment report. No, they couldn't collect it.
Oh, okay.
So we don't get the household side, which tells you what the unemployment rate is and things like that. And then we get the November numbers, which will get both sides of the report, but it may not be complete. It may not be a 100% or close to 100% participation rate because they had to start late. So the Fed's going to look at this and say, this is interesting and it's good news, but the real issue is wait for the December numbers that come out January 9th.
Just it's like crazy, right? Until everything gets reset and back on track.
Yeah.
And that'll be hopefully in the new year.
When will that be?
I don't know. But we'll certainly be continuing to lean on you. Mike, thank you so much. Michael McKee, Bloomberg TV and Radio, international economics and policy correspondent right here in studio. Let's broaden out a little bit and let's get into maybe investors, how they've been reacting since we got that Fed decision and what we are seeing with investment flows and what's going on in terms of activity.
For that, we turn to Stephanie Gill, Chief Investment Officer over at Robinhood Markets. She joins us here in the Bloomberg Business Week studio. Stephanie, I wanted to start with what's happening on the Robinhood platform because you certainly have a certain segment of the investing population. What are you seeing on Robinhood right now?
We're seeing still net buying, but it's been more muted, I'd say, than it was before. And it's been in some of the things that have been going down or had, like Netflix, for example. You've also seen where there's been sales, it's been more in the AI-oriented names. So I've kind of shared this before, but our customers tend to hold core positions and trade around them, meaning they buy when they go down and sell when they go up. But we're seeing a little bit differently where there seem to be like being more subjective about what they're investing in. And that's why I say like it was kind of interesting to see NVIDIA being sold and things that are kind of under pressure.
So selling rather than selling as they have gone up a lot and taking some profits, they're selling as they're going down.
Yeah, but they probably have embedded profits because they've held them all year. So I think that's like kind of giving up a little bit on the AI trade for now.
Well, like I totally get it. Like, Tim and I were talking about Oracle. Like it is still up almost 14% year to date, but we've seen a more than 40% decline from some of when it hit a record back in September, excuse me. So, I mean, how much can you dig deeper into the data in terms of what you're seeing? Is it Mag 7 names that people are getting out of? Is it all tech? Is it just AI related? Like, what are you seeing?
It's just the AI related that I've seen, and then some of the like CoreWeave, those kind of names that are
the
like
neo cloud names.
Yeah, exactly. You've also seen some buying in just broad-based ETFs and some T-bill oriented ones that like kind of make me feel like diversification, kind of parking things rather than trying to pick.
So less playing the market and more like long-term diversified index funds?
I think for now. Wow. Usually we see that activity when there's a big dip, like they go into ETFs first and then they play the differences in names.
How are they playing this? I don't want to call it a crypto winter yet, but we're down another 3% on Bitcoin, hovering around $90,000 per Bitcoin right now. How's that played out over the last couple of weeks?
In the stocks, I've seen actually some buying in like the MicroStrategy names, but on the crypto side, I've actually seen more selling than buying.
Interesting.
Yeah.
So instead of actually holding the patterns that you're seeing, instead of actually holding the cryptocurrency, people are instead putting money into the proxies or the hoarders.
Yeah,
Okay.
I mean, if you can make that relationship, I kind of look at two different dashboards, like crypto versus. But I did think it was interesting to see buying into the equity related.
Yeah, because certainly strategy has had its own set of challenges.
Yeah.
Okay, so let's back out a little bit and talk big macro picture right now. We haven't had a chance to speak to you in a few weeks, and given what we heard from Jay Powell, what we just heard from Mike McKee about different views of the economy coming from different people, where do you sit?
I think the economy's okay, actually. Like, I think this is totally anecdotal, but my feeling is that, like, New York City is busy, travel is a lot. Like, I actually think the consumer's generally okay. That being said, the lower end consumer is still not doing well, and I don't think they've been doing well for a while. So I do think things got overvalued market-wise. So I do, and I also think that the Fed is caught between a rock and a hard place, because you do have this explosive growth in the AI trade, growth in credit markets, and so they have to kind of worry about that being overblown and that creating increased inflation. Obviously, we don't know what's going to happen with tariffs, but that's creating an issue for them too. Then you do have the lower end consumer that is still struggling. So it makes me think of, like, Europe post 2008, when they had to worry about, like, Spain versus Germany. And so that's why I think there's so much of a debate within the Fed. And, Powell did say, like, don't even look at the data that's going to come out next week.
Do you agree with him?
Who doesn't? Yeah.
I worry about the quality of it too, like, in general. So
I want to ask you about, I'm looking, we're almost at the end of the year, so we can look at the S&P 500, the major industry groups, and see what really did well or didn't do. I mean, communication services names, 31% higher, information tech, 23%. So even though, I mean, the Mag 7, even if we start to see, pullbacks on some of these names, or the AI trade, still outperforming. Industrials up almost 20%, financials up 13%. I'm looking at the S&P Composite Pharmaceuticals Index. It's up almost 21%.
Finally now, yeah.
Yeah, finally, exactly. So I'm just curious, what else can you dig deeper in a year where we've talked so much about AI, we've talked about rare earths, we have seen some, M&A activity going on. What is it that you have also seen that are interesting, and you can get an idea of what investors are interested in and what they are not interested in?
I've been bottom fishing. Like, we've been, I sorted, like, the Russell 1000 into, top and bottom players. And it just felt like there was a rotation that started on October 29th, which was when we had that, like, 6% pullback. And a lot of those names, like, of the top 100, the ones that are up the most, 100 most this year, 41 of them are in a negative return since October 29th. So we've been kind of looking around being like, where is there still growth? And I actually think, like, the other thing we've been doing this year is investing in alignment to fiscal policy, because we do think, like, what the Trump administration is doing is important to understand. And I think the consumer is going to be more important for them this year, or coming into next year, I should say. And so we've been looking more in, like, the retail space of players that are interesting. And so
retailers, which have been reported,
and brand names in retail, like On Holding, Lululemon, like, they're down, they're down double digits this year, or maybe not On after yesterday, but
Lulu is for
Lulu,
sure.
yes, there is down 50%. It's up 10% or so today, and so we just think, like, there is value to be found there while we wait to see what happens in the tech world.
But on a Lulu, for example, doesn't a lot of that depend on who the next CEO of the company is, and they don't even know who that's going to be yet.
There is execution risk there now for the CEO, with obviously the change in the CEO, but I think it lost some shine on its brand, and I think they have done a lot to try to turn that around. And you've seen that in Gap this year, which is also, like, I think they're further into that journey. But I think it actually creates an opportunity.
Yeah, Gap's been doing really well of late.
Yeah, it's now up about 11% year to date. But your point is, right, that if the consumer feels better and is out there spending, if we get more juice in terms of the way of stimulus, whether you believe it's the right strategy or not, if there's more money in the pocket of consumers...
Try not to invest in my heart.
I know. It's going to go somewhere. Yeah. And so there are names that will certainly benefit. Great stuff. Love digging deep into your platform. Stephanie Gill, she's Chief Investment Officer at Robinhood Markets, joining us right here on Bloomberg Business Week Daily. On a day where we are seeing, Tim, stocks under pressure, down 1.8% on that NASDAQ 100.
Yeah, but off our worst levels of the day. The S&P 500 down 1% right now. The Dow down just 0.5 percentage point.
All right, when we come back, we've got a couple of tech stories we want to dig a little bit deeper into, including Oracle pushing back on AI data centers. Or are they? Because they're pushing back.
They're pushing back on the pushback.
They are.
Also, Broadcom taking the socks with it. Our tech roundup. That's coming up next on Bloomberg Business Week Daily.
Meet the all-new Fidelity Trader Plus with your preferred tools, customized charts, and streaming data, so you can start a trade idea on one device and execute it on another. Meet our most powerful trading platform yet, Fidelity Trader Plus.
You can't control the course or the competition, but you can control what you do next. Tiger Woods built his career on the ability to reset, adapt, and make the next shot count. Insperity is built to help businesses do the same. You deserve an HR partner that's there to help you thrive, no matter what comes your way. Insperity, because how you HR matters.
Premium benefits anywhere you go. Unlimited, zero trading fees. 6% back in crypto. And other exclusive benefits with Level Up. Take your wealth to the next level.
This is a book, but it's also a teacher. In 2024, nonfiction book sales reached almost 362 million copies. Bookstores and publishers are thriving as retailers reimagine stores as curated experiences, using connected technologies to track inventory, manage supply chains, and increase sales with tools that depend on reliable and secure connectivity from AT&T Business. Because reading is a journey of discovery, and a book is a compass that helps us find the way forward.
At Mizuho Americas, we know this course, and this one, and this one, and definitely this one. We know them well because we're experts in banking and global markets. Mizuho Americas, a name worth knowing.
Of department stores.
It's a storied retailer, but we never want our rich history to get in the way of our brighter future.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. We are looking at losses right now for the Dow, the S&P, and NASDAQ, with the S&P 500 index down 75, now at 68.25. That is a drop of 1.1%. Dow Industrials down 252, down 0.5%. NASDAQ down 377, drop there of 1.6%. The NASDAQ 100 index down 1.8%. Oracle down 4.6%. Broadcom, after earnings, down now by 11.5%. We've got the 10-year currently yielding 4.18%, with the 2-year 3.52%, the 30-year 4.85%. Gold up $15 the ounce, $42.95, up by about 0.4%. West Texas Intermediate crude oil flat on the day, $57.58 a barrel, and Bitcoin now down 2.8%. Of Bitcoin is at 90,250. After earnings, shares of Lululemon Athletica, they're up by 10.5%. Shares of Costco after earnings down 0.5%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Massar along with Tim Stanovic live here in our Bloomberg New York studio. Hey, we're keeping a watch on Oracle. Stock lost about 11% in yesterday's trade, down another 4.6% in today's trade. We did have a redhead crossing the Bloomberg earlier today, and that headline talked about Oracle pushing back the completion dates for some of the company's data centers that it's developing for the artificial intelligence model developer OpenAI, pushing it back to 2028 from 2027, according to people familiar with the work. At the same time, Oracle has come out, though, and they're pushing back on that. So we wanted to get into it with Bloomberg News technology reporter Brody Ford. He's joining us here in studio. First of all, we know Oracle has commented on this, and they're saying they're pushing back. Tell us, though, what you guys found out, what you found out.
Right. Yeah, Oracle is saying that we have a huge contract with OpenAI. That's, 4.5 gigawatts. They're on the hook to develop data centers larger than have ever been done and in a shorter time frame. They're saying that we're going to be able to deliver on our contracts and deliver on our expansions, right? What we reported today is that it's hard to build data centers. And they're already seeing some delays, right? Yeah. And we're seeing this across the industry, that companies that are very good at software are getting involved in this business of standing up big data centers, but finding that there are some physical issues, right? You can't find enough labor. You can't find enough electricians in Texas. You can't find enough electrical infrastructure. So what we're seeing is that the company is on the hook to do some very big things with infrastructure, and it's, going to be maybe a little tougher than it seemed at first.
So it has nothing to do with demand or changes in demand. It has all to do with supply and challenges with all the supply that you talked about.
By all metrics today, demand is insatiable, right? I mean, if you went to OpenAI and said, hey, we have 100 of the largest data centers and we'll sell them to you right now, they'll probably sign the paper, right? So today, the demand for AI compute is through the roof. What a lot of folks on Wall Street are getting a little more anxious about is that in the long term, how much does this stick around, you know?
So let's broaden this conversation out a little bit, because you have a big takeout today, just crossed for Bloomberg Business Week. It's written along with Drake Bennett, and it dives into a question that Carol and I have really been talking about for, gosh, I think probably 3 months at this point.
At least,
since that last Oracle earnings report.
You can't forget it.
Yeah, you can't forget that one. Yeah. And that's why Oracle has turned into this poster child for whatever some investors are calling could be some sort of bubble with AI. Why is Oracle in that position?
To put it simply, because they're so levered.
It's all about that.
Oracle is one of the world's great cash creating machines. Its database software it's fueling this room, it's fueling many corporate rooms, and Oracle said that, hey, we see this AI moment coming, and we're willing to throw all of our cash and then some at becoming the AI infrastructure provider. Where the jury is still out is that a good business to be in?
So, when we talk about AI, the spend, for such a long time, Brody, it was about NVIDIA and their chips. Yeah. Where is Oracle exactly? Like, what is it that they are providing and what they are doing?
Yep, good question. So they buy a ton of NVIDIA chips, rent out some data centers, put the two together, and then sell that capacity to somebody like OpenAI. And that's making it sound simpler than it is, because there's a lot of logistical work that goes in there, but they're effectively a project manager. They're the quarterback of getting all this stuff together between the real estate developers, the chip makers, and the customer.
So why do people want to work with them, and rather than just do it on their own directly? Because we do know, right? Some the hyperscalers, a lot of them are just kind of doing it on their own, right? Or are they not?
Well, Oracle is effectively trying to become a hyperscaler. They're trying to become, Microsoft built its own AI and they build the data centers. Oracle has kind of emerged as a specialty player for AI infra. They wouldn't put it that way. They want to serve all types of workloads, but where's the opportunity right now? It's in AI.
There was a period in September where Oracle shares surged 47%. In just a matter of a couple of days, thanks to a robust earnings report, a robust outlook, and then announcing some big deals. Since then, it's down about 42%. What was the catalyst that got investors to think differently and then also price these credit default swaps the way they've been priced?
Oracle has been trying to get into the cloud infrastructure game for years, and for a long time, it was they were kind of made fun of. They weren't taken seriously. Yeah. What's changed so much lately is they got this massive booking with OpenAI, $300 billion in commitments. And so that's when in September we saw the stock go crazy. But what happened after that is OpenAI went around town and kept signing commitments with everybody else. And it led investors to say, okay, can they actually pay these bills?
What is a commitment? What does that mean?
A commitment
that's what investors were questioning. Well, if OpenAI is making all these commitments, can they actually follow through?
Can they actually follow through
with these commitments?
Is Oracle going to get the $300 billion, or is
Yeah. I feel like this reminds me of like the Amazon spend, and investors were, they weren't profitable and blah, blah, blah. And then all of a sudden it was like AWS came out of nowhere and they just owned market. Brody, don't go anywhere. I want to bring in our own Ian King. He's Bloomberg News U.S. semiconductor reporter, because there's a lot going on, but one of the other things in today's tech trade is we've been looking at what's going on with shares of Broadcom specifically, because we've seen this stock really take a big beating. I just want to pull it up on my Bloomberg here, and you've got shares of Broadcom. They're down almost 12% in today's session, so hovering near their lows of the session. It's a company, a chip, a company, I guess that you could say, that is really vying with NVIDIA when it comes to AI computing revenue. I want to bring in Ian. He's out there in our San Francisco bureau. Ian, the stock's getting really beat up. Having said that, if I look at the year to date, the stock is up almost 55%. So the quarter, what we got from Broadcom, not so bad, but was it just expectations are so high right now?
I mean, the numbers were fantastic. Obviously, compared to where they were a year ago, they're doing really well. But that's kind of the case for all of these AI companies. If there's a through line between, Broadcom and Oracle the day before, it's that where is all of this coming from, right? Yesterday, Broadcom talked about huge orders from Anthropic. There was also some confusion about what kind of business it's doing with OpenAI, like Oracle. So I think, any uncertainty, anything that isn't, fantastic and immediately supportable is creating concern amongst investors right now, and that's really what's happening.
Ian, in the past few months, we've also talked about this idea that Google's got a chip that it's had for a decade that can kind of hold a candle in some cases when it comes to inference, at least to what NVIDIA is doing. And we saw shares of Alphabet move higher as a result of that. Remind us of the relationship Broadcom has with the companies that are trying to take on NVIDIA.
Yeah, it's complicated. I mean, you have to think of Broadcom as like an architect. It's like you've got a lot of money, Tim. You want a flash new house. You go to an architect. The architect basically creates the blueprint that then you take to the builder, which in this case would be TSMC, and they create the chip. So anybody that's wanting to make their own chip that would be potentially a rival for NVIDIA's GPUs tends to go through Broadcom and say, "Hey, help me out with the blueprints here," and that's what they're doing. So they're taken as like a benchmark for how well these efforts that these companies like Google, like Microsoft, like AWS are in terms of their roadmap towards competing directly and replacing what NVIDIA does.
So it makes sense that Alphabet, Apple, and Meta Platforms are among the biggest customers of Broadcom.
It totally 100%. Makes sense. Ian, I feel like we've had this conversation with you about Intel, once the chip king, and no more. NVIDIA, the chip king, although it looks like even there has been a little pecking away at some of the narrative around that company. I mean, Is there enough to go around, or are we likely to see some things maybe change, even in the fortunes of a company like NVIDIA? Or does it look like what you're hearing in terms of orders and the AI build, that it's still going to be a company that everybody's going after?
I mean, back to what I think Brody just said, which is right now there is no evidence of a slowdown. There's no evidence that, things that we're overbuilding, that there isn't a fundamental demand to support all of this investment. That doesn't mean that we won't get there or get there soon. When that will happen, we don't seem to know right now. What is, I think, a growing uncertainty is that who is paying for it? Even though these companies have got fantastic growth in terms of viewer numbers, is that reflected in revenue? Is that reflected in profitability? And I think for this to have a continuing surge along the same lines that we're seeing, we have to see more of that coming in. We have to see more profit dollars being shown to the world rather than just profit dollars of those who are basically being paid to build the systems.
That's a big thing I heard a lot too when thinking about Oracle's success, because effectively for Oracle to be successful, OpenAI has to be, and for OpenAI to be successful, it can't just be ChatGPT. It can't just be a couple of hit AI products. All of this spending is premised on something that's truly transformational, that really redefines a lot of industries, saves a ton of money, and it's like the level, it have like the internet level, right? And we are just not, we don't have a line of sight there yet.
Right, that's exactly what we're trying to figure out. And if that is the promise, then there are some serious structural issues with the way the economy is laid out right now. I mean, so many unknowns, Brody, that people are concerned about. And we even look at the what David Sachs said earlier today on Bloomberg TV with Ed and Caroline, that there are a lot of people who are concerned about losing jobs as a result of AI, but he cited a Yale study that he said, this is David Sachs, that said, we haven't seen a loss in jobs correlate with the introduction of ChatGPT. So it's not, he argues that it's not materializing right now.
Yeah, I mean, I think that's true. I think we've all used these tools, right? They're good, they're not great. I think, they've been around long enough that we've seen the booster cycles, and 2 years ago, there were a lot of promises made that haven't happened yet. Now, they're good tools. They're used a lot, and they are transforming some industries, but for all this to pay off, it needs to go further.
30 seconds to you, Ian. Hock Tan saying he didn't give an annual AI revenue forecast, saying it was a moving target. He'd rather not give guidance on what is going on in 2026. Are you comfortable with that? Is that him being very honest and just, it's not bad, it's just a moving target? Or is it a little bit of being cautious?
The problem is, Wall Street is not comfortable with that. In the past, we like Hock and his directness. There were a lot of questions and a lot of seeking clarity yesterday, and people came away with that not entirely sure when this money is going to come in.
And that's why you're seeing the price really tank in today's session. Gentlemen, thank you so much. Bloomberg News U.S. semiconductor reporter Ian King, and of course, our own tech reporter, Brody Ford, joining us right here in studio. All right, coming up, a view from the C-suite.
Meet the all-new Fidelity Trader Plus with your preferred tools, customized charts, and streaming data, so you can start a trade idea on one device and execute it on another. Meet our most powerful trading platform yet, Fidelity Trader Plus.
Tiger Woods built his career on forward thinking, staying ahead of the curve and away from the expected. Insperity believes that in business, it's no different. They're dedicated to driving your business forward, providing the HR support you need to innovate and win. You don't become one of the greats by doing things the same as everyone else. You take a swing, knowing you've got the right partner by your side. Insperity, because how you HR matters.
Premium benefits anywhere you go. Unlimited, zero trading fees. 6% back in crypto. And other exclusive benefits with Level Up. Take your wealth to the next level.
What we're looking for in the United States is everything. So we've been working together since the 30s. And I think our partnership will continue for many, many decades to go. We have, invested in Lucid, and Lucid now have their own manufacturing facility and plant in King Abdullah Economic City, north of Jeddah. We brought in Pirelli, Hyundai, so many other companies to come and invest in Saudi. Not only that, we are doing a lot of procurement from airplanes, Boeing, Airbus, and one of the things that we asked them to do for us if we do the procurement is to get some of their manufacturing or MRO centers to the kingdom. And in this way, we're both winning.
Tech. This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg Television.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Every weekday from 3 to 5 Eastern.
Only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geoeconomic news whenever and wherever it happens. I'm Bonnie Quinn in Sao Paulo, Brazil, and this is Bloomberg.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. That rotation out of tech stocks gaining momentum this afternoon after disappointing earnings from Broadcom and anxiety about Oracle's data centers renews worries about the AI trade. Right now we got Oracle down 4.5%. Broadcom after earnings down 11.4%. Bottom line here, tech stocks selling off. NASDAQ 100 index down 1.8%. NASDAQ Composite index down 1.6%. S&P keeping it all in context. That is down 1%. Dow Industrials down 0.5%. 10-year 4.19%. We do have spot gold right now trading higher, up 0.4%. 42.96 the ounce. West Texas Intermediate crude 57.44 a barrel, down 0.3%. Bitcoin down 2.9%. 90,221 on a Bitcoin. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, RBC Capital Markets among the analysts that raised its price target on UiPath following recent earnings. In one note from RBC, they said the company is set to continue recent trends like net new annual recurring revenue, also known as NNARR for those keeping track. They also cited stabilization and improved profitability despite debate around its role in an increasingly agentic automation world. That is something we're going to dig into with our next guest.
We got Ashim Gupta with us, CFO and COO of the $9.4 billion market cap company UiPath. The share's up close to 40% so far this year. 12% of the float is shorted. Also with us here in the Bloomberg Business Week studio, Nina Tretman, Bloomberg News senior editor. She writes the CFO Briefing newsletter. You should subscribe to it at Bloomberg.com/CFO briefing. Ashim, good to have you on the program. An application software company, robotics, automation software. Remind everybody and introduce people who don't know exactly where you play in the industry. Who are your customers and where do you fit?
Yeah, thanks so much for having me. For those who don't know UiPath, UiPath is an AI-powered platform that helps businesses and enterprises transform their enterprise processes and organizations to yield productivity and ROI. We do so by emulating what humans do through both deterministic, rules-based automation and agentic automation, using agents and AI to automate a lot of those tasks. You know, we own more than half of the Fortune 500 companies in the world. We have 10,800 customers that span industries from financial services to healthcare to the US federal government. And we operate in over 100 countries. The reason for that breadth is because we are very relevant to what every enterprise of almost any scale does in terms of taking away mundane work to yield for a more productive workforce.
So wait, so do me a favor, just because I'm stupid and it's Friday. So tell me, I'm okay, I'm really okay with it. Give me just in 30 seconds a quick example of a company that you work with and what you do for them.
Yeah, so Carol, Voya Financial, just as an example, is a large-scale bank in the United States. We're working with them to automate their everything from HR operations, such as employee onboarding, to financial processes. If you step back and look at almost any enterprise that's there, think about something as mundane as procure to pay, where you're receiving invoices, entering them into systems, then moving that data that you're entering into systems, doing reconciliations. That work can be done by software and does not need to be done for the hours that people are putting into it. You take something like that as a simple example, but then you can go and you look at a Fortune 10 healthcare company that we work with. All of their claims processing gets touched by our software. Entering data, analyzing and understanding data, and with agentic, providing reasoning to allow for decisions to be made. Those are two examples.
Just wondering, Ashim, in your finance organization, are you using it there too?
Huge. You know, when you look at UiPath has scaled from almost zero revenue in 2017 to over $1.8 billion of ARR to where we are today. Within our finance department, but across our enterprises, we employ our own software. So we have not had to add people net to our company in many years. We've been able to achieve that scale both geographically as well as from a revenue perspective using automation. And that's not unique to us. That is something that a lot of our customers benefit from.
Okay, so we all sat up, Ashim, a little bit straighter, because there is so much of a narrative and conversation going around AI and what it's going to do to the labor market. It sounds like you haven't had to hire people. Reality check, are a lot of companies going to be able to not hire people or even let people go because of what AI or agentic AI is going to be able to do for them?
Yeah, let me make a small nuance here. Okay. We've hired people just in the places that provide higher return in terms of revenue or higher paces of innovation. So in our minds, companies should be hiring and people will continuing to work, but it's going to be working in higher skilled areas and areas that have a higher return to the enterprise, whether that is working interactively with customers or whether that is on pace for designing the next feat of innovation to bring to the market over the next couple of years. So this isn't about hiring less, it's about hiring where you want to. And all of that translates to ROI.
Ashim, just wondering, we've seen a lot of concerns in recent weeks, specifically in November, among investors around AI and whether what we're currently seeing is leading us into a bubble at some point. If you look at your bookings for next year, like what does that look like? And what's the feedback that you're getting from clients if they're thinking about their spending plans for next year?
Yeah, look, I think what our customers feel is they feel a variable macroeconomic environment, I think like all of us do. And, you know, a lot of times what we all discuss in our various forums, whether that's formal or informal, what I can tell you is what's encouraging is customers want to spend. The key area is they're not going to spend unless they see ROI. So as we're looking at our demand funnel, we launched our agentic platform, bringing agents and AI infused automations to enterprises earlier this year. You know, if you go back to maybe 2016, 2017, 2018, there were innovation funds that you could go and say, hey, let me go and spend $2 million and just experiment. I think experimental funds are moving down, but there's a lot of funds available that for projects and areas that yield ROI. So once we launched our platform, the demand for proof of concepts and pilots really we're super encouraged by. Even in the first 5 to 6 months, more than 700 of our 10,800 customers, these companies are going and building agents on our platform and figuring out where are the highest ROI areas. So there's a lot of activity, and I think funding will follow activity so long as that there is ROI that is there, and that's what gives us a lot of confidence and optimism as we look into the years ahead for UiPath.
Ashim, very briefly, very interested in the work that you do for governments in the US and around the world. How do you characterize that work? Like, what do you do for them? And also, how big of a business is that for UiPath?
Yeah, so the public sector is it's greater than 10% of our revenue base just globally. That was as of 2 years ago. We haven't disclosed figures since then, but it's, I would imagine it's in a similar vein here. I can represent that. When you look at the US government, it's everything from areas of agencies that are in high paper network. They use our software to actually scan, read, and extract data so they can process things fast. There are partners that we work with the government that are taking papers that are sitting in caves and in parking lots, trailers and trailers of them, and digitizing them as a part of their digital transformation. Getting audit compliance across the government, which involves retrieving documents and processing different areas for auditors and business teams, that is a key area that we can look at. But we're across every agency that is there. What I'd say is we've gotten super close to the government over these last years. We've continued to have a great relationship with them. And just like enterprises, what's encouraging is they're looking for high ROI, high impact, transformative areas to deploy our software.
All right. Well, super interesting. And I hope you'll stay in touch so we can continue this conversation. Ashim Gupta, CFO and COO of UiPath, joining us from afar. And of course, right here in studio, Nina Tretman, Bloomberg News senior editor. She writes the CFO Briefing newsletter, which you can subscribe to at bloomberg.com/CFO Briefing. You get a new one every Sunday. Nina, thanks.
And Ashim will be featured in an upcoming edition of the Bloomberg CFO Briefing newsletter. Also, for more coverage of CFOs, you got to check out Chief Future Officer, the series from Bloomberg. The newest episode premieres next week. It features the CFO and COO of Hasbro. That's Gina Getter. Watch next Wednesday at 9:30 New York time. This is Bloomberg Business Week Daily.
Meet the all-new Fidelity Trader Plus with your preferred tools, customized charts, and streaming data, so you can start a trade idea on one device and execute it on another. Meet our most powerful trading platform yet, Fidelity Trader Plus.
Premium benefits anywhere you go. Unlimited, zero trading fees. 6% back in crypto. And other exclusive benefits with Level Up. Take your wealth to the next level.
Thanks for walking us through the plan.
Have fun with Lizzie this summer.
Doors connect us to what's important. A dedicated Fidelity advisor can help you open those doors. Backed by a team of specialists, they'll help you build a personalized investment strategy. Doors were meant to be opened.
Very low. Stablecoins today have $20 billion of flows a day. It's less than 1% of the flows of the payment system in the world. But because they have the ability to be very helpful in use cases, particularly in retail to begin with, but then potentially on the wholesale side, I think we will see a lot more of them.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg. You're listening to Bloomberg Business Week Daily with Carol Masser and Tim Stenevec on Bloomberg Radio and Television.
All right, everybody. We are coming up on the last hour of trading on this Friday and also for the week overall. Let me just pull up my market boards. And right now, we're off our lows of the session, still down about 1% on the S&P 500. NASDAQ 100 still down about 1.8%. We've really seen a pullback on the trade when it comes to kind of almost anything related to AI. So that's where we're kind of ending up on this Friday, which has been a jam-packed week.
It has.
Again.
You actually even thought it was Friday the 11th, but it's Friday the 12th.
Yeah, I'm having trouble with that. I gotta check my calendar.
If we take a look at how stocks have shaped up this week, as we do get to an hour left in equity trading, down 0.6% on the S&P 500, the NASDAQ Composite down 1.5% this week. The Dow, though, Carol, up more than 1.1%.
Yeah, that I think has been interesting, the rotation, which says maybe, again, out of maybe some of the momentum trade and then into some other less loved parts of the market. It's just kind of interesting to see that. I'm Carol Masser along with Tim Stenevec. Let's get to some stocks on the move on this Friday. With us to do that is Bloomberg cross-asset reporter Denitsa Sokova in the house. And we're going to start with Oracle. We've been talking about this one a lot today.
We've been talking about it a lot this week and in the past month, and it's really shaken the whole AI trade. We see the Nasdaq is down today, the S&P is down today, and a lot of it came after the news that Oracle has pushed back the completion dates for some data centers that is developing for OpenAI. Initially, they were going to be in 2027. Now the date they have is 2028. The ticker, of course, is ORCL. The stock is down about 4.5%, but it's extending a 40% slump since September. There has been a lot of activity in their CDS. Investors have been growing pretty jittery about Oracle in specific, because that's a company that's obviously spending a lot of money. Oracle has been working to deliver 300 billion contract to supply the computing power necessary to train open AI models. Capital expenditure, we recently got a report from them, came at about 12 billion in the quarter. That's an increase of 8.5 billion. So this is the number investors have been worried about. It is more than analysts were expecting. They, of course, expected high spending anyway, but this is even higher, and you can understand why some of the jitters are appearing. And of course, circularity of deals. It's always the same names, and Oracle is there.
Okay, well, speaking of the same names, let's go to Broadcom, a chip architect that works with some of the companies that are trying to take on NVIDIA.
Yeah, and that was a big winner. The company was up 75% before the sell-off. We're seeing now big drawdown today. Shares were down more than 11%, approaching a 12% drop. The most intraday since January. The sales outlook failed to meet investors' expectation. The ticker is AVGO. It really happened after some unsettling commentary yesterday from their CEO that said the company has a 73 billion in AI product orders backlog. He later tried to suit investors and said that that figure was a minimum, but nevertheless, we're seeing a really, really big sell-off, and the combination of Oracle and Broadcom is really dragging tech stocks down. Investors were seeking more clarity on when and how the company will get a payoff from AI, but instead they didn't even get a forecast for AI revenue for 2026. So, the worries are there. We saw some good numbers. Sales will be about 19 billion in the first fiscal quarter, which is more.
Ian King said that it was a really good quarter for Broadcom.
The report was good, but no one is looking at what's happening now. Everyone is looking at the outlook, and any small disappointment, it happens a massive loss. Yeah. Two-digit drop on a day. It's just
Okay.
incredible.
So if you don't like the AI trade, just go out and buy some yoga pants.
Yeah, that's
the shares of
that's the winning
Lululemon.
trade. If you want to be up 11% today, the ticker is LULU. Lululemon shares rallied after the yoga wear maker boosted its full-year outlook and announced that its chief executive officer would step down. There has been a lot of competition. There are so many brands that offer $100 yoga pants, and Lululemon has kind of taken the back seat for some time. There is Alo, Nike even has like a Skims partnership, and those have been very popular. We're seeing some positive results in Lululemon after a pretty tough few years. Lululemon's fiscal third quarter report had several positive signs. Profit and comparable sales is something analysts are pointing that there is some optimism there. The company has been pushing to improve their products and to increase their allure. They have some new fun things that have been working, but nevertheless, the company is down 50% before today's rally. So it's been a tough year, but people are looking forward to more yoga pants and more optimism in that area.
I want to live my whole world in a pair of yoga pants. Sometimes that's what I'm wearing in the studio. Just throw on a jacket and wear some yoga pants.
I'm going to talk about Chip Wilson. He's the Lululemon founder. He blasted the company's board after its leadership changes. He said the directors failed on succession planning and allowed what he calls significant value erosion under CEO Calvin McDonald. He's making his voice heard as a huge shareholder of the company that he founded.
Yeah, I mean, listen, it's a higher end product. It's not inexpensive. You don't often see sales at Lululemon. We'll have to figure out, there's a lot more competition in that space.
Don't forget about your quarterly $75 credit, girl.
I just signed up on Amex.
I used my friend's credit. It was really good.
All right. Good stuff. Denise, thanks so much. Hey, check out our Stock Movers podcast, 5-minute episodes of the biggest winners and losers in the stock market. You can find it on Apple, Spotify, or anywhere you get your podcasts.
We're actually going to be speaking about what's going on at Lululemon with Bloomberg Intelligence's senior analyst for e-commerce and athleisure, Poonam Goyal. She's going to join us at the top of our show on Bloomberg Business Week Daily. I want to know what names are being floated.
Yeah, I do too. Also, we're going to get into the astronomical cost of defeating any foreign aerial attack. We are talking the Golden Dome. This is an incredible story. That's all ahead. If you're watching on TV, the close is coming your way. We continue on radio.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is the close.
The week for equities ends just like it started, on a down note. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking off to the closing bell here in New York, in the United States. The S&P 500 down by 1% on this Friday. A lot of that pain coming through when it comes to big tech, as you can see, after we got that disappointing read from Oracle and from Broadcom. I will just remind you, this is a week where we did hit a record high, but certainly feels far away on this Friday. The Russell 2000 also in the red deeply here, down by 1.3%. Not helped at all by the sell-off that you're seeing. The 30-year Treasury yield higher by 5-6 basis points right now. Some interesting Fed comments coming through. We're going to get into all of it, Romaine.
Yeah, we are going to get into all of it, but we have to talk about some of the questions out there right now about the scale of the AI build-out, the financing to facilitate it, and the potential return on that investment. Remember, that had already led to a 5-week sell-off in tech stocks. Well, today, you throw another log on the fire of AI skepticism with the news that Oracle is said to be pushing back completion dates for some of its OpenAI data centers, and Broadcom holding off on giving an annual AI revenue forecast. So that means the 5-week AI sell-off is now a 6-week slump. Investors now taking a more fundamental and, quite frankly, a more down-to-earth approach to the AI trade rather than putting their hopes and prayers into those moonshot expectations of earlier this year that conveniently ignored basic financial fundamentals. Moonshot expectations that had pushed AI stocks to record high after record high.
Given valuations, it makes sense for people to say, look, AI might be absolutely transformational for the way business is done a few years from now. It can absolutely increase productivity, but who are the winners? I think given valuations, you might want to diversify who you think might end up winning.
And of course, trying to value these companies, at least through traditional discounted cash flow models, that's getting harder than ever with the rise in Treasury yields. No coincidence that the sell-off in high multiple tech names since late October coincided with benchmark yields rising more than 25 basis points. In fact, since the NASDAQ 100's October 29th record high, Microsoft and NVIDIA are down 10%. Dell and AMD have dropped about 20, Oracle down 30, CoreWeave 40, and power stocks also getting dinged. Constellation Energy in correction territory, and Vistra and Vertiv right now, Katie, in bear market range. Are you going for the optimistic or the pessimistic?
I am. Look at this happy chart I have behind me. I thought it'd be interesting to take a look at how the global stock market is performing. Of course, we spent a lot of time talking about what's going on in the United States. And as I mentioned, we did see a record high this week, but take a look at the all-world index from MSCI behind me. You can see that we saw a similar drop when it came to early April with that tariff liberation day back and forth that we saw from the Trump administration. But look at the recovery since then. We are sitting currently right now at all-time highs when it comes to this index. A good reminder that it's not just the U.S. that we're seeing this performance from. You're also seeing it in Europe. You're seeing it from emerging markets. We've certainly heard a lot of optimism there, as well as when it comes to Asia, Romaine. The question is, what is going to be the catalyst to keep the party going in 2026, especially when you see a lot of central banks around the world, particularly when it comes to developed markets, maybe backing off from that easing mode.
Well, Mona Mahajan joins us right now to kick us off to the close. Maybe we can get some insights out of her, head of investment strategy over at Edward Jones. Mona, great to see you here.
Great to be here.
I'm not sure how you came into 2025 in terms of your optimism, pessimism levels, but I am curious as to where those optimism, pessimism levels are for you, at least with regards to equities here with 20 days left in the year.
Yeah, you know, look, we still think it's a fairly benign backdrop. We're looking at a 2026. It's probably still giving us a 2%-ish economic growth picture. We're looking at a Fed that is still likely heading towards a neutral rate. We're looking at an earnings growth picture that remains double digit. But keep in mind, there's risks to the story. There always are. And that includes, to your point earlier, AI uncertainty and maybe even a little bit of lingering inflation. So two things we're watching closely.
With regards to the AI uncertainty, is that uncertainty, or are we going to be talking about a material pullback in the AI tech trade?
Yeah, look, as we're exiting 2025, this is now year 3 of growth outperforming value, of tech and AI leading the charge forward. As we look at what's happening to the business models of some of these companies, they are getting more debt heavy. They are going from asset light to asset heavy, a lot of infrastructure, CapEx build out. And so we do think some of the margins and some of the valuations may come under pressure. Now, as we think about it, one of the things we say, don't fight the Fed, but also don't fight earnings growth. And we look at earnings growth for 2026, double digits, but the good news is it's coming from tech and non-tech parts of the market. So there is this case to be made that you should have some innovation exposure, but you should have some other parts of cyclical and value in your portfolio for the year ahead.
Well, I want to talk about tech a little bit more, and I want to zoom out here because you made an interesting point that you think about tech, they're going from asset light to asset heavy. That is a sea change. You think about, especially during the pandemic era, it was more the fact that, you know, they had a lot of intangible value. That was one of the big draws of tech. Is the nature of investing in tech changing here, or, you know, is this something that maybe isn't quite structural?
Yeah, you know, I do think markets have been smart in sniffing out those players that might come under pressure. So you think about a company like Oracle, already high in debt, has been taking on more debt to finance some of this CapEx spending, and you see what's happening in some of their CDS and multiple and valuation concerns there as well. So markets have figured that out. Now, a lot of the Mag 7 have been extremely cash rich. They can actually probably do a lot of the infrastructure build out from cash on their balance sheets. But companies like Amazon, Meta have been taking out a little bit more debt as well. So I do think the asset heavy nature, while it's still not going to be a complete burden on the balance sheets, it might give investors pause on how much they're willing to pay from a multiple or valuation perspective. So that's something we're watching closely as well.
Well, when it comes to the blue chip tech companies that can probably, like you said, pay for a lot of this build out from free cash flow, I was having a conversation with Rick Reeder actually at an ETF event upstairs in the Bloomberg building yesterday, and he said when it comes to a lot of these tech names, those in the AI build out, the big question that he faces, or at least one of them, is, you know, whether you want to own exposure to that name in equity or in debt? And I wonder, for some of these high flyers, how do you approach that question?
It's a great point because, look, we do think from a debt and really from a yield perspective, if you look at investment grade bonds today, they actually offer an interesting yield above the 4% or 4.2% Treasury. And a 4.2% Treasury is actually at a near 15-year high. And then you add on that some of these corporations that can really, offer you some interesting yield with a very strong balance sheet behind it. We do think there's some interesting opportunities coming in 2026 in the bond space. So we like that, especially if you're in retirement, near retirement, or just looking for income. When you're at 5, 6, 7% yield return, you're actually kind of close to what you want to be from an ongoing return perspective, and outpacing inflation, by the way.
But with regards to that strategy, do you see more opportunity on the corporate side than on the government side?
Certainly on the investment grade corporate side. We're still a little hesitant to go full high yield. Spreads are very tight. There could be volatility, we think, as we play out in the year ahead. But we think both government and corporate, IG corporate, very interesting yields here. And 10-year, I think, is in that bucket as well.
Interesting. Well, let's wrap the Fed into this conversation because you think about the sell-off that we're seeing on this Friday. A lot of it can be traced back to what Cleveland Fed President Beth Hammack said, that she would prefer interest rates to be slightly more restricted to keep putting pressure on inflation. You think about this Fed, it seems like 2026, one of the stories is going to be the division as to what should come next when it comes to their rate cutting trajectory. Where do you fall currently?
Yeah, it's a great point. So, we think inflation will land somewhere in this 2.5% range. And traditionally, Fed funds is about 100 basis points above inflation. So 3.5%, or maybe it's 75 to 100 basis points above inflation. So we think that 3.25 to 3.5% feels like a good neutral spot. We're close to there already. 1 to 2 hikes will get us there. 1 to 2 rate cuts, will get us there. And I do think the Fed, and especially Jerome Powell, would like to leave this Fed in a neutral position so they have the opportunity to pivot as they need going forward with the new Fed chair.
And no concerns here about kind of the lame duckishness of his term over the next 5 months?
No concerns yet. We're watching it. Look, we know some of the key players that are named as potential replacements for Jerome Powell. We do think if the Fed comes under any question as per its independence, markets are actually going to start blowing out yields on the long end. And that's the opposite of what this government really wants, which is lower yields. So that's a good point.
All right, Mona, I have to leave it there. One of the best in the business, Mona Mahajan, Head of Investment Strategy at Edward Jones, kicking us off to the close here on this Friday afternoon. When we come back, a conversation with Priscilla Sims Brown, the president and CEO of Amalgamated Bank, the largest union-owned bank in the country. We're going to get her outlook for 2026.
Plus, Open Table's Debbie Sue is dishing out the deets when it comes to restaurant demand. She'll wrap up the year in reservations and tell us what she expects to see in 2026.
And then we're going to bring it home with real estate and a real estate icon, Ryan Serhan, on his expectations for the Manhattan market. And of course, we're going to take a look at season 2 of his Netflix show, Owning Manhattan. All that and more coming up in a bit. Stick with us. This is The Close on Bloomberg.
Wherever news and ideas meet, wherever earnings reports and saved orders intersect, the all-new Fidelity Trader Plus is there, giving you the freedom to trade how you want with your preferred tools, customized charts, and streaming data. So you can start a trade idea on one device and execute it on another. Meet our most powerful, consistent trading platform yet. Meet Fidelity Trader Plus.
Tiger Woods built his career on forward thinking, staying ahead of the curve and away from the expected. Insperity believes that in business, it's no different. They're dedicated to driving your business forward, providing the HR support you need to innovate and win. You don't become one of the greats by doing things the same as everyone else. You take a swing, knowing you've got the right partner by your side. Insperity, because how you HR matters.
when it comes to Asian markets.
Analysts expecting another year of record highs in 2026. Goldman strategists writing in a note today that S&P profits could jump 12% on AI-fueled earnings and economic growth. Our next guest has been called one of the most powerful women in banking, and she says that affordability concerns and interest rate uncertainty could make investors and businesses more disciplined in the year ahead. Joining us live is Priscilla Sims Brown. She is the president and CEO of Amalgamated Bank. Great to see you in person.
Thank you. Good to be here.
Let's talk about affordability, because we've seen it come up in recent elections. We know it's going to be a big conversation in the midterms, and it's a conversation that every family in America is probably having right now. So talk us through what discipline could look like on the part of consumers and businesses next year.
Well, I'll first just say that it is a topic that most people agree on, and which is an interesting part of this. I think no matter where you are on the spectrum politically or in other ways, you agree that affordability is a concern. And that requires, I think, companies to think differently about serving not just the most affluent, but those who are also underserved in traditional financial sectors. And so I think that's an opportunity for businesses to really think about low and moderate income families, and also the organizations that serve them well. And financing, providing access to capital to those organizations and individuals is, I think, an important opportunity, which also is great for profits because it's an underserved community, but it's something that helps everyone. And then for individuals and families, I think the opportunity to think differently about how we spend will make the difference.
I am curious about just actual activity that you're seeing amongst clients with regards to borrowing. Are they feeling, I guess, A, are they confident enough to borrow? And more importantly, do they have the capacity and the creditworthiness at this stage in the economic cycle to do so?
So, two things I would say about that. Yeah. At the consumer level, which is not the largest part of our business, right. But at the consumer level, there's an opportunity to think differently about how we underwrite. Okay. Because there are ways in which people demonstrate their creditworthiness that may not be reflected in credit scores. They do it through the payment of all sorts of things: your cell phone payments, your rent, your union dues, your all the many ways that you are diligent in responding to your debts.
But that's been a hallmark of the bank pretty much since its inception.
That is right.
Okay,
that's
has that changed at all, or is that intensified in some way?
It has intensified as the wealth gap has widened. But the bigger opportunity for us, the one that we see that's really important, is that when you think about the intersections of things like resilience against climate disasters, and also the economic impact of healthcare and medical bills and such. When you think about all of those intersections, there are opportunities to address the needs. For example, we are really engaged in a product called CPACE, Commercial Property Assessed Clean Energy. This is just a way that property owners can receive loans for the work that they need to do that may create greater resilience, whether that's a solar panel, whether that's a better window, whether that's a heat pump installation. And that's done both at the residential and consumer and commercial level. And lending into that is a huge opportunity for financial services firms, but is also something that addresses resilience that individuals and businesses alike can benefit from.
Well, I'm taking a look at your 2026 market outlook, and you do highlight the energy transition as, a defining economic engine here. And I wonder, how that conversation wraps in, especially when you think about the different sectors that are impacted by that transition.
Yeah, the opportunities in energy are great, of all forms. There's simply more demand than there is supply. And certainly with clean energy being less expensive than most forms, there's a particular opportunity there. So we see that in battery storage, geothermal. About 40% of our lending, in fact, is climate related.
Are you seeing a lot of competition for those loans? Meaning, are you up against other regional banks, or up against direct lenders, private credit folks?
Sure, there are a number of people getting into the game, particularly at a time when there may not be as many federal opportunities for those projects. But again, you've still got supply that outstrips, demand that outstrips supply, which then makes it still an attractive
So it doesn't affect your underwriting standards?
Not at all.
Interesting. I do want to talk a little bit about interest rates, because you think about the rate cut that we got this week. We know that that was consensus, but there is a lot of quabbling being done over what exactly the Fed's trajectory looks like in 2026, whether or not we are going to see rates meaningfully come down. What impact have you seen when it comes to some of the clients that you work with, some of the businesses that you lend to, the impact of these higher rates that might not be coming down as quickly as some might have hoped?
I think certainly, while there's a little bit of our diverse opinions on this, I think the expectation is that there will be a lowering of rates next year. I think the uncertainty causes people to pause. Certainty changes that, so you'll see more investment and more activity as people have greater certainty around that rate cut. For us, it's really, we're fairly rate neutral. We're slightly better if rates are up, but it doesn't matter a lot. What's really important to us are deposits, how those are running. We're really pleased with that. How lending is going, and we're really pleased there. And then credit quality. Those are really the three most important things to us, more important than rates themselves.
But with regard to your margins, net interest margins, I mean, that's still a rate story.
Right.
Have you made adjustments in anticipation of rates coming down?
We are, we're a little bit unique in that this bank is fairly deposit rich and a fairly high percentage, so we have low cost deposits. A fairly high percentage of our deposits are related to segments which are moving pretty quickly and therefore are not as rate sensitive.
All right, Priscilla, great insights and great to have you here on the program.
Great to be here.
And love to have you back sometime. Priscilla Sims Brown, President and CEO of Amalgamated Bank, as we continue to count you down to the closing bells here on this Friday afternoon with a look at some of the big movers, and one of the biggest of them all is Broadcom, down 12% on a disappointing sales outlook. We're going to discuss with an analyst who covers the stock. That's coming up next here on The Close. This is Bloomberg.
Meet the all-new Fidelity Trader Plus with your preferred tools, customized charts, and streaming data, so you can start a trade idea on one device and execute it on another. Meet our most powerful trading platform yet, Fidelity Trader Plus.
You can't control the course or the competition, but you can control what you do next. Tiger Woods built his career on the ability to reset, adapt, and make the next shot count. Insperity is built to help businesses do the same. You deserve an HR partner that's there to help you thrive, no matter what comes your way. Insperity, because how you HR matters.
Premium benefits anywhere you go. Unlimited, zero trading fees. 6% back in crypto. And other exclusive benefits with Level Up. Take your wealth to the next level.
All right, time now for our top calls, big movers on the back of analyst recommendations. We start with Roblox and a downgrade of JP Morgan to neutral. The price target going to 100 from 145. The analysts seeing Roblox taking a bit of a breather in 2026 due to headwinds hitting user engagement. Those shares down for a third straight day. Next up, Restoration Hardware, RH as it's now called. TD Cowen cutting the price target to 200 from 265, but sticking with its buy rating, saying that the price target cut really is just a note of caution post earnings, but the analyst still sees the shares potentially working again. They're working today, up 7%. And finally, how about Citigroup here? JP Morgan raising their rating to overweight, upping the price target to 124. The analysts banking on Citi benefiting from a solid economy and strong markets-related activity. We should point out Citi shares, which had actually been up a little bit earlier in the session, now down a fraction of a percent, an 8-day run heading into today. Those are some of our top calls. Let's turn to Broadcom. Those shares down more than 12% after the chip maker, well, kind of didn't give a sales outlook and then said that its backlog for AI, well, came up a little bit short than what analysts were looking for. Let's bring in Will Kerman, senior equity analyst for technology over at Morningstar. Will, first, let's start off. I didn't actually think the numbers were all that bad. Why do you think we're seeing such a negative reaction in the shares today?
Yeah, and Romaine, Katie, great to be with you today. We also didn't think the numbers were that bad. We actually really liked the numbers, and we liked a lot of the forward-looking commentary that management gave. So we see this market sell-off today as a little bit missing the forest for the trees, some nitpicks maybe around margin, maybe around backlog, but really ignoring what we focus on, which is that there is a grander picture here of accelerating AI demand, and we think that's constructive into the long term for Broadcom.
We'll talk a little to the fact that, they held off on giving an annual AI revenue forecast. The comments from the CEO were that it's a moving target, and it's hard for me to pinpoint what 26 is going to look like precisely. One of the reasons why you're seeing shares startled to the extent that they are today, Will, it seems like not necessarily something that you're all that concerned about.
Definitely not. Well, they did not explicitly guide to full year AI revenue. They've really been leaving what I've been calling a trail of breadcrumbs and letting us analysts figure this out. So first off, the Q1 guidance for AI was above our expectations, a little bit above consensus. And then there are these massive purchase commitments coming in the second half of 2026 that we think will create an acceleration and a surge in revenue. There's $21 billion set to come in from Anthropic, which is the company's fourth custom AI chip customer. And then the company announced a fifth customer, yet unnamed. I've seen rumors that it may be XAI with its own $1 billion order. So we see this as a good first half and an acceleration and an extremely strong second half.
Revenue growth, order backlogs, those are good things, Will. But as we kind of saw with some of the issues with investors souring on Oracle's earnings report, there are a lot of questions about how much money is it going to take to actually fulfill those orders and whether that money that's needed eats into the profitability of all of those sales. Is that a concern?
It's a concern longer term. The way I've been kind of describing this AI hardware infrastructure is that in the short term, in the next 1 to 2 years, everything is supply constrained. And we think that is going to lead to continuing strong demand and strong growth. And long term, over a 10 plus year period, we see this as a transformative technology that is really going to be the end all be all in tech investing. Now, in that medium term, it could look a little choppy. We could see a correction in what that growth looks like. I talk about this as kind of the slope of the curve, maybe a flattening at some point in the future. But really, over the next 2 years, 2026 and 2027, we see a lot of upside for Broadcom.
And we have less than a minute left with you, but I wonder how much of the share reaction that we're seeing right now on this Friday is a case of high expectations. I'm taking a look at our preview piece on the Bloomberg terminal, and it was Broadcom is primed for disappointment after its blistering 170% rally since those April 4th lows. I wonder how much that plays into it.
I think it's all about expectations, Katie, and especially given that Oracle had reported just earlier that day and shares were down, I think the market was looking for really anything to nitpick in these numbers. And again, there is maybe some disappointing margin guidance and again, a lack of that full year AI guide. But really, we think those are nitpicks, just what I said, and that the grander picture is extremely positive.
Certainly a lot of nitpicking going on today, Will. Great to have some time with you. That is Will Kerwin of Morningstar. Now, coming up, we're going to be speaking to OpenTable's CEO, Debbie Su. Don't go anywhere. This is The Close.
all-new Fidelity Trader Plus with your preferred tools, customized charts, and streaming data. So you can start a trade idea on one device and execute it on another. Meet our most powerful trading platform yet, Fidelity Trader Plus.
Tiger Woods built his career on forward thinking, staying ahead of the curve and away from the expected. Insperity believes that in business, it's no different. They're dedicated to driving your business forward, providing the HR support you need to innovate and win. You don't become one of the greats by doing things the same as everyone else. You take a swing, knowing you've got the right partner by your side. Insperity, because how you HR matters.
Premium benefits anywhere you go. Unlimited, zero trading fees. 6% back in crypto. And other exclusive benefits with Level Up. Take your wealth to the next level.
Wherever news and ideas meet, wherever earnings reports and saved orders intersect, the all-new Fidelity Trader Plus is there, giving you the freedom to trade how you want with your preferred tools, customized charts, and streaming data. So you can start a trade idea on one device and execute it on another. Meet our most powerful, consistent trading platform yet. Meet Fidelity Trader Plus.
Of power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up to them in the news whenever and wherever it happens. I'm Sherian in Seoul, and this is Bloomberg.
.30 p.m. in a Long John weather, New York City. This is the countdown to the close. I'm Romaine Bostic.
And I'm Katie Greifeld. We're keeping an eye on the markets.
It's so peaceful out there, yet it's so brutal and cold.
Yeah, your face hurts. I actually went for a run this morning and
outside?
Yeah, I felt super tough.
Why did you do that?
It was just me and like the birds. No one else was out there. Anyway, let's talk about restaurants. I know that you're
the birds probably didn't want to be out there.
You're a big foodie, Romaine. OpenTable is out with its 2026 dining trends report.
Yes.
One of the key stats it found was that 55% of Americans think that they'll spend more on dining out in 2026.
That surprised me.
Well, you have to wonder, is that just because things are going to cost more or because we're going to be eating out more?
That's a good question. But yeah, I thought it was like, because it seems like we talk so much about people pulling back. It also gets into this idea of the kind of K-shaped economy. Obviously, OpenTable kind of traffics in restaurants that are a little bit more upscale than some of the people that we have on our show. But I don't know. I think there's somebody who can maybe help answer that question for us.
Shall we speak to her?
How about that? That's a segue.
Yeah. Joining us to discuss the trend she's seeing in the restaurant industry.
There's Katie.
No, don't I usually do this?
This is a Friday. You do.
Okay.
Was my name there?
I'll just keep going. Debbie Sue, she is the CEO of OpenTable. She joins us right now. Debbie, such an interesting report. There's so many different stats that we can dig into there. But let's start with that one, the one that we just showed up on the screen there. 55% of Americans saying that they plan to spend more in 2026. So I'll ask you the question I asked Romaine. Is that because things are going to cost more, or because we're going to actually go out and spend more at restaurants?
I think it's both. And great to be on, by the way, and happy to join this little party on a Friday afternoon. But I do think it's both. And I'm going to start with your second point. I do think people want to go out. We've seen that year over year since the pandemic. People continue to prioritize the experience of dining out in their household P&L. I think that's one piece of it. People are craving connection. They want to be taken care of. And I think they want to support their local restaurants. I think all of that is wonderful. I also do think there's a part of it where, I don't, Romaine knows this. I'm not a great cook. I don't do it often. I did try during Thanksgiving. So, we went to the grocery store, we bought all the things. I was astounded by how much things cost. Mm-hmm. And so restaurateurs are so scrappy and innovative and resilient. And oftentimes we've seen, even with labor shortages, supply chain interruptions, inflation, they have not pushed that full cost that they're seeing onto their diners. Right. So oftentimes going out to eat could be a better deal. So I think it's both of those things.
Yeah, it's interesting. And you've seen that really across industries, not just in restaurants. Basically, companies taking on and eating some of the cost of those higher prices. But I want to talk a little bit about generational differences here, because I'm taking a look at the consumer segmentation breakout, and millennials actually plan to dine out 14 times a month. That is the highest of any generation. Is that usually the case, Debbie?
We haven't seen it be this high in one particular demographic, and it's funny because when I saw that stat, I was like, do I count in that? So I had to Google that and check. Yes, I indeed am a millennial. 14 times is very high, but if you think about maybe on the weekends, brunch, lunches, once or two during the week, and then a few dinners. If you break it down that way, it's not that surprising, and it's not actually that much if you think about, in your own life. But, I guess in some ways it does make sense, right? Millennials often have jobs, right, are of a certain age, have the resources to go out and dine out more frequently than perhaps those who are just starting, for example, in their career.
Well, I am curious also in this, you've been speaking of millennials. We'll just dig on millennials for a little while longer. 79% of them, according to your data, say the restaurant's, quote, Instagram TikTok worthiness matters in where they choose to dine. I'm not actually too surprised. I have a couple friends who are restaurateurs, and this is something they talk a lot about, is how much attention they have to put now into the decor and other non-food elements just to get people in the door. I assume that's been a trend that's been unfolding for some time.
It has been unfolding for some time, and I think if you talk to any restaurateur now, not even the ones who kind of grew up in the age of social media, they know that it's an important part of how diners are discovering them. So whether that be on TikTok or Instagram, but what diners want to know is it's not just, how your food looks in a photo. And it's not just about the ambiance of the restaurant, although all of those things, of course, are very important in contributing to a diner experience. But they want to know the story behind the food. Like, why did you pick this cuisine? Why this neighborhood? Why this size of restaurant? Like, I think that's what's really resonating. People want to hear the storytelling from the restaurants. And myself, right, because I didn't grow up with social media, it's been even astounding to see for OpenTable how much people engage with our brand on these channels.
Well, I am curious about that, particularly with regards to your business, to OpenTable's business. You've got tens of thousands of restaurants on your platform right now. I am curious, but we've seen some increased competition from places like Resi and 7 Rooms and a couple others that have cropped up here. How do you make sure you keep people engaged? I mean, obviously you have to get the restaurants on the platform, but how do you keep the average consumer engaged, not just to come to your site to book, but to actually do a little bit more?
There's a lot of things that we do, but first and foremost, what we do is we are a platform for our restaurant partners. We promote and tell their stories. I always tell the company, it is not our job to be cool. our restaurants are cool. Let us be a tool in which that they can tell their stories. Other ways that
OpenTable is cool, by the way, Debbie.
Oh, that's
I'll say this, and I'll say this too, and I'm not just trying to gas you up here, but I mean, you talk about the search functions, which are better than some of your competitors that I won't name, but also the idea of engagement and being able to see what other people think of the restaurants and there, so you have a better sense. If you've never tried it, you get a better sense. Anyway, go ahead. That's my spiel.
You can see. I love that. Thank you, Romaine. You can see the reviews as you mentioned, right? You can see what other people are saying about the restaurant. We do try to make search and discovery and booking as easy as possible, right? And people talk about that all the time. We've recently relaunched our loyalty program, right? So for those of you who might know, if you're an OpenTable VIP, historically, like no one knew what that meant, and that's fair because we didn't do a great job of showcasing that. So all of that is getting revamped for now. If you are an OpenTable VIP, or we're calling it Gold, you get, for example, 6 months of free Uber One membership, which is a great value and a great deal. You get early access to booking some of the best restaurants that we have in our platform. So we're always trying to figure out and innovate ways to really help our diners, because we know that our number one job is to help restaurants fill their seats. So whether that be connecting with open AI companies, pushing in our social channels the stories of our restaurants, launching Concierge, which is AI search on our own website and apps to help diners get their questions on restaurants answered. All of those things are in service of funneling more guests into our restaurants, because there's nothing worse than an empty seat.
Well, Debbie, just quickly here, you mentioned Concierge AI, that is your new AI assistant. I do wonder what uptake looks like, because you think back to Clippy on Microsoft Word, or you think about some of those chats that would open up on travel websites back in the day. A lot of people just X out of them. Are folks actually using the AI search tools?
Katie, I know you're a millennial if you know about Clippy, first of all.
That's true.
I haven't heard that one in years. We have answered millions of questions since the product has come out. And right now, Concierge exists on the restaurant profile. It's not on the homepage, right? So when you go to OpenTable.com or you fire up your app, you actually have to get into a restaurant, and then you can see the Concierge there. We are seeing great usage. And what's really interesting is that when people engage with it and get their questions answered, and you measure the activity that they're doing on OpenTable afterwards, they're more engaged and they're coming back and discovering and booking more frequently when we solve the question that they asked with Concierge. So it's really early days, and we're also trying to figure out how to get it higher up in the funnel. So not just on the profile page, for example, right? But it's front and center when you come to OpenTable.com or go to our app. And all of that is still in flight, and we're pushing hard to do it. But some of the early signals, I think, have been really fascinating in terms of the impact of how sticky it makes our product, their usage afterwards, all of that.
All right, Debbie, I have to leave it there. We didn't even get to the top 100 list of the year, which I should point out is dominated by restaurants in my hometown of Chicago. But that's for another conversation. Debbie,
yes,
great to always have you on. We have to leave it there. Debbie Su, the CEO over at OpenTable. We'll be back in a moment. This is Bloomberg.
Wherever news and ideas meet, wherever earnings reports and saved orders intersect, the all-new Fidelity Trader Plus is there, giving you the freedom to trade how you want with your preferred tools, customized charts, and streaming data. So you can start a trade idea on one device and execute it on another. Meet our most powerful, consistent trading platform yet. Meet Fidelity Trader Plus.
You can't control the course or the competition, but you can control what you do next. Tiger Woods built his career on the ability to reset, adapt, and make the next shot count. Insperity is built to help businesses do the same. You deserve an HR partner that's there to help you thrive, no matter what comes your way. Insperity, because how you HR matters.
Premium benefits anywhere you go. Unlimited zero trading fees. 6% back in crypto. And other exclusive benefits with Level Up. Take your wealth to the next level.
Our data showed from our survey that 41% ranked AI as the #1 area of investment in technology going forward. That was followed by cyber, and outside of more generic AI, agentics in particular were high on the list. Well, we've had a tremendous focus on back office. I think you're going to start to see companies taking more and more chances, especially with the regulatory environment, to be able to make a push to really start to transform their business and break out of the pack.
The pool of dollars is going to our transformation.
Watch Chief Future Officer Wednesday on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
All right, time now for Factor Friday, where we take a look at some of the big factors that move the equity markets during the week and, well, quite frankly, all quarter long. Chris Kane joins us right now, equity strategist for Bloomberg Intelligence. All right, let's start with the traditional factors, Chris, and kind of what we've seen, not just on the week, but really over the past couple of months.
Yeah, Romain, it's been a choppy trade basically all year for factors, very frustrating, but we have seen some trends emerge, recently. So specifically, momentum has done very well since the beginning of September. We have high momentum stocks in the S&P 500 outpacing low momentum stocks by about 10% over the last, call it, quarter. And then, believe it or not, value has actually woken up over the last 5 weeks. So basically, since the beginning of November, we have the cheapest stocks in the index outperforming the most expensive stocks in the index by about 8%. So that brings values, long-short returns back to about even on the year. Momentum is the leader. So those are really the two factors that have kind of woken up in what has been a choppy trade for factors all year.
Well, let's talk a little bit more about value and what that outperformance has meant for valuations. Where do some of those metrics stand right now, Chris?
Katie, it's the outperformance has been too short. It's only been 5 weeks, so it hasn't really changed valuations. I mean, the thing about factor valuations and value factor valuations specifically, is that cheap stocks are just way, way cheaper than expensive stocks right now, even when you look historically. So basically, when you look at median price to sales of the cheapest versus the most expensive stocks in the index, the cheapest are only about 10% the valuation of expensive. That's much lower than average. It's actually a 6th percentile relative valuation reading over the last 25 years. We did a study and we looked at every time that value stocks have been this cheap compared to expensive stocks, again, over that 25-year time frame, there tends to be very strong long-short value factor performance over the next year. So we could potentially be setting up for a bit of a rotation.
I have to ask you, though, Chris, about the value trap. When you take a look at the potential return on those investments, are value stocks really, in theory, a better deal relative to some of those more expensive names?
That's the thing, Romain. I mean, the picture is murky because value is a lot of junk right now. When you look at things such as the profitability of the cheapest stocks in the index, that has gone from basically a median ROE return on equity of 20% in 2022 to just 10% now. So a lot lower than expensive stocks. So there is a lot of junk in there. I would say if you're going to be a value investor, you could be a bit, picky as far as what value you invest in.
All right, Chris, great to get some time with you. That is Chris Kane of Bloomberg Intelligence. Now, coming up next is the closing bell with Kara Murphy. Don't go anywhere. This is Bloomberg.
Meet the all-new Fidelity Trader Plus with your preferred tools, customized charts, and streaming data, so you can start a trade idea on one device and execute it on another. Meet our most powerful trading platform yet, Fidelity Trader Plus.
Tiger Woods built his career on forward thinking, staying ahead of the curve and away from the expected. Insperity believes that in business, it's no different. They're dedicated to driving your business forward, providing the HR support you need to innovate and win. You don't become one of the greats by doing things the same as everyone else. You take a swing, knowing you've got the right partner by your side. Insperity, because how you HR matters.
Premium benefits anywhere you go. Unlimited, zero trading fees. 6% back in crypto. And other exclusive benefits with Level Up. Take your wealth to the next level.
Stream from that.
I don't know if you can break down what the average person is seeing right now in terms of stuff that's AI generated versus, maybe more traditional human generated, but what's that going to look like in a year or in 5 years?
There's actually a lot of hybrid content, and too often we talk about synthetic content and organic content, and never the two shall meet. But there's a lot of content where AI is part of the workflow, right? Like you might not even know it. It might be whatever app you're using to do color correction might be using models to do so. Stamp tool in Photoshop in the old days to get rid of a pimple, those types of things. But that line is going to be more and more blurred. So it's going to be a little bit less like what is organic content and what is AI synthetic content and what the percentages are. I think there's going to be actually more in the middle than pure synthetic content for a while. But you will also see experiences that are purely AI, right? You see this in the last 2 weeks with Vibes in the Meta AI app and with Sora 2 from OpenAI. So I think you're going to see both.
I'm David Weston. Join me for the next generation of Wall Street Week. This week, Glenn Hubbard on this week's Fed decision. Lisa Su of AMD on the open source approach to AI and why it matters. Going nuclear to get all that power data centers need. And a trip down memory lane as iconic Macy's tries to restore the luster of department stores.
It's a storied retailer, but we never want our rich history to get in the way of our brighter future.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute geoeconomic news whenever and wherever it happens. I'm Bonnie Quinn in Sao Paulo, Brazil, and this is Bloomberg.
One of the things we say, don't fight the Fed, but also don't fight earnings growth. And when we look at earnings growth for 2026, double digits, but the good news is it's coming from tech and non-tech parts of the market. So there is this case to be made that you should have some innovation exposure, but you should have some other parts of cyclical and value in your portfolio for the year ahead.
Mona Mahajan kicking us off to the close from Edward Jones just about 50 minutes ago. Looking right now at an equity market on the back foot. The NASDAQ 100 now setting up for its biggest two-day drop in 2 months.
Yeah, a lot of pain coming through in big tech as we sort of rethink some of the AI names here in the form of Broadcom, in the form of Oracle. I will say that 1% drop on the S&P 500. We're now looking at a down week for the big benchmark, off by about 0.7%. And again, this is a week where we hit a record high. We had a Fed meeting, et cetera, et cetera. Certainly, again, feels far away right now.
And it's interesting to put a pin on this, too, because when I kind of saw the sell-off this morning, the first thing you start going is trying to look at all the superlatives. There really aren't that many. I mean, we're only, 1% or 2 below the record highs on the major indices. And while there are some individual stocks and sectors that are kind of in correction territory, overall, this is a market, a sell-off, I should say, that's been a little bit more of a rotation rather than people just cashing in and moving on.
It's a good point. Yeah. Rotation underway, and we're just churning along near these all-time highs. I'll also point out that it's December 12th, so we're going to see liquidity drop off in a big way when it comes to trading volume. So this might be what the rest of the year looks like.
Yeah, so just about 12, 13 more shopping days for Christmas there with Broadcom, NVIDIA, a lot of the big tech stocks on the back foot today. A reminder, we are still seeing some strength out there in other tech names, including Tesla, Apple, and Netflix. Kara Murphy, she joins us now, Chief Investment Officer over at Kestra Investment Management. The count is down to those closing bells, and I do want to start off with the idea of this tech sell-off. We'll just use the word sell-off for now, but the idea that this is more of a rotation, that people may be taking some profits from some of those high-flying names. And if indeed that is true, it does appear some of that money is still staying invested in the equity market. I'm curious as to where.
I think this is very healthy. And it's interesting because I talk to people from all over the country, from high schoolers to retirees to professional investors. And the one question I get the most is about AI. Are we in a bubble? What's going to happen? And I think on a day like today, it's a good example of how we can see the market start to rotate to other areas without AI having to blow up. And this is very healthy. We've sort of been waiting for this for a while. For the last 3-ish years, it's all been about this Mag 7 AI story. And so to see other parts of the market start to step in and carry some of the weight, I think is what we would expect to continue to see into 2026.
So, I mean, when we take a look sort of at some of the sectors that have seemed to have bubbled up, financials gets talked about a lot. I think if my memory serves me correct, I'm pretty sure we hit a record high on most of the banking and financial indices, industrials as well. Are you finding something attractive in those spaces?
Absolutely. So particularly in the industrials, when you look at all of this AI spending that's happening, I mean, the top spenders in the space are spending about $350 billion this year in CapEx. That's an enormous amount of money, expected to increase significantly into next year. And all that money has to be spent somewhere. A lot of it is being spent on building out infrastructure, whether it's data or power or servers. This all has to be built out into real things by real companies, and they have to be deployed. And so that has a multi-year kind of horizon on it. It doesn't happen overnight. And when you look at earnings reports from a lot of these companies, they're reporting huge backlogs, mega projects that will take multiple years to be able to complete. And I think that's a pretty sort of long road for us to be able to enjoy.
And to that point, one of the breaking news stories on the terminal today was that Oracle is delaying some data center projects for OpenAI to 2028. And you have to wonder, Kara, whether we're going to get more of these headlines. Obviously, it's all about the build out right now. But one of the big concerns out there is that when it comes to AI infrastructure, that we're in the midst of an overbuild.
I think that is very healthy that we're asking this question, because the worry is always that there's this huge rush to build out a ton of capacity, and then you get a year or two into it and you find out you don't need it. So then you have all of this dead space. So I think the fact that the market is asking this now, when we're still in the very early stages of building this out, is actually very healthy. I think obviously we're going to have some dollars spent that don't see really strong returns. There are going to be other areas that see stronger returns than what are expected today. And we have a little bit of time to be able to leg into it, but we think we're still in the early innings of that particular story.
I do want to bring the Fed into this conversation because you think about the rate decision that we got this week, the dissents that we got accompanied with that decision, and the silent dissents in the form of the regional Fed presidents. I like this line that you have in your notes saying that Powell is walking a tightrope, as the Fed always is, but this one is more about politics than policy. You consider the politics around the Fed right now and the fact that we're going to get a leadership change in May 2026. How do you approach that from an investor's standpoint?
So, you think that the Fed is always juggling this labor on the one side, inflation on the other. And we're in sort of a unique time right now where you're getting conflicting signals from those two. So we'll admit that this is a higher level of difficulty than some other areas or some other time periods. But when you compare the sort of economic challenge that the Fed has right now to things like COVID or the global financial crisis, the level of difficulty is much, much lower. And to your comment earlier, it's the politics weighing on top of these conflicting signals that are making it so difficult to navigate, right? You have higher levels of dissension from within members of the board. You have this leadership change coming in. You have many more conversations about the administration's view of Fed policy than typically what we've seen in modern history. So those things are going to be much more difficult to actually navigate. Ultimately, what I think that means is that the Fed has to be fairly cautious in how quickly it moves. And we've seen the Fed move in cutting rates much slower than what market participants had expected earlier this year.
Yeah.
I think the caution will actually continue into next year.
Kara, before we let you go, I am curious, and I think the last time we had you on, we asked you about some of the opportunities outside the U.S. I mean, I was taking a look at the performance of U.S. equities relative to the rest of the world, and we kind of forget sometimes that despite the run-up in the U.S., we are still seeing outperformance elsewhere. And I'm curious as to whether you think, A, that continues into next year, and whether, if you're not already exposed to non-U.S. assets, whether you move into that post-haste.
We do think it's very important. And it's interesting when I talk to investors, people don't realize that emerging markets had a really banner year. Non-U.S. developed also had a really strong year relative to U.S. And let's not forget that this is coming on the heels of about a dozen years where U.S. markets outperform non-U.S. markets. So we think this is just the beginning. It's very important to have exposure to both developed non-U.S. and emerging markets. And I think that will be helped by some potentially weaker dollar and some resurgence in earnings in some of those economies.
Kara, always a pleasure. Kara Tara Murphy, Chief Investment Officer over at Kestra Investment Management. And to put a finer point on that, you take the MSCI World Index ex-US here, and the S&P 500 lagging that by the most on an annual basis since 2006.
Yeah, it's pretty amazing. You think back to the beginning of the year, we had that outperformance. Everyone said it wasn't going to last.
Exactly. We move closer to the closing bells here on this Friday. A lot to unpack on the day and on the week. We're going to take some time to do that for you, so stick around. Our global simulcast, it starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Katie Greifeld taking you through to that closing bell with the global simulcast. We're joined now by Carol Massar and Tim Stenovic in the radio booth. Welcome to our audiences across all of our Bloomberg platforms, including our partnership with YouTube. We got a lot to unpack here, guys, so light your incense sage, hide the kids. Carol Massar, what do you make here of the sell-off today?
What do I make of the sell-off today? It's kind of these narratives that have been kicking around for the last couple of weeks, right? Concern about the AI spend and build out. I also think the Fed speak has been a little conflicting. And, you know, speaking of that, you guys, I'm sure we're just breaking these headlines from the Wall Street Journal, you know, that the president's leaning towards Kevin.
Well, it's a Kevin, right?
It's definitely a Kevin.
It's definitely a Kevin. It's definitely a Kevin. Well, you know, it is definitely a Kevin as far as we know now.
Yeah.
Right?
You know,
well, why wouldn't it not be now?
Well, we all thought it was Kevin Hassett a few weeks ago.
Is it Kevin McAllister? Maybe?
I'm just saying.
I like it. That's a Home Alone reference to everybody out
Thanks,
there.
Tim.
Children of the 80s.
I'm just saying we're going to know when the president ultimately makes a decision and says it publicly.
I was just looking at Polymarket because these odds are moving in real time. And just 10 minutes ago, even after the Wall Street Journal story broke, Kevin Hassett was still at 66%. Now Kevin Hassett's down to 56%. Kevin Warsh up to 39% odds. The odds moving just in the last few minutes after this Wall Street Journal story crossed.
Yeah, I want to know what the liquidity looks like in that market.
Volume's $39.9 million.
Okay. I don't know whether or not that's a lot, because it's cool to have that stat.
Yeah. Sorry, I got a little distracted.
Are you placing your bet?
Well, no, I went on to Google here to look up the most famous fictional Kevins in the world. Kevin McAllister does rank up number one. Kevin Dominion is number two, in case you cared one way or the other. We don't need to go through the rest of the list. Let's get you the closing bells here in New York, which not only includes clapping and cheering, but actually confetti there at the NASDAQ. And I'm not sure why, but all of the major indices are in the red on the day. And it looks like mostly for the week. The Dow Jones Industrial Average is going to lose about 0.5% on the day. The S&P 500 down a full percentage point, about 73 points. The NASDAQ Composite, that's your main laggard, down about 1.7%. The NASDAQ 100 down about 1.9%. And the Russell 2000 also pulling back healthily on the day, down about 1.5%.
Also Kevin Arnold from the Wonder Years.
Yes.
And Kevin Malone, The Office. Did you say that one?
No, I didn't, but I used to love the Wonder Years. Winnie?
Yeah.
I used to have a crush on
I know. Who didn't, right? Yeah. S&P 500, guys, almost an even split. 221 names to the upside, Katie. 281 to the downside, one unchanged.
The Wonder Years is also a great band, but let's talk about the circle in front of us. You can see a real mixed bag here when it comes to the sector performance amid this sell-off. 5 managing to finish in the green, 6 in the red. In terms of what did do well today, consumer staples up top, higher by about 0.9%. Certainly a defensive tilt there. Meanwhile, you take a look at what didn't perform, and you guessed it, it's tech, down 2.9% as a sector. Energy and communication services also certainly hurting today, Carol.
Yeah, the SOX alone was down, I think, more than 5% in today's session, so you definitely saw that playing out. Thank you, Broadcom.
It was 5.1% if we were going to be specific.
Okay, you know.
Worst day since October 10th.
I am done. Let's get to some of the individual gainers, if we may, on this Friday. Lululemon, guys, check it out. Top gainer in the S&P 500 and NASDAQ 100, finishing the day with a gain of about 9.6% off its highs, but still nonetheless outperformance there. The shares rallying after the company boosted its full-year outlook, announced its CEO would step down. So as we know, we were breaking this late yesterday. The company looking for a replacement for the company's CEO, Calvin McDonald, who will depart the top post at the end of January. So nonetheless, investors enthused about what's to come next for Lululemon. Hey, also weed stocks, which have been taking a beating, kind of smoking today.
This is insane.
I know. Yeah. Check this out. Canopy Growth up 54% in today's today's session. That's the ADRs that trade here in the United States. Go over to Tilray. That went up about 44% in today's session. Again, backdrop is that we know that they've been beaten up a lot. So just got to kind of put that into perspective. But what the news is, President Trump, or at least he's expected to direct his administration to move to reclassify marijuana as a less dangerous drug, according to people familiar. So pushing to reclassify it as a Schedule III drug.
Yeah.
And that would be really a victory for companies and investors and patients who use medical marijuana.
Did he address the issues that were in that most recent congressional bill that would effectively get rid of like edibles and a lot of other products?
I don't know. Did he?
No.
Okay. All right, so there's more to come, right?
Is that a rhetorical question?
I don't know.
Most of my questions are rhetorical. You know.
I never know when to ignore and when to listen. All right, another group on my mind, fast food, fast casual. Check it out, guys. Let me go through a couple of different names. You have Chipotle. That one is up 3.6%. Shake Shack's up 5%. Cava was up as much as 5.6%, ending the day with a gain of just shy of 1%. Baird analyst David Tarantino seeing these companies as potential beneficiaries from the 2026 World Cup, as you know, being hosted by U.S., Mexico, and Canada. Here's what he has to say. He says the increase in tourism and broader consumer mobility activity tied to each sporting event over the 6-week period will lead to increased spending at restaurants in and around the host cities, and also provide some of these brands a
they want to come and eat that American food, the fast casual that we're known for.
Just saying. Eat and go, eat and go. All right, what do you got, Tim?
All right, I got to start with shares of Oracle falling by 4.5%. This after Bloomberg's Brody Ford reported that the company has pushed back completion dates for some of the data centers it's developing for OpenAI to 2028 from 2027. This is according to people familiar with the work. The delays largely due to labor and material shortages, said the people. Oracle, in a spokesperson, said in a statement that the company remained confident in its ability to meet its obligations and future expansion plans. And Carol mentioned Broadcom down 11.4%. Worst day going back to January. You know, we spoke to Ian King about this earlier. He said the numbers were fantastic. It was that sales outlook, though, for the AI market failed to meet investors' expectations. Hock Tan said the company has a backlog of $73 billion in AI product orders that will be shipped over the next 6 quarters, but warned that total margins were narrowing because of AI product sales and held off on giving an annual AI revenue forecast, saying it was a, quote, moving target. And finally, shares of Dell falling by 6.2%. This after Business Insider said the company is set to increase prices next week across its commercial product lines. Business Insider cited an internal list of upcoming price changes sent to staff on December 9th. Dell shares down by 6.2%.
All right, a quick check on yields here. It was another interesting day, but more importantly, an interesting week. 2-year yields were lower on the day and on the week, but pretty much across the rest of the curve, we were higher, not just on the day, but on the week as well. In fact, 2 straight weeks now that we've seen the benchmark 10-year as well as the long bond, the 30-year, actually go up rather than down, despite some of those rate cuts.
Oh, so let's go to some stories that have caught our attention. There's a lot of stuff coming at us this week, no doubt about it. This one, though, from Netflix. Lots of malls, department stores that have either shut down and there's been some vacancies. Anyway, Netflix has been turning some of these malls and department stores into immersive playgrounds. So they've got a new permanent brand activation. They've got a movie theater and a retail outlet. It's called Netflix House. It's at the King of Prussia Mall in the Philly suburbs. And so you've got things like a Twisted festival, an escape room, a sports bar. Right?
Yeah, Netflix-themed sports bar. It's all part of an effort to extend the lives of those popular TV shows, create these experiences that are away from the screen for its fans. 2 more locations are planned to open in the U.S., Dallas, and also, you could probably guess, Las Vegas.
It's pretty interesting. I mean, it sounds like a mini theme park housed inside a mall. It makes a lot of sense why they would do something like this. I do wonder what a Netflix-themed sports bar specifically
I want to know what the Squid Game activation is.
Oh my God, probably terrifying.
What do you do with that?
You know, speaking of malls, I don't know if you've had a chance. You know, if you go just up here away from Bloomberg World Headquarters, it's the big Ralph Lauren flagship store here. Apparently, Ralph Lauren Christmas, the whole phrase has been trending for quite some time, a reference to, if you've ever seen the decor that they have decked out, the sort of cozy, very sort of rich, homey feel that they put on their holiday decorations, their aesthetic, if you will. Apparently it's taken off, and like I guess everything online, apparently now it's going to consume every single thing that we do this Christmas.
I really love that chart because, I mean, okay, the spike that we're seeing this year is certainly noticeable, but then you take a look, it's so consistent of a bump. Apparently every Christmas, I didn't know this, people really want to know what's going on with Ralph Lauren Christmas.
What I love about this too, and I guess Carol and Tim have no comment on this, but it gets to the idea, though too, I mean, it is very, like it's very, you know, I mean, you know, this whole, it's almost like their normal aesthetic, you know, it's not even just like the Christmas, it's just that now it's, you know, red and green, but it's just, you know, the same, a lot of flannels and patterns and, you know, big leather chairs and fireplaces.
That's what I was going to say. They have been, I feel like, selling and marketing a lifestyle for a long, long time. Their advertising has been like that for decades, and so they just kind of amp it up around Christmas. It's kind of like your home, right, Romaine?
It's kind of like...
It's cozy.
No, my home? No. My home's a mess. What's your favorite Christmas movie, Carol Master?
Die Hard.
That's very funny.
I like it.
I have to. I end up watching A Christmas Story a lot. It's my husband's favorite, so you know I end up getting stuck watching that.
All right,
I'll
answer the question
I went to Cleveland earlier this year, and I went to visit the Christmas Story house. Yeah.
The actual house, yeah.
Christmas Vacation is the best one.
Yeah, that's
National
good too.
Lampoon's.
Elf should get a.
Katie, you gonna weigh in? Is it Die Hard?
Katie doesn't watch movies.
Not really.
Yeah.
Oh.
I'm more of a 20-minute TV show kind of gal, or a 6-second TikTok sounds pretty good.
I also do love Love, Actually.
Yeah, that's a classic.
I know, it's a classic. All right, guys, that's a wrap. Have a great weekend, a safe weekend. That is a wrap for our cross-platform coverage. Radio, TV, YouTube, Bloomberg Originals. We call it the closing bell. Romaine and Katie continuing there on television. Tim and I continuing right here on Bloomberg Business Week Daily.
When we come back, a closer look here at the market action and a closer look at what to expect up ahead. Jamie Kramer, CIO of Multi-Asset Solutions at JP Morgan Asset Management. She's coming up next. This is The Close on Bloomberg.
Excellence takes drive, work, perseverance. Tiger Woods brings it to the course. Insperity brings it to your business. Want to be the best? Work with the best. Insperity, how HR matters. Learn more at insperity.com/tiger.
Wherever news and ideas meet, wherever earnings reports and saved orders intersect, the all-new Fidelity Trader Plus is there, giving you the freedom to trade how you want with your preferred tools, customized charts, and streaming data. So you can start a trade idea on one device and execute it on another. Meet our most powerful, consistent trading platform yet. Meet Fidelity Trader Plus.
Premium benefits anywhere you go. Unlimited, zero trading fees. 6% back in crypto. And other exclusive benefits with Level Up. Take your wealth to the next level.
Only on Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld. God, it is a Friday,
I'm Romaine Bostic. It is certainly a Friday, and it's been quite a long week. We started the week with a bit of a sell-off in markets. Things perked up midweek. Maybe some optimism around that Fed meeting, but some concerns about those earnings out of Oracle a couple of days ago, and of course out of Broadcom last night. That took the wind out of the sails of the market rally, taking them off their record highs. The NASDAQ 100 bearing the real brunt of the pain, down about 1.9% in a close today, right around that 50-day moving average. average. The Philadelphia Semiconductor Index also down significantly, down about 5%, and also firmly now below that 50-day moving average. So momentum trend line on both of those indices now towards the downside. The risk appetite for Bitcoin waning just a little bit, but one of the few bright spots on the day. Carol Massar talked about it in the simulcast. The marijuana stocks having a phenomenal day. In fact, for the Round Hill Cannabis ETF, that's actually the best day on record.
Weed absolutely on fire on this Friday. Let's take a look at why the stock market was down so significantly. A lot of that pain coming through in the tech sector, a lot of that pain coming through in shares of Broadcom, down about 11% after reporting earnings yesterday. You weren't seeing any help when it comes to the likes of NVIDIA, too. A big weight on these indexes, off by more than 3%. I did want to highlight one of the big movers to the upside. That, of course, is Lululemon, higher by nearly 10% on this Friday. They have a CEO change that they announced last night, so you can see shareholders cheering that move. But let's talk about our weekly ETF check, and I want to talk about the Dash for Cash specifically. I have on there the top 5 fixed income ETFs as measured by flows year to date. And it's so fitting that up at the top, you have SGov taking in more than $36 billion. This is an ETF that tracks 0 to 3 month treasury bills. It really tells you where the appetite is right now, because you can see BND, that is just a total bond market ETF. It's taken in about $19 billion year to date. Certainly nothing to scoff at, but certainly cash is king right now. Let's talk about that with Jamie Kramer. She is CIO of Multi-Asset Solutions over at JP Morgan Asset Management. Jamie, great to see you on this Friday.
Thanks for having me.
Let's start with cash, because I'm taking a look at the notes you sent over to our producers, and you talk about the risk of being in cash for too long when you think about your long-term performance, but it just seems like it's insatiable demand.
That is true. Like that chart's pretty surprising to me. But when you look at the numbers and you think about why money is going to cash right now, I think people really look at valuations in the markets, and they kind of like are a deer in headlights, but which is what our job is. Which is, if we can get clients invested and keep them invested. All the numbers show that cash is the riskiest place to be in the market. Just think about this year. What's cash up this year?
You tell us.
0?
Yeah, well, no, like we're getting towards the end of the year, maybe about 4%.
Okay, all right.
So what is a balanced portfolio of 60% global equities, 40% bonds up?
A lot more than that, a lot more than 4%.
It's up, like maybe not today, but let's just say 15%. That's almost the same as the S&P, but with half the volatility.
Right. So it's interesting. I mean, you sit at a very interesting juncture as multi-assets. And I wonder, you know, if you did have a lot of cash just burning a hole in your pocket, and you're taking a look at these valuations across asset classes, where do you think, if you are coming off the sidelines, the opportunity is right now?
Yeah, it's a good question. So it's really hard to say where the opportunity is tomorrow or the next day. But every year we re-underwrite our long-term capital market assumptions. So we'll look at stocks, bonds across not just the US, but the world. And when we use those assumptions, we see a 60-40 portfolio at, let's just say, 6.4%. Now, that's pretty good. But it's down from 7, and you think about where we're allocating. If you're strategically allocating the areas that we like on a relative basis, we like Japanese equities. We like emerging markets, both in the equity and on the debt. But overall, we're pretty comfortable having a balanced portfolio right now. We had our research summit in London this week, where we re-underwrote our long-term bullish trend for AI. We are believers. Yes, valuations are stretched, but earnings are growing.
Yeah. So I'm curious, though, with regards to that 60-40 split, or whatever the split is going to be now, when you start to see people add more alternative assets to the portfolio, is that pulling from the 40 or is that pulling from the 60?
Yep. It's pulling from both, and it depends where you're adding it.
Yeah.
So when we look at portfolio allocation, we think you have to look at the whole entire approach. And for clients who want income, you probably likely are pulling from high yield if you're going to private credit. But what we did is we took a 30% allocation from both stocks and bonds, allocated to a diversified private basket of alternatives. And the punchline is that you can increase your portfolio return and reduce your risk by 25%. So we are believers in long-term alternatives. Now, the difference between publics and privates are twofold. The first is publics, you can get beta. The second is you can get in and you can get out.
Yes.
Privates, you have to really be careful. There is no beta. It's all about manager, which ones you pick. There's a huge dispersion. And if you get into a private equity fund, fairly long lock, even with some of the evergreen structures.
Is that liquidity risk being compensated appropriately right now, or no?
I think it depends. I think in private equity, I would say, and there's different parts of the market, yes, we believe so. Core real estate, we definitely believe so. That's an asset class that provides fairly strong income and is very unloved, so valuations are not rich today. And if you look at other areas, private credit, obviously it's a very large spectrum, but there we're seeing more convergence, and we would have a little bit more caution.
Well, talk to us a little bit about that convergence when it comes to public credit, private credit. You have a lot of issuers bouncing back and forth. Meta is kind of the poster child of that. And I wonder, how you think about that blurring and how you approach it as, CIO of multi-asset solutions.
Funny you should ask. We had a working group today and we were just talking about it. That is the one area of alternatives that we are seeing the lines blurring. Again, we think about if you can build a portfolio that has publics and privates in the same portfolio, it makes sense. And the flexibility as a manager, the flexibility of being able to make decisions if I need a 7% yield, looking at the relative value between the two and then stepping back. So it's not, you don't have to be in one or the other, it's a holistic decision. And that is the area that we think will be converging. We're seeing funds come out in the market that offer both public and private, so you get the liquidity benefits, but you also get to go back and forth where the relative value is best.
What is some of the main concerns that you're hearing from clients with regards to allocating into next year and portfolio construction overall?
Well, I think the number one thing is everyone is worried about stretched valuations. It's hard wherever you look to find markets that are cheap. I think what you would say is that if you start looking under the hood, there are companies that haven't appreciated that much, and the ones that have, some of them at least, some of the large hyperscalers have great earnings. So I think clients are always afraid. In fact, 32 years of my career, every time I've been afraid, you get dips, and then again, the reason that a balanced portfolio multi-asset works so well is it keeps investors in the market.
All right, Jamie, really fascinating discussion. Great to get some time with you. That is Jamie Kramer. She is CIO of Multi-Asset Solutions over at JP Morgan Asset Management. And for more ETF insights, be sure to check out my newsletter, ETF IQ. That is Bloomberg.com/ETF IQ newsletters. It's not out this week, but I swear it's coming out in the next hour.
Oh, so Katie, what am I supposed to do this weekend? All right, coming up here on the show, AI is taking a hit as those Oracle delays or reports of those Oracle delays rattle some investors. We're going to talk about that a little bit more in depth and the response that we got out of Oracle itself. Stick with us. This is The Close on Bloomberg.
Meet the all-new Fidelity Trader Plus with your preferred tools, customized charts, and streaming data, so you can start a trade idea on one device and execute it on another. Meet our most powerful trading platform yet, Fidelity Trader Plus.
You can't control the course or the competition, but you can control what you do next. Tiger Woods built his career on the ability to reset, adapt, and make the next shot count. Insperity is built to help businesses do the same. You deserve an HR partner that's there to help you thrive, no matter what comes your way. Insperity, because how you HR matters.
Premium benefits anywhere you go. Unlimited, zero trading fees. 6% back in crypto. And other exclusive benefits with Level Up. Take your wealth to the next level.
And dig up the peculiar and wonderful treasures that reveal what a country is made of. Yeah,
Oracle shares, they've been on a downdraft ever since the record high a couple of months ago, and they continue that slide today, down about 4%. The company is said to be pushing back completion dates for some of the data centers that it's been building or said to be building for OpenAI. This according to people familiar with the situation that Bloomberg reporters spoke to. An Oracle spokesperson did respond in kind to that report and said, quote, there have been no delays to any sites required to meet our contractual commitments. Joining us right now is Mandeep Singh, Global Head of Technology Research at Bloomberg Intelligence. And, whether this is true or not, it does get to an issue that has been raised by multiple people, that we talk about all these big financial commitments, but at some point, some of this stuff has to be shovels in the ground, and we know for a fact a lot of shovels have not gone into the ground. How much of a concern, if at all, is this for you, Mandeep, about the potential for delays in this build-out?
Yeah, look, there are two sides to it. One is the supply constraint sides, whether it's power related or just the availability of chips or, have the projects kind of hit the ground and running. The other side of it is the skepticism that investors are showing around the long-term forecast for these companies. And whether it's their backlog number or any other type of long-term forecast, I think right now in the last few weeks, we have seen a lot of skepticism, and for good reason, because if OpenAI is saying we'll be paying, almost half of the revenue we'll generate in 2029, which will be close to $100 billion in compute costs, then the question is, how do they get to $100 billion in revenue, given the compute shortages and, all their business model is around serving the traffic and using these models that are getting increasingly complex. So that's where I think there are doubts being cast around OpenAI's ability to ramp up to $100 billion in revenue. And if they can't get there, then how do they pay for compute costs? And that's where I think the Oracle backlog is getting questioned. But to me, it's all the circular financing and, everything comes back to the model providers eventually.
Right, absolutely. And you think about the circularity of some of this financing, what we're seeing right now when it comes to Oracle, this specific story that they're delaying some of those data center projects for OpenAI. You think about the different deals that have been inked, particularly by OpenAI. Do you see any ripple effects here, should this situation develop further between Oracle and OpenAI?
I mean, look, Microsoft looks like they really did a great job of, refusing some of the OpenAI business, which eventually went to Oracle. And that's how Oracle ended up, signing that $300 billion deal over, multiple years. But clearly, Microsoft had that foresight in terms of, refusing to OpenAI. And to my mind, it sounds like this is going to be a lot more staggered in terms of the build out. And clearly, OpenAI was a lot more ambitious a couple of months back in terms of that 26 gigawatt in additional capacity they wanted to add. But it sounds like until they have revenues to show, it'll be hard for them to, ramp up capacity when it comes to the additional data centers that they want to open.
I am curious, Mandeep, is there an argument? I've heard from several investors, particularly this week, given all the attention around OpenAI, and of course that big piece in the Atlantic kind of questioning their business model. Is there a sense here that maybe some of the other big AI companies like Anthropic are potentially doing this in a better way than OpenAI?
Absolutely, and that's the challenge of a consumer-facing business is because you only have, 4% of your users who are paid users. You're serving, 800 million monthly active users. Bulk of it are freemium. How do you monetize? I mean, Google can monetize using ads. OpenAI needs either an ads or some form of monetization because the more users use, the more users they add, the more cash they are burning. And that's the challenge of a consumer-facing business. Anthropic, on the other hand, is enterprise-focused, and you get paid for every API call. So that way, it's an advantage for them.
Right. Mandeep, great to get some time with you. That is Mandeep Singh, Global Head of Technology Research over at Bloomberg Intelligence. Coming up, we'll be speaking with Ryan Serhant. He is CEO of real estate firm Serhant. Next. This is Bloomberg.
Wherever news and ideas meet, wherever earnings reports and saved orders intersect, the all-new Fidelity Trader Plus is there, giving you the freedom to trade how you want with your preferred tools, customized charts, and streaming data. So you can start a trade idea on one device and execute it on another. Meet our most powerful, consistent trading platform yet. Meet Fidelity Trader Plus.
Tiger Woods built his career on forward thinking, staying ahead of the curve and away from the expected. Insperity believes that in business, it's no different. They're dedicated to driving your business forward, providing the HR support you need to innovate and win. You don't become one of the greats by doing things the same as everyone else. You take a swing, knowing you've got the right partner by your side. Insperity, because how you HR matters.
I'm Jumana Bersachi in Beirut, and this is Bloomberg.
It's an evergreen story. Manhattan rents surging to a record high. Fresh data showing new leases in November were signed at a median of $4,750. That is up 13% from a year earlier. Joining us now, I'm pleased to say we have Ryan Serhant. He is the founder and CEO of real estate firm Serhant. He's also the star of Netflix's Owning Manhattan, which is out now with season 2. Ryan, it's great to see you.
Great to see you.
Let's talk about Manhattan, because we were joking in the commercial break. Has there ever been a period when Manhattan rents aren't rising to a record? But talk us through the specific dynamics that you're seeing in Manhattan right now when it comes to that supply and demand balance.
That's why the show is called Owning Manhattan and not Renting
It's hard to do.
Manhattan. It's hard to rent. For your median apartment in Manhattan right now, there's about 11 tenants who are applying per apartment because it's too expensive to buy. Rates are not yet at a place where the purchaser can afford the monthly payment, including the monthly HOAs and the monthly real estate taxes, and where sellers, where 90% of them have sub 5% loans. And in New York City, most of the adjustable rate loans, which most luxury markets have, are under 4%, can afford to move either. So all it does is it puts the mobility in the marketplace into leases, and then there's only so much inventory to go around. We have significant regulation now around what can and cannot be built. So most developers who should be building more housing to bring prices down, because that's how you lower pricing, you create more inventory, are saying this is too onerous, and they go build elsewhere.
Do you think those regulations are going to get worse with the new administration, local administration coming in?
Prices are high, not because of the market. They're high because of policy.
Yeah.
Look what's happened over the past 30 years. It's been policy, rules, and laws that have been created by who? By a generation of people who grew up with nothing, who set out to create laws to protect everything. And that's not capitalism, that is asset protectionism. And so the housing market protects stability, right? It protects people who own property already, landlords and homeowners, and it penalizes mobility, people who want to move, who I have a job, I need to move, I need to rent. But you can do it if you pay the price. And so we're seeing pricing go up. Prices will raise even through next year. And it's the same story over and over and over, and then we have a reset and we create more inventory. That's what we need. We need more inventory.
Well, Ryan, something made my week just in the past couple days. I was talking to a real estate agent. I recently moved to Hoboken. I signed a lease. I would love to buy.
I've been following your journey.
I know, actually. I've been discussing it with you. But I was talking to someone, and they said something along the lines of it's turning into a buyer's market. And you are starting to see some softening, at least in my hyper-local area. You're seeing some of the prices come down. I hear what you're saying overall, but I mean, is there any hope when you think about the New York City metropolitan area that, you know, people looking to buy a 3-bedroom might be able to do so? The tide might actually turn in their favor?
Average days on market right now is sitting at around 50. You've got about 45% of all new listings that have come to market this year have actually come off market. So there's actually a lot of quote unquote shadow inventory that's out there. So if you talk to a great agent, they'll have access to it because it's available for sale, but just not today because sellers are coming off the market for the holidays. You know, they're thinking through pricing strategy. What can they afford to actually sell for? So I don't think it's a buyer's market per se. You're not coming in and getting 10, 20% off. It's not necessarily also a seller's market where you're sitting there and you're saying, all right, I'm going to take my pick of the litter. I think it's an opportunity for it to be everybody's market, right? If you're a buyer and you can afford the property, you can make an offer, you can negotiate, and can get a good deal. If you're a seller and you're realistic on price, you will have buyers and you can sell pretty quickly. It's only when you have, you know, sellers or buyers who both think that they're the smartest person in the room, that's when each one says, bah.
Yeah.
I am the smartest one in the room.
See, I told you, we all are.
Yeah, and realistic pricing, that's something. That's a novel concept. I do want to talk a little bit about owning Manhattan. The second season came out. I watched the trailer. I haven't had a chance to actually watch the episodes yet.
You better this weekend.
I feel like it should be called, based on the trailer, it seems like it should be called Fighting Manhattan. What is going on with your agents and all the people out there right now?
Listen. It is a realistic depiction of what it's like to sell real estate with your shirt off. No, I'm just kidding. To sell real estate and build a real estate company from the ground up in New York City. And it follows that process.
Yeah.
It's also a reality show. It follows the drama. You know, and they film us in real time for 6 months. And then they capture the best moments and they edit it down into 8 38-minute episodes. It is a lot. It is fast. It's dramatic. It's incredibly emotional. If you like that type of stuff.
Yeah. Well, yeah, it's fun to watch. I don't know how real it is, but it's
super.
fun to watch.
Let me tell you. Compared to other real estate shows and other reality TV shows, this is the most real because it's my life. I live it.
Yeah.
And the drama there and the altercations, they're real and they've been in the press, so you can like follow along.
Yeah. I am curious though. One thing about the show, and obviously it gets edited down tremendously, but given that you're dealing with a lot of high-profile clients and other people who maybe don't necessarily want their faces or names even associated with it, how do you sort of navigate that and sort of being able to do your show and at the same time serve people that maybe want a little bit of privacy?
For people who want to go on camera, it's easy because they sign appearance releases, the properties sign location releases, and you're good to go. We do follow deals. For example, there's a deal on the show this season for $60 million. It's the sale of an apartment in the West Village. At the time, it broke the lower Manhattan condominium price record. The entire transaction is followed. I actually had a buyer, and he got screwed out of the deal, and they followed that process too. The sellers did not go on camera. The buyers didn't go on camera. The agents and the process are on camera, and that's where you actually get the most meat of the story. So there's a lot of that, right? We ask people if they don't have to. The show though brings an insane amount of exposure to Sirhan, to our firm. I mean, our listing traffic goes up something like 3,000%, right? I mean, Netflix is in 200 countries. There's tens of millions of people who watch the show right now. Maybe not you yet.
Yeah,
you're gonna watch it this weekend.
Do you know Netflix has this whole experience thing, like they have a Stranger Things theme park now out in King
they're Netflix houses.
Yeah, Netflix houses. Have you spoken with them about, because I mean, you sell houses.
I do.
I would think that would be a natural segue, the Netflix house Sirhan House or something?
Yeah, we have Sirhan houses. I love it. They have yet to open one in a location that is very nearby me, so I'm excited to go see one. They opened one up in Philadelphia first. I believe they have a Dallas one now. Vegas one coming. But yes, I'm all over them, letting them know, hey, you guys are buying HBO, buying real estate. I'm here to help.
I mean, they got $80 billion laying around, you know?
Yeah, there you go. Ryan, it's always great to get a check in with you. I think so.
You don't have another question?
I have a producer in my ear saying that we should wrap.
I had another question.
Well,
you don't want to talk about your housing journey anymore?
I have so many questions, but most of them are off.
Yeah, I can ask him about his T-Mobile partnership.
Do you want to tell us about it?
We can talk about T-Mobile, sure. Yeah, we broke the internet 2 days ago. We put together the first of its kind deal in the real estate brokerage space, where we're partnering with T-Mobile to bring something called Super Mobile to all of the people who use our app, which is called Simple, which is an AI operating system for salespeople. It replaces all administrative work. And so now everyone who uses it, their cell phones don't have to ping cell phone towers and wait in line like the rest of us. So even in New York City, your signal goes down, right? You'll be on like 55th Street and all of a sudden you have no service. So with Super Mobile, that doesn't happen. It's really, really cool. It's really wild. And it's been a lot of fun. And it's been a great, great partnership to have. It's a couple days old, and I'm excited to see it roll out.
All right, Ryan, always great to talk to you.
Thank you.
Best of luck to you. Ryan Serhant there, the star of Netflix's Owning Manhattan, and of course the founder and CEO of the real estate firm Serhant. We'll be back in a moment. This is Bloomberg.
Meet the all-new Fidelity Trader Plus with your preferred tools, customized charts, and streaming data, so you can start a trade idea on one device and execute it on another. Meet our most powerful trading platform yet, Fidelity Trader Plus.
Excellence takes drive, work, perseverance. Tiger Woods brings it to the course. Insperity brings it to your business. Want to be the best? Work with the best. Insperity, how you HR matters. Learn more at insperity.com/tiger.
Premium benefits anywhere you go. Unlimited, zero trading fees. 6% back in crypto. And other exclusive benefits with Level Up. Take your wealth to the next level.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
All right, welcome back. Our next guest built his brand by building businesses, from his track record at the Essence magazine to his New Voices VC fund, and a new one aimed at amplifying smaller, diverse entrepreneurs. I had a chance to sit down with Richelieu Dennis. He's the founder and chair of the Sundial Group of Companies, sold his Shea Moisture company back in the day for a cool $1.6 billion, and now trying to help out other entrepreneurs do the same. Take a listen.
We're entering a world now where everything is changing, right? Everything is shifting. And within that shift comes opportunities, right? And so there's the world that we used to live in from an entrepreneurial perspective, from a fundraising, from a capital, from a stability, from an ecosystem perspective that is undergoing a tremendous amount of shifting, right? We're seeing what's happening with Black women and their jobs and the the losses of jobs. We're also seeing that black women are driving the growth of new businesses in this country and driving the levels of entrepreneurship, but are also impacted by the lack of VC capital that's available and that's going to them. And so there are constraints, but within those constraints come new opportunities. And so our job is to help them navigate this new environment, help them get settled in where they are with their existing businesses, and then find new entrepreneurs and new opportunities for both the existing businesses and new ones. So it's fun.
Is the support there for them? I mean, it's funny, you talk about black women and the entrepreneurial streak. I feel like this is a conversation we could have had 50 years ago, 100 years ago. I mean, obviously, your connection to the beauty industry, there's a long line of black women who were basically shot out of other opportunities, and they found their own opportunities. Why is now different than then?
So I think now you have a few things that are structurally different, right? Then there were a lot more avenues in terms of new job opportunities opening up. We see the areas that they've been focused in, whether it's in the medical arena, whether it's in the legal arena, whether it's in the marketing arena. So those avenues were opening up back then, whereas those avenues now are shrinking. Right, so you're seeing when I talk about the job losses, you're seeing that black women are disproportionately affected or impacted by those job losses, right? And so I think what's different about it is the structural changes that are going on. Also, what's different about it is that they've now had a tremendous amount of opportunity to exposure. Right, and to see how things run, how things shift, how things change, and because they're the culture drivers, applying the understanding of what drives culture to those experiences that they've now had, I think is also helping to fuel that entrepreneurial spirit being exercised as opposed to just living within. And then the third thing is they've seen some success, right? You've seen companies like the Honey Pot with Beatrice Dixon. You've seen Monique and Mayel. You know, you've seen successes now that they can look at and say, hey, I can do that too, right? Like I've seen somebody start from scratch, start from the kitchen, start from the garage, build something, and I'm part of that build. And so I think you're also seeing some confidence that comes out of seeing others do it and be successful at scale.
On the capital side, I am curious, particularly when it comes to consumer products companies. There's been I've heard from a lot of venture capitalists this idea that a lot of them won't even sort of take a meeting with some of these companies, certainly not at the early stage, maybe when they're very mature and have a track record. Is that an impediment when you're dealing with these consumer product companies as to like how early are you comfortable getting involved with them, meaning making an investment?
Yeah, I mean, it's absolutely an impediment, right? Because as my mother always says, nothing happens until something happens, right? And so great ideas out there, great solutions to serious problems. A lot of times the capital doesn't understand the problem that you're solving, because most of the time the problems that we're solving are community-based problems, right? They're happening in our homes, they're happening in our neighborhoods, they're happening in our schools, they're happening in our churches, they're happening inside of our environments. And so a lot of times the capital doesn't understand that. More than that, a lot of times the capital is saying, hey, I'm more familiar over here, right? Or I know so-and-so, I have access to so-and-so, so that's where the focus is. And so the challenge is to get pools of capital that understand these solutions, right? Understands these problems and the solutions that are being provided.
Are you seeing more firms falling into that category, meaning newer firms, or at least firms that are represented by people who look like you?
Unfortunately, not, because at the higher levels, the capital has dried up, right, for those purposes, right? And so what you're seeing is less and less fund-to-fund activities going in here. So which means the ones that do have the resources, those resources have become more precious than ever. So deployment has become more stringent than ever. And so what you're finding is that there's less and less risk to be taken at the seed stage, at the incubation stage, and more folks are waiting to see where you land in your Series A. And what we found over the years is even when you get to a Series A and you get something that's functioning, it's still difficult getting that Series B and then getting to that Series C. So our job is to make these companies exceptional from the beginning, so that when they get to that stage, it's now a level playing field, and you're really now just looking at the math as opposed to, hey, do they have the right team? Do they understand the market? Can they scale? How much time is this going to take from us in order to make this happen?
Our conversation with Richelieu Dennis, the founder and chair of the Sundial Group of Companies. And you can actually watch the full interview by going to Bloomberg.com/live/shows and navigate to the close, Katie Greifeld.
Yeah, seamless process. It should only take a couple of minutes. Still ahead, the business.
Can we just put a QR code up on the screen or something like that?
That might be easier. We're working on it. Still ahead on the close, the business of reverse logistics is booming. We'll hear from ReturnPro CEO Sender Shamis about how the industry is navigating tariff and consumer crosswinds. This is Bloomberg.
Wherever news and ideas meet, wherever earnings reports and saved orders intersect, the all-new Fidelity Trader Plus is there, giving you the freedom to trade how you want with your preferred tools, customized charts, and streaming data. So you can start a trade idea on one device and execute it on another. Meet our most powerful, consistent trading platform yet. Meet Fidelity Trader Plus.
Premium benefits anywhere you go. Unlimited, zero trading fees. 6% back in crypto. And other exclusive benefits with Level Up. Take your wealth to the next level.
Bookstores are thriving again as retailers reimagine stores as curated experiences, using tools that depend on reliable and secure connectivity from AT&T Business. Because reading is a journey of discovery, and a book is a compass that helps us find the way forward.
Strategy now that tariffs have changed the game.
Most of our capital is being spent on those businesses that aren't exposed to tariffs. The next pool of dollars is going to our transformation.
Watch Chief Future Officer Wednesday on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
Reduce the opportunities.
It allows you to increase significantly your net income.
Watch Horizon's Middle East and Africa every trading day at midnight Eastern Time. Only on Bloomberg.
Time now for Next Up, where we highlight the entrepreneurs and trendsetters moving the needle in business and the economy. Today, we're talking reverse logistics. That's the official term for the chain of events that happens when you return that impulse purchase. Our next guest is just out with his annual holiday returns report and says that stakes have never been higher for his reverse logistics business. Joining us live in studio, I'm pleased to say, is Sender Shamis. He is the co-founder and CEO of Return Pro. Sender, great to see you in person.
Thank you very much for having me on.
So let's talk about these stakes this specific holiday season. Why are they this high this holiday?
So first of all, as always, the return rate keeps going higher and higher. This year it's over $800 billion, over 16% of everything sold. The goal at the end is to make sure we bring that product back to life and kind of get it back on the shelf. This year, I think more than any other year, most of the retailers and brands we work with have focused on tariffs, and our job is to make sure they pay as much attention to returns as they do to tariffs. And of course, last year it was a really important thing. I'm not saying it's not important this year. I'm just saying that some things did take a back seat to tariffs themselves. So from our perspective, you know, it's time to bring attention back to those returns, and it's very important to solve the problem.
So you work with retailers to help them manage that process. Let's say that, you know, something goes amiss. I mean, put it in concrete terms why this matters for retailers, you know, if they don't have a smooth process to actually handle the returns that they're getting.
So first and foremost, I think the most important thing to point out is the fact that returns represent such a huge percentage of the sales themselves, that 16% I talked about. But more importantly, 50% of consumers care about returns. That's a really important part of the return journey. They just won't shop at a retailer if they don't have a good return solution. Additionally, with things like AI, over 50% of consumers we surveyed used AI this holiday season to shop for their holidays, and there aren't any good return solutions that are doing that reverse kind of generative conversational AI, but for returns. There's a lot for shopping, but there isn't a lot for returns.
I am curious as to how you vet the goods when they come back, because obviously you have to make sure they're still in the new condition, or at least the condition that the retailer or the brand requires to return. But there's also the issue of the origin of the good itself, whether it was actually indeed bought from the retailer or whether it was acquired through, like, you know, theft or some other means.
So we do this for the largest retailers and brands. We do it for tens of thousands of brands and retailers such as Walmart. The brands themselves have different kinds of policies with the retailer themselves. So in a lot of cases, they'll ask for that product to be shipped back. If it is an international item, like we were talking before, the break ended, the item actually physically has to be returned to that country of origin. In a lot of cases, that headache is just not worth it. That transportation cost is not worth it. So maybe they'll let a customer keep it. Maybe they'll get a company like us to try to bring it back to life. We have we have basically thousands of teammates. We have locations in Canada, United States, Mexico, Southeast Asia. The whole purpose is to bring the product back to life and put it back on those marketplaces. And it's not just the people doing the work. It's the technology that it takes to put together that entire ecosystem to get that product back to life.
What have you done to improve your own technology internally within the company to sort of make this process not only easier on your clients, but I guess more economical for you as well?
So our software, our SaaS, is actually multi-phased. We have an internal component that works with the retailers themselves. So imagine a portal in POS, like in the point of sale systems. Imagine a portal online that allows the brands to physically let us take over the returns process. But then there's software that's in the warehouse that specializes in returns management systems. There's software that specializes in putting that product back on their marketplace. That's basically the gist of it, but there's a lot of nuances within it, especially lately with AI.
Oh, yeah.
And Sandra, we only have less than a minute here, but I do want to go to this finding in your annual holiday report. Caught my eye that fraud risk continuing to rise. 75% of retailers say that return fraud worsens during the holidays. What does that actually look like? People are trying to return things that they didn't actually buy?
So about $150 billion out of that $850 billion number is fraud. And there's two types of fraud. There's organized fraud. There's just like your regular consumer saying, you know, maybe this item's not what I wanted. Maybe they're wardrobing, which means they're buying an item, wearing it, and returning it. There's a lot of different types of fraud. The organized one is the dangerous one. And it's just a terrible thing that needs to be resolved. We do it.
All right. Well, obviously a busy time of year for you, the holiday season, and more importantly, the post-holiday season. Sender, always great to catch up with you. Sender Shamas is the co-founder and CEO of Return Pro, a company that helps all of those retailers and brands deal with all your unwanted holiday gifts.
Yeah.
Katie Greifeld.
Certainly a lot of that, I'm sure, to sort through during the holiday season and immediately after.
Yeah, and well, speaking of the holiday shopping season, we did get a chance to catch up with the CEO of Macy's, Tony Spring. A special conversation with him that will air tonight on Wall Street Week that airs at 6 p.m. New York time. That does it for us here on The Close. Katie and I will be back on Monday, but for all your politics coverage, stick around. Balance of Power is up next.
Meet the all-new Fidelity Trader Plus with your preferred tools, customized charts, and streaming data, so you can start a trade idea on one device and execute it on another. Meet our most powerful trading platform yet, Fidelity Trader Plus.
You can't control the course or the competition, but you can control what you do next. Tiger Woods built his career on the ability to reset, adapt, and make the next shot count. Insperity is built to help businesses do the same. You deserve an HR partner that's there to help you thrive, no matter what comes your way. Insperity, because how you HR matters.
Premium benefits anywhere you go. Unlimited, zero trading fees. 6% back in crypto. And other exclusive benefits with Level Up. Take your wealth to the next level.
No matter the challenges we face, there is a place where we can find answers, where we uncover new perspectives, where innovation sparks real change, and our actions push our world forward. This is Singapore, where events create lasting impact.
This is Bloomberg. Africa, a region rife with potential for growth and opportunities, but not without its challenges. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? On this episode,
the goal is to expand in terms of countries, in terms of geographies, but also in terms of products, new services that we can launch in the geographies that we have presence.
Premieres December 19th, only on Bloomberg.
This is Balance of Power, live from Washington, D.C.
From Bloomberg's Washington, D.C. studios to our TV and radio audiences worldwide, welcome to Balance of Power. I'm Joe Matthew in Washington. Tonight, breaking news, the president leaning toward a Fed chair pick. The moves just within the last hour. On the race for Fed chair, with the Wall Street Journal now out with this report just a short time ago, the headline reading, quote, Trump says he is leaning toward Warsh or Hassett to lead the Fed. The president telling the Journal in an interview, former Fed Governor Kevin Warsh or National Economic Council Director Kevin Hassett are at the top of his list, saying, quote, they're both, I think the two Kevins are great. Noticeable inclusion of Warsh today, coming just hours after J.P. Morgan CEO Jamie Dimon signals his support for Warsh in a closed-door event. Joining us now for more off the top here is Bloomberg's Washington Deputy Bureau Chief Laura Davison. That's a pretty short list. So it does come down to the so-called Kevins, as we've been hearing for months.
Yes, this has been a really interesting evolution from the president. Just a couple weeks ago, he was saying he was certain, he'd made his pick, he'd narrowed it down to one.
Yeah.
Now we're hearing a Trump who is a lot less certain, and probably two reasons for this. One, Trump does not like to make any personnel decisions until the very last moment. He likes to keep us all guessing. And because of that, number two is that he can kind of keep these candidates sort of pitted against each other, competing to make sure he's absolutely certain that he likes who he's chosen. He, very notably had buyer's remorse after picking Jay Powell in his first term.
Yes, notably indeed. Now, we know that final interviews were taking place with the boss this week. Would the re-emergence of Warsh at the top of the list suggest that those interviews brought him forward again?
It certainly does. He met with him on Wednesday. He said that he got this assurance from Warsh that he wanted to lower interest rates. This, of course, has been the number one thing that the president has really wanted to see. So this is, also coming at the time when Wall Street, notably Jamie Dimon, is not very enthusiastic about Hassett.
Yeah.
We had reported Hassett was this front runner, but as this has gone on, in some ways, Trump likes to have these trial balloons that he puts out there to see how people respond. This allows him to give him more maneuvering room to pick someone.
That's great. We're still, though, expecting an announcement early next year. Is that still the case?
It could come at any time. Trump has suggested he might wait till early next year, but he, the seat doesn't officially open up until the end of January, so he could even push it later in the month.
Got it. Laura Davison with breaking news at Bloomberg in Washington. We thank you. Meantime, the other big news gripping the city here and the tech world is the president's moves on AI, signing an executive order blocking state-level AI regulations and handing a policy win to tech industry leaders who've pressed for preemption of local rules. For details on this, we turn to Bloomberg's Michael Shepard with us here in our Washington bureau. An EO is one thing, but of course it can be undone pretty easily. Mike, does he not need the help of Congress here?
He does. And in fact, he has said, and the order specifies, that the administration led by White House AI czar David Sachs, who happens to be a venture capitalist, joining the administration this year, they would work with lawmakers to craft what a legislative framework